Now, coming to Accounting Standard 22 that deals with taxes. Now, Accounting Standard 22 talks about how should we calculate, how should we present, how should we compute the expense or benefit on taxation, right? Now, for this, you need to have a basic understanding of Income Tax Act of 1961, basic understanding, right? Of course, because you are writing group 1, I presume you would have already completed, significant portion of income taxes as well. And how do we compute or how do we calculate accounting income? So these two understanding is very, very important, right? I'll give one small scenario to build the concept and then we will move ahead to the concepts of the standard. Now, as far as accounting income is concerned, we'll follow the schedules of the Companies Act, we'll follow the accounting standards, we'll compute the expenses, and we will figure out, yes, this is how the income or expense has to be calculated. So you'll have some line item. Say for example, sales. I'll put one number, 10,000. Cost of goods sold. I'm not following a proper Schedule 3 format. This is just for understanding. 8,000. Assume this 2,000 is my profit before depreciation. This is profit before depreciation. Then let us say there is depreciation of 500. So you have profit before tax of 1,500. Profit before tax of 1,500. This is called income as per books, or you can also call it as accounting income, right? This 1,500 becomes my accounting income. Now, income tax works very differently. Income tax is whatever you have calculated as per your books, I don't accept it. You have to compute the income as per my rules, as per my regulations. So when you come to Income Tax Act, income tax says all this depreciation, whatever you have calculated, I don't accept. So then what do you accept? You have to calculate depreciation as given in the provisions of section 32, right? You don't need to remember the rates. The question will give the rates and all of that in the examination. But income tax says this 500 is not acceptable to me. So then what is acceptable? Assume for a moment 400 is acceptable. Income tax says I will allow only 400 of depreciation as a deduction. Then what happens? Instead of 1,500 as income, I will have income of 1,600. As per what? As per tax provision. This is called taxable income or income as per taxation. Okay. 1,600 is as per taxation, 1,500 is as per books. Now, 2-3 things you keep in your mind while solving questions on accounting standard 22. One thing that the income tax wants is calculate tax on this 1,600 and pay tax on that 1,600. So how to calculate? Now for companies there is a flat rate. For individuals, of course, will not be tested. For capital gains, we have a different rate. All of this will be given to you in the question. All right. So 1,600 is the income. Assume for a moment 20% is the income tax rate. 20% is the income tax rate. So 1,600 multiplied by 20%, you have 320 as your tax payable. Okay, I'm ignoring cess and all for the moment, but 320 is the tax payable. This tax payable, what you calculate as per the income tax provision is called, what is it called? What is it called? The tax that you calculate as per the provisions of the Income Tax Act, that is called current tax. That is called current tax. Okay, till here understanding is not difficult because you have been doing income taxes, you will be able to understand this. Now the problem or the challenge comes when the accounting standard says that, see, you have charged 500 of depreciation here. You have charged how much? 500 of depreciation. Income tax says 600 of depreciation. There is a mismatch. Sir, why is there a mismatch? My expense is 500 here. My expense is 500 here. But for tax purpose, for calculating income tax, I have calculated or I have reduced 600, not 500. So there is a mismatch. We have violated the matching concept. So accounting standards prescribe that to ensure matching concept is there, you calculate what is the impact of this difference. Now, what do you mean by impact of this difference? In my books, I have charged 500 of depreciation. For taxation, I have charged 600 of depreciation. Now, in future years, see today what has happened? See this, year 1, books, tax. Books it is 500, tax it is 600. Maybe in year 2, books will be 500, tax will be 550. Maybe in year 3, books will be 500, tax will be, no, sorry, I'll just revise the example. So assume we have books and we have tax. In year 1, books had how much? 500, tax had how much? 600. Maybe in year 2, books will have 500, tax will also have, say for example, 500. Maybe in year 3, books will have 500, tax will have 400. So what happens is, today income tax says take a higher deduction. Income tax says take a, okay, I took 400 here. So I missed the number. I'll again do it. Sorry guys, because I was thinking I took 600 there. Did some of you put a comment here? Okay. I'm revising the example. I thought I took 500. So again, books was 500, tax is 400. In year 2, books is 500, tax also is 500. In year 3, books is 500, tax is 600. Of course, it will not be such a streamlined reversal, but just for example. So in year 1, what has happened is, income tax says, I will give you lower deduction. So this resulted in higher taxable income. Here, there is no difference. In the 3rd year, it became lower taxable income. Now, think of it. There is a difference. Because of this difference, in the 1st year, I had to pay a higher tax. But in future, because I have paid higher tax here, in the 3rd year, I have to pay a lower tax. So this is called deferred tax. This is called deferred tax. Deferred tax means for the future, shifting it to the future. Now, what the standards require is, these differences cause a mismatch between accounting and taxable income. You have to calculate the tax impact of that so that the expense that you have charged in the books and the tax that you show in the books is aligned. Now, what do I mean by that? Here, I have to pay higher tax today. How much did I pay? 1600 into 20%, I paid 320. And because of this difference, there is a difference of 100. Because of this difference will give me some kind of benefit in the future. It will give me some kind of benefit in the future. That benefit which I get is called a deferred tax asset. So on 100 multiplied by 20%, I get how much? I get 20 worth of deferred tax asset. This is a benefit. This is a benefit. So what does this benefit represent? This benefit represents a future reduction in tax liability in the 3rd year. So when you come to the 3rd year, in the taxation you get a higher deduction. So assume this income is still 1500. So what will happen at that point of time? 1500 minus 100 of extra depreciation, you get 1400. On this, if you apply 20% taxation, you get tax of 280. You have to pay only 280 of tax. Here you have to pay 320 of tax. This extra 20 gets offset here. So here we say we have reversed the DTA. The reversal is how much? 20. So when it comes to tax expense is equal to current tax plus or minus deferred tax. In year 1, it became current tax of 320 minus asset of 20. Why minus asset of 20? If I am creating an asset, it gives me a benefit in the future. It is a benefit, so I am reducing it from my expense. So this became 300. In year 2, there is no impact. In year 3, it became 280 plus 20. This 20 I am reversing now, and this also became 300. So matching concept is followed when we try to do deferred taxation. Now, one thing I want to make it very clear here is, in real life, this will not exactly match like this because taxation rates are different, reversal timings are different. So all of those factors will be there. But the underlying logic is, whatever expense I am charging in the books, my tax expense should reflect those expenses. If I am getting some kind of benefit from taxation, or if I have to pay something extra for taxation, it will have a future impact which I have to show it in the books of accounts, right? So this is how the concept of deferred taxation works. The logic that you have to remember is, taxes paid today and future. If taxes to paid today is higher, sir, why will it be higher? Disallowances by the Income Tax Act or some income which is taxed earlier. So if the taxes paid today is higher, which will result in a future reduction of taxes, this will create a scenario called deferred tax asset. This will create a scenario called deferred tax asset. And if taxes paid today are lower, in future I have to pay a higher tax. This will create a scenario called deferred tax liability. Now, here, if you see, first we paid higher tax, in future there is a lower tax. So in year 1, it created a deferred tax asset. And in year 3, that deferred tax asset got reversed. Okay. So two things you have to keep in mind. One, tax expense is equal to current taxation plus deferred taxation or deferred tax impact. And if taxes paid today is higher, in future if I have to pay lower tax, this becomes a DTA. If taxes paid today is lower, this result in higher taxation, this becomes a DT. Are we clear? Any questions here? Okay, great, perfect. Now, Accounting Standard 22, accounting for taxation income, deals with the taxation impact and focuses on matching concept, basically matching expense against the revenue for the period. So whatever expense you have charged, whatever expenses you have created, the taxation impact should also reflect that. Then few important terms I have already discussed. Accounting income or loss is the net profit or loss before taxation for a period as reported in the statement of P&L. So this is your profit before taxes. Taxable income is the amount of income or loss for a period as per tax laws. What is relevant for us? Income Tax Act of 1961. Now, two things you have to keep in mind. If the question gives you the tax rate, if the question gives you how to calculate, follow that. Okay, don't take as per tax. This is there. This is wrong question. No. If nothing is given, you can assume rates of income tax is applicable, and you can accordingly do it. Right? Then current tax is the amount of income tax determined to be payable or recoverable. Recoverable could be if at all there is a kind of a refund in respect of the taxable income for the period. So current tax is taxable income into tax rate. And deferred tax is the effect of timing difference. Now what is this timing difference? I gave you an example where there is a depreciation impact. Every year there is a difference. First year tax has given us lower deduction. Next year there was no difference. In the third year, tax has given a higher deduction. So that is called timing difference. So there are two types of differences what you need to understand. One is timing difference and the other one is permanent difference. Timing difference is something or a difference which arises in one period. For example, in year 1, it has arisen. This will be subsequently reversed in the subsequent periods. So if there is something which arises in one period and are capable of reversal in one or more subsequent period, this is called timing difference. Classic example is depreciation, and most of the questions are based on depreciation in your questions or in the exams. Permanent difference are those which originate in one period and do not reverse subsequently. What is the meaning of this? There is a difference. For example, interest income exempt. Now, interest income exempt, will I show it in the books? Yes. Will I consider for tax purpose? No. So it creates a difference. But this difference, once created, will never ever reverse in the future. That is called a permanent difference. So that is one. Another example could be if there is something in the nature of penalty, etc., which is disallowed under section 37, then once disallowed, it will never be allowed. That is also a permanent difference. Whereas if something is disallowed under section 40 IA, I have written the correct section. Okay, this is with respect to, let us say, TDS. Now, if something is disallowed with respect to TDS, for example, you made payments to some contractor, you did not deduct TDS, and the amount is disallowed. What is the amount disallowed if I don't deduct TDS under section 194C? If I don't deduct TDS under section 194C, what is the amount of expense that will be disallowed? Yes? Can you type it out? Because I am not able to hear my turn off the speaker, so you need to type it out. Guys, you're writing examination. I expect you to give me answers. If 194C TDS is not deducted, what is the amount of disallowance under Income Tax Act? I'm waiting for an answer. 30%. Very good. Finally, you got the answer. Okay, why did it take so long? I don't know, but yes, 30% is disallowed. Now, this disallowance, is it a permanent disallowance? Is it that they will never allow us that expense? No. This 30% disallowance will be subsequently allowed in the future. So, this is called timing difference. Okay, same way we have one section called 36, I think IV, I don't know, some section under 36 where PF of employees. If employees' share of PF is not contributed within the due date, it is disallowed. And recently there was an amendment which said it will never be allowed in the future. It will never be allowed in the future. So that is a permanent difference. Now, permanent difference basically means that even if you pay higher tax today, in future you will not get any benefit. So that is what is called permanent difference. Okay, permanent difference does not create deferred tax impact. So there is no deferred tax liability, there is no deferred tax asset. So for us, what we need to understand is whenever we handle examination question, first we need to check, are there any differences? Then step 2 will be whether it is permanent or temporary. If it is permanent, ignore. If it is temporary, step 3 would be whether there is a higher tax today. If it is a higher tax today, then it is a DTA. If no, then it becomes a DTA. This will complete, or this will help you revise this chapter thoroughly. Are we clear? Okay, right? So that is how we have to approach a question considering the differences. So let's have a look at some of the illustrations. Financial year ending on 31st March, 1st of April of year 1, purchase of machinery 1,50,000, useful life 3 years, expected scrap value 0, IT depreciation 100% in year 1. In the first year itself, we'll get 100% deduction from this particular machine. Accounting depreciation is SLM. SLM means what? 1,50,000 divided by 3, it becomes 50,000. Profit before depreciation every year is 2 lakhs. So every year profit before depreciation is 2 lakhs. Tax rate is 40%. Now let us see how does it work. Sorry. Profit before depreciation every year it is 2 lakhs, 2 lakhs, 2 lakhs. Anyways, it's given in 1000. Depreciation for accounting purpose. So, as far as books is concerned, every year 50,000 depreciation, 50,000, 50,000, 50,000. Profit before tax becomes 200 minus 50, 150 every year. Okay. Now, when it comes to taxation, taxation says we will give you entire amount 100% as a deduction in the first year itself. We'll give 100% deduction in the first year itself. Now, when we give 100% deduction in the first year itself, now here profit before tax is 150, depreciation we have said 150, only 50. Tax says take 150 as depreciation. Means what? 100 of extra depreciation. So 150 is the total depreciation. Profit before tax is also 150. You get extra 100 of depreciation. So taxable income is 50. Or if you want to do it other way, what you can do is profit before depreciation is 200. From that 200, take 100% deduction of income tax of depreciation. So this will be 50. Profit before tax will be 50. Okay. Now on this 50, 40% rate when it is applied, you get 20. This 20 is called current tax. Once again, I have profit before tax of 150. I get 100 of extra depreciation. So my taxable income becomes 150 minus 150 multiplied by 40%. I get 20 as the current tax. I am paying a lower tax, but I have to pay a higher tax in the future. I have to pay a higher tax in the future. If I have to pay a higher tax in the future, it will be a deferred tax liability. Now, what is the amount of higher tax? We have to see what is the difference. First step, identify the difference. Depreciation as per taxation 150, as per accounts 50, difference is 100. Difference is 100. Now, is this a temporary difference or a permanent difference? This is a temporary difference. I am paying lower tax now, so I have to pay a higher tax in the future. So this will result in a deferred tax liability. 100 multiplied by 40%, 40 becomes deferred tax liability. Now this deferred tax liability, what I will do, I will add it to my expense. So deferred tax. So this is called, this is the current tax, this is the deferred tax. Total will be 60. Total is tax expense. Now in examination, they may ask you, calculate the tax expense. When they say calculate the tax expense, you have to calculate current tax as well as deferred tax. If they say calculate only deferred tax, you will calculate only deferred taxation, right? So this is the first year. In the second year, what happens is you have 200 of income before depreciation, 50 is the depreciation, 150 is the profit before tax. Now when it comes to taxation, taxation says I have already given you deduction. So this 50 of deduction is no longer allowed. This 50 of deduction is no longer allowed. So on this 150, you will add back 50, which will make the taxable income to be 200. Or what you will do? You can say profit before depreciation itself is 200. There is no further depreciation allowance. So this is the profit before tax. On this, when you apply 40%, you get 80. This is my current tax. So current tax is always taxable income multiplied by the tax rate. Taxable income multiplied by the tax rate, which is 80. Right? Now, what happens to deferred taxation? In deferred taxation, see, there are two ways to approach it. Depreciation as per books is 50. So, in year 2, depreciation as per books is 50. As per tax is 0. So the difference now has become 50. Now please understand, this is not a fresh creation of difference. Year 1 was 50, 150, difference was 100. This was created. In the first year it was created. In the subsequent year, it is reversed. In the subsequent year, it is reversed, right? So this is called reversal of deferred tax liability. See, one is creation. First time when it happens, it is a creation. Subsequently, if the difference gets reduced, it is called reversal. So what happened? 50 got reduced, reversed. If 50 got reversed, multiplied by 40%, 20 is the impact which is reversed. So here if you see, in the first year we created 40. Please understand this. This is one part where students make a lot of mistake. 40 is when we created, or when we created 40 was the deferred tax liability. After the end of first year, there is a reversal of 20. Reversal means I have consumed DTL of 20. Now when I reverse a DTL, it is reducing my liability. So I take it as a benefit. So my current tax expense is 80, which is 40% of 20. This 20 is the reversal. So my tax impact is again 60. My tax impact is again 60. Here current tax minus deferred tax, because I am reversing a liability. So I get 60. In the third year also same thing, 80 minus 20, 60. Okay. So sometimes if the question asks you for 3 years, first calculate current tax for all the 3 years, then calculate the deferred tax, and if there is a reversal of deferred tax, you should calculate that. Now in exam, if a question like this comes, this is a very simple question, you will also get marks for calculating current tax correctly, and you will get calculation of deferred tax marks, that also you will get. So for example, maybe 1.5 here, 1.5 here, and 1.5 here, around 4.5 to 5 marks will be allocated. Okay, that is how you need to calculate. So even for calculating taxable income correctly, you will get some marks. For calculating current tax correctly, you will get marks. For calculating deferred tax also, you will get marks. So again, a recap. First, see if there is any difference. Then see if it is a permanent or temporary. If permanent, ignore. If temporary, I will be paying higher tax today. If yes, DTA. If no, DTL. In the current case, we were paying lower tax today, so DTL. DTL, so when you calculate tax expense, you will say current tax plus DTL minus DTA. So what if we are reversing DTL? If you are reversing DTL, then when there is a reversal, you will do minus DTL plus DTA, which is reversed. Okay. Logically, if you think and practice 2-3 questions, you will be perfect in this concept. Any question? Okay. Now, when it comes to accounting treatment, current tax is an expense. Deferred tax liability creation is also an expense. These two put together will be the total tax expense. So what if there is a DTA? DTA you will reduce. DTA you will subtract while calculating the expense. Now, when it comes to DTL, whatever is the DTL, you will directly recognize, because you are creating an expense. So when you are creating an expense, when you are charging an expense, you directly recognize. But when it is a DTA, you have to apply the concept of prudence and check virtual certainty regarding future taxable income. What do I mean by that? See, when I am saying DTA, I have said that I am paying higher tax today, and in future I will pay lower tax. In future I will pay lower tax. Now in future, if I am expected to incur losses only, if I am expected to incur only losses, will I be able to get any benefit of this taxes paid today? I will not be able to take any benefit, right? So if I am paying a higher tax today and I have to create a DTA, in the future, if I am expected to incur losses, I will not be able to utilize the higher taxes paid, and hence DTA should not be recognized to that extent. Another example is, if there are losses today, what happens is, in future you can set off the losses. In future you can set off the losses. When you can set off the losses in the future, what happens? You will pay low tax at that point of time. So these losses that you have today, the accumulated losses which you have today, this also results in creation of deferred tax asset. But one thing that you have to keep in mind is, even though there is a deferred tax asset on this particular losses, if in future also I am expected to incur only losses and losses and losses, I should not be recognizing deferred tax asset. So the concept of prudence says that if I am recognizing DTA, it should be recognized only to the extent that there is a reasonable certainty of their realization. So I have to see whether can I realize the asset, only then I can recognize DTA. That's the first thing. Second, if an enterprise has unabsorbed depreciation or carry forward of losses under the tax laws. So as I told you, if I have carry forward of depreciation and carry forward of tax losses, in future I will have to pay less tax, and hence I have to create a deferred tax asset, right? Deferred tax asset should be recognized only to the extent that there is a virtual certainty supported by convincing evidence. This term you have to remember. Virtual certainty supported by convincing evidence that sufficient future taxable income will be available against which the deferred tax asset can be realized. So if I am recognizing losses, I have to see, is there a reasonable certainty or is there a virtual certainty? Is there a virtual certainty? In the future, I have convincing evidence that in the future I'll make profits, and accordingly I will be able to realize the deferred tax. Only if this is satisfied, you can recognize deferred tax asset. Remember this term. If there is a theory question, you have to mention this without fail. So this is something which you have to remember. Okay. Now, we have seen what is the concept of current tax, what is the concept of deferred tax. First thing, subsequently, when you have to calculate the amount, what is the rate required? See, current tax is equal to taxable income multiplied by tax rate. What is the rate to be taken? For current taxation, you will take what is the applicable rate in taxes. Means for example, for your examination, finance budget of 24 is applicable. Jan 25, right? So finance budget of 23 is applicable. For May 25 students, my Finance Act of 24 is applicable. Correct? So what is the applicable tax rate and loss? What is the applicable tax rate and loss? Using the tax rate, you will calculate current taxes. But when it comes to deferred taxation, what you need to understand is, you will take the tax rates and tax laws that have been enacted or substantively enacted. Meaning to say, budget is presented in, let us say, February of 2025, for example. Okay. Now, when the budget is presented for February 25, assume for a moment, the parliament has passed, but president approval we will receive in July end. And you are preparing first interim financial statement, financial report for the first quarter, that is April to June. Budget has been passed by both the houses of parliament. Only technical formalities pending. This is called substantively enacted. So if already it has been substantively enacted, the rates that has been given, that rate will be considered for deferred taxes. See, for current taxes, there is no confusion. I know the rate, I will apply that rate. For deferred taxation, there is either enacted rate or substantively enacted rate, which should be considered, and you should not discount it to present value, because you cannot reliably measure when will the reversal happen. So this should not be done. And always remember, deferred tax asset or liability will always be shown as non-current asset and non-current liability. So rate to be considered: for current tax, the rate already enacted; for deferred taxation, the rate which has been substantively enacted. Only technical formalities are pending. Okay. Now, if at all a question comes on passing journal entries in the examination, we know tax expense is equal to current tax plus deferred tax liability minus deferred tax asset. Okay. So for current tax, the entry will be tax expense, which is a P&L item, to current tax payable, which is a balance sheet item. For deferred tax liability, you will have deferred tax expense, which is P&L item, to deferred tax liability, which is a balance sheet item. This is non-current, this is current. Okay, and if there is a deferred tax asset, you will have deferred tax asset to deferred tax benefit. Again, this is a balance sheet item, this is a P&L item. This also will be shown as non-current. So instead of deferred tax benefit and deferred tax expense, can I write tax expense? You can write. That is also allowed. Okay. Now if you see, tax expense plus deferred tax expense will make your total tax expense, or tax expense minus deferred tax benefit will make the total tax expense. Right? Now, if previously there are some unrecognized deferred tax asset, or if you have already recognized some deferred tax asset and you want to carry out a review, so what happens is, I have created a DTA. Okay, I created a DTA. Subsequently, I feel that this DTA cannot be recovered. So what will I do? I will write down this DTA. Or initially I have not recognized DTA, or I have recognized at a lesser amount. Subsequently, I feel that I am making profits. I can realize this DTA. Then you will either reverse it or you will recognize afresh. So basically, both the DTL and DTA, they will be reviewed. They will be reviewed at the end of each balance sheet date to see if there is no certainty existing. I have already recognized DTA, but it is no longer virtually certain that future taxable income will be available. Write down. Previously, I have written down. Now there is evidence that I can realize it. Reverse it. I have not recognized in the past. Now I feel that I will be able to recognize it. Reverse it. Okay. So that is what it is done. In the balance sheet, deferred tax assets and liabilities should be distinguished from current tax and disclosed under a separate heading in the balance sheet, separately from current assets and current liabilities. Basically, non-current asset or a non-current liability. In the P&L, what you will do is, you will show in the tax expense current tax separately and deferred tax separately. These two breakup is given. Any questions so far? No questions. Okay. Now, one more aspect is changes in tax rate. Okay. Let us say in year 1, depreciation as per books is 50,000. Depreciation as far as taxation is concerned is 80,000. So the difference is 30,000. Difference is 30,000. Now with this difference of 30,000, assume the tax rate applicable is 30%. So 30,000 into 30% is 9,000. Now because tax is giving me extra deduction, I have to pay a lower tax. In future, I have to pay a higher tax. So this will result in a deferred tax liability. Right? Now assume in year 2, there are no differences. Depreciation is same, but this tax rate has changed from 30% to 25%. Then what we should do? On this difference of 30,000, so you have to take the total cumulative difference, 30,000, you will apply 25% rate, and now you have the liability of 7,500. Initially liability was 9,000, now it is 7,500. So when the tax rate changes, you also need to revise the liability. When you have to revise the liability, it can result in either increase of liability or decrease of liability. Here there is a decrease of liability, means there is a reversal of DTL. So whenever there are tax rate changes, you have to reverse. You have to reverse or you have to add, depending on whether the tax rate has increased or tax rate has decreased. Let's look at this question. Year 1, 1 lakh is loss. Year 2, there is a loss of profit of 50,000. Year 3, there is a profit of 60,000. Tax rate is 40%. Tax loss permitted to be carried forward up to 8 years. Now, in year 1, if I have a loss of 1 lakh, what will I see? I will see, is there a virtual certainty that in the future I will have profits to take the benefit of deferred taxation? If yes, then in year 1, you multiply this by 40%, you have 40,000 of deferred tax asset. 40,000 of deferred tax asset in the first year. In the second year, what will happen? I have an income of 50,000, but I have a carry forward loss of 1 lakh. I have a carry forward loss of 1 lakh. So what will I do? I will set it off and my current tax will become 0. I don't have to pay any tax because I have brought forward loss. But I have already consumed 50,000 out of this 1 lakh. I have already consumed 50,000 out of this 1 lakh. So my carry forward loss will be equal to 50,000 only. 50,000 into 40%, I have a balance of only 20,000. So here I had a DTA of 40,000. Now I have a DTA of 20,000. So there is a reversal of 20,000 of DTA. This reversal of DTA will become my expense. Now see how beautifully the amount will match. 50,000 of income, reversal of 20,000 DTA. Basically, I am recognizing expense on account of 50,000 of profit. You can think of it this way as well. Then in the third year, what will happen? Another 50,000. See, balance is 50,000. Here profit is 60,000. So in the third year also, reversal will happen. In the third year, current tax equals to 60,000 minus 50,000 multiplied by 40%. So this is 4,000 and the balance of 50,000 gets reversed. So DTA reversal will be 20,000. So total tax expense will be equal to 20 plus 4, 24,000. Total tax expense will be 24,000. That also see how nicely it gets matched with the 60,000 of profit. So what you will do? In the first year, deferred tax asset, tax savings. Second year reversal, tax expense. Third year reversal, this also becomes tax expense. Current tax plus deferred tax will make the total tax expense. Okay, that is how the matching concept works when there is a profit, when there is a reversal of, or when there is a utilization of brought forward losses. Now, some questions and we'll see how to handle, how to quickly compute in the examination. The following particulars are stated in the balance sheet of Siddhi Limited as on 31st March of 22. Deferred tax liabilities credit 2.5, deferred tax asset debit 1.35. Now, one thing what you have to understand is, you will present in the balance sheet as net amount. So here DTL minus DTA 2.5 minus 1.35, you will present it on a net basis. If DTA is higher, that also you will present it on a net basis, right? The following transactions were reported during 22-23. So this is what opening balance. This is what opening balance. The following transactions were reported. Depreciation as per accounting records 15 lakhs. Depreciation as per tax records 20 lakhs. Now what has happened? Is there a difference? Yes, difference of 5 lakhs. Is it a temporary difference? Yes, it's a temporary difference. Now we have to see whether it will reverse or whether it will add, depending on how do we look at it. Now here, because there is no information of previous balances, you can treat this as a reversal or a fresh addition as well. Okay, so accounting records is 15, income tax is 20, difference is 5. Now tax is allowing me higher deduction. If tax is allowing me higher deduction, my profit will be higher or lower? My profit will be higher. My profit will be lower. If my profit is lower, in future I have to pay, today I have to pay lower tax. In future I have to pay higher tax. So this 5 will create what? A deferred tax liability. Second, interest paid to NBFC accounted in the books on accrual basis but paid on 30th of June. Now this you have accounted in the books on accrual basis, but as far as section 43B is concerned, it will be allowed on payment basis. So this will also be disallowed. If this is disallowed, my income tax expense is higher, or taxable income is higher, accounting income is lower. So on this 6, it will create a deferred tax asset, because in the next year when I pay, I will get a deduction, and when I get a deduction, I will pay lower taxes. So always remember, if there is, for your understanding, if there is any disallowance of expense by income tax, this will always create a DTA. Just keep this in mind. If at all there is a disallowance under the Income Tax Act, it will always create a deferred tax asset only. Okay, so this will create a DTA. Items disallowed for tax purpose in 21-22 but allowed in 22-23 means previously it was disallowed. At that point of time, what would have happened? Previously in 21-22, this was a DTA. Okay, but now it will be reversal of DTA. So this will be a reduction from DTA. Donation to private trust. So assume this is disallowed and it is a permanent difference. So this will become a permanent difference. Tax rate 15%. So on all of this, you'll do 15% calculation, right? So now, difference in depreciation, it will create a DTL. That is what we have seen here also. How much? 5 at 15%, 0.75. So 5 multiplied by 15%. Then interest paid. Oh, I missed it. This 43B, see how important it is to remember the timelines. This 43B, this will not be disallowed because this is before the due date. 30th June is before the due date of filing returns, correct? So because it is before the due date of filing returns, this will not have any consequence. My bad. I assumed that it will be disallowed, but now I recall, as per 43B, it will be disallowed if you pay it within the timeline of filing returns. It will not be disallowed. Then previously it was disallowed. Now it is a timing difference. It is a reversal of DTA. It is a reversal minus of DTA. How much? 1.05 into 15%. And here donation to private trust, permanent difference, it is not applicable, right? Then in the balance sheet, it will be disclosed that DTL 2.5 plus 0.75, which is added 3.25, and DTA 1.35 minus 0.58, this number, and this has to be presented on net amount basis. Net amount will be whatever 3.25 minus 1.92 of DTL, which will be presented in the balance sheet. Any question here? Now here, if you see, because they have not mentioned anything, you will apply the provisions of Income Tax Act of 1961. So some key provisions you need to remember. Don't think that, sir, it is an income tax, it is an accounting paper, why should we remember income tax? That approach will not work. Okay. It's 11 o'clock. Then the following information is furnished in respect of Mohit Limited for the year ended 31st March of 22. Depreciation as per accounting records 56,000. Depreciation for income tax 38,000. The above depreciation does not include depreciation on new addition. So this is old only. A new machinery purchased on 1st of April costing 24,000, on which 100% depreciation is allowed in the first year for income tax purpose, whereas SLM method of depreciation is considered for accounting purpose. Estimated life is 4. So 24,000 divided by 4, accounting depreciation is 6,000. Just a moment. The company has made a profit of 1,28,000 before depreciation and taxes. Donation to private trust during the year 15,000 not allowed under income tax laws. Corporate tax rate is 40%. Right. Now here, profit before depreciation and taxes is given as 1,28,000. Then Depreciation as per accounting record is 56,000 plus depreciation on new addition is 6,000. So 56,000 plus 6,000 will make it 62,000, right? Profit before tax 66,000. Now taxable income. Profit before depreciation and tax is 1,28,000, or alternatively what you can do, you can take profit after tax and do the reverse working. But if this number is already available, profit before depreciation and tax, it is advisable to use that. Minus depreciation 38,000 and 24,000, 62,000. So this becomes 66,000. So here it is same, see, 62,000, 62,000. Then donation, this is permanent difference. Donation is permanent difference. So 1,28,000 minus 62 is 66, plus 15,000 makes it 81,000. 81,000 current tax is 32,400. 81,000 into 40% is 32,400. Is there any deferred taxation? See, this is also 62,000. This is also 62,000. Is there any difference? There is no difference. So since there is no difference in depreciation, no deferred tax. Also, 15,000 of donation is a permanent difference. So on this also no deferred tax. So you'll only have current tax and profit after tax, right? Now you ask me, sir, whether we should explain the provision. You have to see the number of marks. How many marks are there? 5 marks. For 5 marks question, and how many items are there? There are about 6 to 7 items. No scope for giving any explanation, or give a small one line. Give a one line explanation saying that interest paid to NBFC has been paid within the due date of filing return, hence it is allowed. And it is assumed that donation to private trust is not allowed for income tax purpose and is a permanent difference. 2 sentences you can mention, not more than that. Okay. If the same question is for, let us say, 8 marks or something, then you have to write more. Okay. Same question what we had seen earlier. See that they keep on repeating the question. Here they have said you are required to show the impact of the above items on deferred tax asset and deferred tax liability. Now when they have told you for each item show the impact, you have to do a working like this, and this analysis can be brief. You don't need to give a very detailed analysis. What is important? This number is important, and a brief analysis of why it is done. Okay, so let us do this. Depreciation as per books is 70 lakhs. Depreciation for tax purpose was 42 lakhs. There were no additions during the year. So 70 and 42. The difference on account of depreciation is a temporary difference, resulting in lower depreciation for what? Tax purpose. So either it can be a deferred tax asset creation, or it can be a reversal of deferred tax liability created earlier. Expenses disallowed in 1920 and allowed for tax purpose in 2021. So always remember, when expense was disallowed in 1920, it was DTA. Now it is reversal of DTA. Share issue expenses allowed under section 35D of the Income Tax Act for the year 2021, 1/10 of 70 lakhs incurred in 1920. Now if you see, 35D allows for how many years? If you remember, over a period of how many years you should allow the share issue expenses as per section 35D? This is 35D, okay, not 35 bracket D. As per section 35D, it is 5 years. Here they are saying 1/10 is allowed. So 1/10 of 70 lakhs is 7 lakhs. To that extent, it is reversed. The year in which it is disallowed, DTA. Year in which it is allowed, reversal. Then repairs to plant and machinery were made during the year of 140 lakhs and was spread over the period 2021, 21, 22 equally in the books. However, the entire expenditure was allowed for income tax purpose. See, first thing is, this treatment itself is wrong. In the books also, you have to the repair expense has to be expensed in the year in which it is incurred. But still, they are saying 140 was split in 2021 and 21-22. We are dealing with what? 31st March of 20. No, we are dealing with 2021. Okay. So 2021, 21, 22. 70 lakhs as per books, 140 lakhs as per taxation. Taxation has given us higher deduction. Means in future we'll have to pay a higher tax. So it will be resulting in a creation of DTL. Will show this. Okay. Now if you look at this, following information has been provided. Depreciation as per accounting and tax is given. This will again result in tax is higher. So DTL. Right? Straightforward. Unamortized preliminary expenses 40,000. This is disallowed, so this will create a DTA because it will be allowed in the future. Very simple. definition and all, you can do it. So here if you see, actual payment was made before the due date of filing return and allowed for tax purpose. So here they have given a detailed explanation. In the other question they have just given 30th June. So you have to be careful on how do you analyze. Again I am telling you, if nothing has been given, no information has been given on allowance and disallowance in the question, you will assume that it is allowed for income tax purpose. Can an enterprise offset deferred tax assets and deferred tax liability? It can offset deferred tax asset and deferred tax liability if the enterprise has an enforceable right to set off against liabilities representing current tax and the asset and liabilities relate to taxes on income levied by the same governing tax laws. So, as far as offsetting is concerned, deferred tax asset and deferred tax liability, you can offset it provided they are charged by the same taxation authority and the entity has a right to offset the assets against liability. Again, similar question what we have done. Okay. My pencil battery is low. I'll just charge it and we'll resume in a minute. Okay, so this is typically simpler questions are asked. There is no difficulty, very high difficulty level questions are not tested as far as deferred taxation is concerned. So even if you are comfortable with the type of questions we have discussed, you will be able to manage it. Just think of it. Is there a difference? Temporary, permanent? If it is temporary, benefit now or higher tax now, accordingly calculate DTA or DTL. Then we have one more concept of MAT, which is minimum alternate taxes. Right now, minimum alternate taxes it is levied under section 115 JB of the Income Tax Act. What it prescribes is especially when companies claim a lot of deduction, what the provision says, there is something called as taxable profit and there is something called as book profit under section 115 JB. Now the concept is, sometimes what happens, you claim a lot of deduction or there is a lot of brought forward losses which are offsetting, because of which the taxable profit will be lower, but the government does not want to leave taxation. The government says even if your taxable profit is zero or negative, but if there is something called as book profit, how to calculate and all of that is out of the question of the syllabus. Also for your intermediate, you will learn this in final level. But what it says is, say for example, taxable profit is 10,000. After claiming all the deductions available in the chapter under chapter 6A and brought forward losses and all of that, this is 10,000. On this, you are required to pay 30% of tax, which is 3,000. But as per books, when I say as per books, not accounting books, as per book profit of 115 JB, when you calculate using the provisions of income tax, this taxable profit under 115 JB becomes, let us say, 50,000. And on this, 10% tax is applicable. What is 10%? 5,000. So, what the standard says is, the Act says, current tax is 3,000, book profit under 115 JB is 50,000. So, this 5,000 is called minimum alternate tax. This is an alternate tax. Sir, how many regimes to remember? We have to remember under 115 BAC, we have to remember 115 JB, we have to remember this. That is how it is. Okay. So, this is a normal tax, 3,000. Under provisions of 115 JB, you need to pay a minimum alternate tax of 5,000. So, the income tax was, if this is higher, pay this. If minimum alternate tax is higher, pay this. So, higher of current tax or 115 JB is payable. So, how much will we pay? We will pay 5,000 only. We will pay 5,000. But now, sir, we pay 2,000 extra. This 2,000 extra, you can claim as credit in the future. 2,000 extra, you can claim as credit in the future. I am repeating the concept. Taxable profit is 10,000. Tax on that is 3,000. Book profit under 115 JB is 50,000. Tax on that is 5,000. Government says pay higher. The extra amount that you pay, 2,000, this you can claim as credit in the future. This is called asset or MAT credit. So why it is called an asset? Because I can claim this in future, it is called an asset and I can utilize it. Okay. So with this concept, let us have a look at one question. The accountant of Sona Limited provides the following information for the year ended 31st March. Accounting profit 750, book profit 437. Profit as per income tax 90. Now this is as per MAT, means as per 115. Tax rate is 20%, MAT rate is 7.5%. Now you are required to calculate deferred tax asset liability and the amount of tax to be debited to P&L. Right? First, accounting profit is 750. So what you have to do? We have to calculate tax. No need to calculate tax on accounting profit. Calculate tax on book profit. Calculate tax on profit as per income tax. Calculate tax on book profit and profit as per income tax. Profit as per income tax is 90,000 into 20%. 90,000 into okay, I'll work it separately here. 90,000 into 20%, that is 18,000. This is what? This is tax as per normal provision. Okay. Then book profit is 437,500. On this you will apply 7.5%. So as per MAT, tax is 437,500 into 7.5%. That works out to 32,812.5 or 32,813. Which is higher? 1 or 2? MAT is higher. So the government says pay MAT. Government says pay pay MAT. So we'll pay MAT. Amount to be paid is 32,813. That is your amount that you have to pay. Okay. Now I have paid 32,813. I have paid 32,813. This becomes my current tax. This becomes my current tax. Okay. Then out of this 32,813 and 18,000, the difference whatever is there, 32,813 minus 18,000, difference between MAT and normal tax, 32,813 minus 18,000, I get 14,813. This I can take benefit in future. This I can take benefit in future. So 14,813 I will debit to MAT credit and I will credit to P&L 14,813 and 14,813. So this amount will be credited to P&L. Okay. So first we'll calculate the total tax as per normal provision and MAT 18,000 and 32,813. Whichever is higher will be debited to P&L. Then the difference between these two, which is 14,813, that will be credited to the P&L. So why are we crediting to P&L? Because it is not my expense. I will get a refund of this or I can adjust this in the future. So I will credit it to P&L and show it as an asset in the balance sheet. Technically speaking, only the net amount is shown. Okay, but the institute has framed the question in this way, and in fact, in the suggested solution, they have not even given this perspective. But you have to show it as an asset in the balance sheet. Then the next thing is, what is the deferred tax asset and liability? Now here they have given accounting profit of 7,50,000. They have given accounting profit of 7,50,000 and they have given profit as per Income Tax Act to be 90,000. Now this difference of profit, my income tax profits are lower, means I will have a lower tax now but higher tax future. That will create a deferred tax liability. 75 minus 9, so 0 0 0 and one more 0. 75 minus 9 is 64. 6,40,000 is the difference. On this I have to apply 20%. Sorry, 15 minus 9 is 66,000. 20%, 66 into 20% is 132. So 1,32,000 is my deferred tax expense. So two things. One, what is the deferred tax expense? 1,32,000. And what is the current tax amount to be debited? 32,815. And also you will have to credit 14,812 or 14,813 as credit in the books. Is this question clear? The question on math. Please practice this question, because if at all it comes, it is 5 out of 5. 5 out of 5. See, the idea is to master such questions which will give us out of out in the examination. Other questions can be taken care of. Okay. So here also is a similar question, the thing, but again, they have said amount to be debited, it has to be net amount basis. There is a conceptual error in the question itself. Okay. Then there is another concept which has not been tested so often in the examination, but you should be aware of the concept on tax-free enterprise. So we'll look at the concept first, and then we'll come back to the question. Tax holiday or tax-free enterprises. So what happens is, you just no need to break your head what is section 80IA and all of that. Just remember the concept. Okay, here I don't want you to spend extra time in remembering the logic and all of that, because this is slightly advanced level. You can do it subsequently also. Okay, there are some things which we have to understand logically in detail. There are something we just need to remember and go and write in the examination. Objective is right now pass the exams. Okay, now what happens is, there is a concept called tax holiday or tax exempt enterprise. So meaning to say, if I am doing a specific kind of business, the government says for the first 5 years, your profits, everything will be not taxed. Your profits will not be taxed. First 5 years, profit will not be taxed. Now think of it, year 1, 2, 3, 4, 5. Year 1, 2, 3, there is a difference which has arisen between the accounting profit and the tax profit. This difference will reverse in 4, 5, 6, 7, this period. Now in 4 and 5, I don't have to pay any tax. So reversal happening here is irrelevant to me. Whatever reversal will happen subsequently, only that is relevant to me. So if there are timing differences which has arisen during the tax holiday period, in the first 3 years, there is a difference which has arisen. And if it is reversed during the tax holiday period, then the deferred tax should not be recognized to the extent of GTI subject to the deduction during the period. Basically what it means is, if differences arisen in this period and subsequently the difference has reversed in the tax holiday period itself, you will ignore. And if it reverses after the tax holiday period, deferred tax should be recognized to that extent in the year in which the differences originate. So if 1, 2, 3 differences arose, whatever differences gets reversed in 4, 5, ignore. If differences gets reversed in 6, 7, for that you will provide deferred tax impact. Okay. This summary you should keep in mind so that it is clear to you. So let us see this. Goodwill Limited is a full tax-free enterprise for the first 12 years of its existence and is in the 3rd year of operation. 3rd year better. Depreciation timing difference resulting in a DTL in first, 2nd and 3rd year is 200 lakhs, 300 lakhs, 400 lakhs respectively. 1, 2, 3. From 4th year onwards, it is expected that the timing difference would reverse each year by 10 lakhs. So from 4th year onwards till what? 12th year, even after that, reversal will happen at what? 10 per year. 10 will be reversed every year. Assuming tax rate of 35%, find out the DTL at the end of 3rd year and any charge to the P&L account. Now here what you need to understand is differences that arose 200, 300 and 4 year, and we are talking about end of 3rd year. So total differences is 500. Total differences at, sorry, they have asked us end of year 3. This is year 1, this is year 2, this is year 3. So at the end of year 2, it is 500. At the end of year 3, it is 900. Means the total difference which has originated. Originated means 200 plus 300 plus 400. Total differences is 900. The question has asked us, find out the DTL at the end of third year and any charge to the P&L account. Okay, so we'll do for the third year. 900 is the total origination. Now, reversal will happen how? How will the reversal happen? 4, 5, 6, 7, 8, 9, 10, 11, 12. 1, 2, 3, 4, 5, 6, 7, 8, 9 years into 10, that is 90 lakhs will be reversed. 90 lakhs will be reversed during which period? During the tax holiday period. Then, after that, whatever gets reversed after that will be, we will create a DTL for that particular amount. We will create a DTL for that particular amount. Now think of it. The question is, again, find out the DTL at the end of year 3. So how much should be the DTL at the end of year 3? Cumulative timing difference is 900, which will reverse during the tax holiday is 90. Reversing beyond tax holiday is 810. On this 810, if you apply 35%, 283.5 should be the deferred tax, which should be the closing balance. Now, if you see the breakup, we have 200, we have 300, and we have 400. Out of this 200, 90 will get reversed because it is first in first out basis. Out of this, and 10 will get reversed subsequently. Out of this 300, entire 300 will get reversed subsequently, and out of this 400, entire 400 will get reversed subsequently. I am repeating once again. Out of this 200, 90 gets reversed during the tax holiday period and 110, not 10. I'll give a breakup here itself. Out of this 200, 90 gets reversed in the tax holiday period and 110 gets reversed subsequently. Out of this 300, entire 300 gets reversed subsequently. Out of this 400, entire 400 gets reversed subsequently. So 400 plus 300, 700 plus 110, that is what brings us to 810. So at the end of year 1, DTL will be 110 multiplied by 35%. At the end of year 1, it will be 38.5%. Then in year 2, 300 into 35% gets added. 300 into 35% is 105. That gets added in the second year, and 140 gets added in the third year. Balance at the end of the third year is 283.5. Okay, so that is how you have to calculate. Practice this. If it comes, a bonus question. Generally, they will not ask, but who knows? Institute, we never know. Okay, that is there. Again, similar concept here. Then they have added one unique type of question here. I just pull this up in the notability so that I can discuss this. ABC Limited had an investment in venture capital amounting to 10 crores. Venture capital in turn had invested in the below portfolio companies, new startups on behalf of ABC Limited. So investment is 2, 3, 4, 1. Total investment is 10 crores. Okay, 10 crores is invested. It is unfair for the institute to ask this question at inter level, but still, because they are given, we need to discuss. Okay. During 1920, venture capital had sold their investments in Star Limited and realized an amount of 8 crores on sale of the shares of Star Limited, and entire proceeds of 8 crores have been transferred by venture capital to the company. So now, please understand, the company has invested in VC. Company has not directly invested in these companies. If they are directly invested in these companies, we would have calculated gain or loss based on each investment. What we have to see is, we have invested in a venture capital. We have given the amount of venture capital, and which is 10 lakhs, and 8 crores of shares of Star Limited has been sold, and we have received the amount. The account managers has received the following additional information from the venture capital. 8 crores have been deducted from the cost of investment, and carrying amount of investment as at year end is 2 crores. So 10 crores was the total investment. We received 8 crores back. Now our investment is valued at 2 crores in the books. Company had to pay capital gain tax or 20% on the net sale consideration of 4 crores. So what they have done is the company has to pay tax. In the books, it is differently accounted. For tax, 8 crores is the sale proceeds, 4 crores is the cost. The difference on that 4 crores tax has been paid. This is called something called as pass-through transactions. Again, advanced level when it comes to intermediate. Pass-through transaction means the venture capital is not paying tax. The original owner will pay the tax. So I'm not technically directly owning Star Limited. Okay, but tax liability is falling on me. Due to COVID, the remaining startups, that is Oscar, Z, and Sony, are not performing and will soon wind up their operation. VC is monitoring the situation, and if required, they will provide for impairment loss. So, the remaining 3 they are monitoring. You need to suggest accounts manager what should be the correct accounting treatment as per AS 22. Okay, so here see sale consideration 8, cost of investment 4, gain is 4. On this 20% tax has been paid, which is 0.8. Now, this is my current tax liability. This is my current tax liability. Okay. Then there is a timing difference. What is the timing difference? Taxable income is 4. Income tax is saying you pay for your taxable income is 4. But in the accounting, there is no profit. Accounting, we are saying it is nil because we have reduced it from the cost of investment. So, is it allowed or not? See, there is something called as equity method of accounting. Then there is a separate accounting for venture capital. All of that is allowed. Okay. It is more like a return of capital. I gave you 10 crores. You returned 8 crores back to me. Whether you return from this investment or that investment, as far as books of account is concerned, I am not bothered. But tax implication has fallen upon me. It has been passed on to me. So, the timing difference is 4. Timing difference is 4 means what? Accounting income is low, taxable income is high. We have paid higher taxes today. Now, this higher taxes today, whatever we have paid, will we realize this in the future or not? That is the first question. That is the first question we have to understand. The timing difference 4. On this, if you apply the tax rate of 20%, you get a DTA of 0.8. Now, this DTA, whatever I have created, I can show it as DTA in the books if I believe that in future I will get benefit. But they have said that the portfolio companies are not performing well, thus the company may not have sufficient future taxable income, which will reverse the deferred tax asset. Because future I will not get any income. So where is the question of reversal? And if reversal will not happen, we should not recognize DTA and only show current tax liability of 0.8. Okay, practice this. If they pick it up in the examination question, it will be a good help for you. Okay. So with this, we covered all the concepts and important questions of accounting standard 22. I will end it here because we have only around 25 minutes left. I want to complete accounting standard 11 also in a single stretch. I don't want to give a break on that. And then after accounting standard 11 tomorrow, we will start with accounting standard 4 and accounting standard 5. Okay. Any questions or can we end the session? Accounting standard 11, we are talking about foreign exchange. A lot of time what happens is companies which are now here, when I am giving examples, I will give you Indian specific examples so that you can manage that well in the examination as well, right? So let us say there is an Indian company. Assume it is Infosys or TCS, whatever company. Right? Infosys is in the business of technology or software that we call. Infosys has customers in United States. Now these customers they buy services from Infosys. Now when Infosys sells services to the US customers, generally what happens is international trade, when you look at, they are denominated in dollars. Denominated in dollars means Infosys, when they sell products to the United States or the customers of United States, what happens is they will bill in dollar. Let us say $10,000 is the amount. Okay. Now tell me, what is the exchange rate going on right now between USD INR? What is the exchange rate? Are you tracking it? Or even if you are not tracking it, if you can give an estimate. 84, 85. Okay, I think it touched or it is about to touch 85. Anyways, so for our easier calculation, we'll put it at 85, right? Now, when I am invoicing in $10,000, when I'm saying that $10,000 is the invoice value, right? This, when I have to record in my books of account, I have to record in INR. I have to record in INR because Infosys has to present its financial statements in INR, right? So what Infosys has to do is this $10,000, it has to convert to INR and record in its books of account. So assume it is 1st of January of 25. Infosys sold $10,000 worth of services. While passing the journal entry, that is customer account debit and sales account credit, if I have to do, I cannot say $10,000. I have to convert that into INR. Accounting standard 11 gives us a guidance as to what should be that rate when we are recording. Now here assume today's rate is 85. We will record at this rate of 85, $10,000 into 85, 85, 0, 0, 0, 0. So that is 8,50,000. 8,50,000. And sales will also be recorded at 8,50,000. How to calculate GST and all of that? That is handled by goods and service tax. And generally in case of export, in most of the cases, GST is not leviable. Okay, so, and even if it is leviable, it is refunded and all of those things works out. So don't worry about that. Don't mix both concepts. Here it is customer debit to sales 8,50,000, 8,50,000. Right? Now, after the sale has been made, assume that the due date is 6 months. Due date is 6 months. Now, 6 months means was from January till June. The due date is 30th of June of 25. And in between, we have this wonderful date, which is 31st of March of 25. When I say wonderful date, it means one of the most important dates, that we talk about. 31st March of 25. This is my financial year. Okay. Now, I have to receive $10,000. I have to receive $10,000 on 31st March. I don't know what is the value, and on 30th of June, I don't know what is the value as on 1st of January. As I reach to 31st of March of 25, what the standard requires is, if there are any monetary item, you have to record it at closing. Now, what is monetary, what is non-monetary, that we'll understand subsequently. But for now, just understand that if at all there is a monetary item, which is an account receivable, $10,000, the standards require that this $10,000 has to be valued using the closing rate. So, which rate? 31st of March of 25. Assume on this date, the rate was 84. The rate became 84. Now, tell me one thing. When I sold, the rate was 85. On 31st March, the rate became 84. Is it good for me or bad for me? Earlier, it was 85 per dollar. So, if I receive money, I will receive 8,50,000. Now, if the rate has come down to 84, I will receive only 8,40,000. So, this results in a loss. This results in a loss. How much is the loss? 85 minus 84 multiplied by 10,000 is my loss. So, this loss becomes 10,000. So, what the standard says is, this loss of 10,000 on this item you have to recognize. So, when I recognize loss, I will debit P&L or I will debit exchange loss 10,000 to customer 10,000. And in the balance sheet, I will say customer is not at 8,50,000. Now, in the balance sheet, the customer will be shown at 8,40,000. Okay. That is the second thing what happens in case of a foreign currency transaction. Then, on 30th of June, assume the rate became 87. The rate became 87. Now, I am very happy because I thought I would have received at 84. Now, I am receiving at 87, which means there is a gain to me. How much is the gain? Now, here, don't make this mistake. Gain will be current rate 87 minus, sometimes students go back and take 85. You should not do that. You should take the previous rate at which you have valued the customers. What is the previous rate? 84. So 87 minus 84 multiplied by 10,000. How much is my gain? My gain is 3 into 10,000, 30,000. This gain I should recognize on the date of settlement. So the gain, when I recognize, I have to increase the value of my debtor. See, if there is a loss, I have to reduce the value of my debtor. If there is a gain, I have to increase the value of my debtor. So debit customer 30,000, credit gain on foreign exchange 30,000. So customer, what happens? From 8 lakh 40 plus 30, it becomes 8 lakh 70,000. And when I receive $10,000 at 87, it will be debit bank $10,000 multiplied by 87, which is 8 lakh 70,000. Credit customer 8 lakh 70,000. Okay, this is the one of the fundamental transaction adjustments that is required by accounting standard 11. This concept has been tested time and again for 2 to 5 marks in the examination, and our objective is we should score out of out here. We should score out of out here. Now, in this flow of example, what happened? First, Infosys sold $10,000 worth of services to a US based customer. Now, this dollar transaction is called a foreign currency transaction. It is called foreign currency transaction because it is not happening in my currency. It is happening in some other currency. So, this is a foreign currency transaction. Foreign currency transaction initially has to be measured using the rate which existed on the date of transaction. Now, if that rate is not available, or if the rate is pretty volatile, or if an average rate indicates that the average rate represents the rate on different dates of transaction, you can use an average rate as well. Okay, this rate will be given to you in the question. This rate will be given to you in the question. So initially, you have to measure using a foreign currency, the exchange rate on the date of transaction. Then two important things: at every financial year end, you have to remeasure all the monetary items. What is monetary, what is non-monetary? I'll explain to you. We already had the discussion once earlier. And on the date of settlement, if you receive more, it is gain. If you receive less, it is loss. So, for you to remember, there are two scenarios: imports, exports. If rate increases for imports, it is always a loss, and for exports it is a gain. So if rate increases, when I say rate increases, USD INR exchange rate from $1 is equal to 85. If it increases to, let us say, 87, then there is a loss for imports, there is a gain for exports. That is why when the currency depreciates, when INR moves from 1 to 85 to, let us say, 1 to 87, this is called depreciation of INR. Sir, but the value is increasing. No, value is not increasing. Value of dollar is increasing. Earlier, $1 was 85. Now, $1 is 87. There is increase in the value of dollar. Dollar is appreciating. Our currency is depreciating. If at all there is depreciation, there is a loss for importers and gain for exporters. So that is why you will see all these export companies, Infosys, TCS, all the service-based companies who have lot of exports, they are happy when the currency depreciates. All the importers, we import oil, we import other items, they are sad when the currency appreciates, right? That is the first thing. And if the rate reduces, importers will record a gain and exporters will record a loss. So in the exam, if there is an import transaction, and if there is an appreciation, if there is an increase in the rate, loss. If there is a decrease in the rate, gain. That is how you have to immediately decide when you see a question. Okay. Then there are monetary items. There are non-monetary items. What are monetary items? Monetary items are those items which are determined in terms of money. For example, account receivable, account payable, loan, bank balance. All of these cases, my amount in money is fixed. Account receivable, I know exactly how much money the account receivable has to give me. Account payable, I know exactly how much I have to pay to the creditor. Of course, there may be bad dates, there may be discount allowed, there may be discount received, all of that is there, but the amount is determined. These are called monetary items. Non-monetary items, amount is not determined. Means, of course, we value them in the balance sheet, but how much amount will be received or recover from those assets, it is not determined. For example, fixed asset. I may say fixed asset is valued at 1 lakh, but how much amount will I get from the fixed asset? Is that fixed? That is not fixed. Is that, can I determine for sure? I cannot. So, financial assets, investments in shares, right? There also I am not sure of what is the amount that is received. Anything other than monetary gets classified under non-monetary. Okay. Now tell me, inventory. Should I classify inventory as monetary or non-monetary? Inventory, is it a monetary item or a non-monetary item? Yes, please. You can type out. I think my if you're speaking, my speaker is on mute because sometimes there is an external disturbance. Non-monetary. Others? Okay. Though we use inventory, we value it at NRV. The amount that we will recover from this inventory is not fixed. So, this inventory becomes a non-monetary item. The moment you sell the inventory and it becomes an account receivable, that becomes a monetary item. Okay. Now, the principle, the golden principle that you have to remember is that all monetary items have to be restated on the balance sheet date at the closing exchange rate. Okay. So, there will be exchange rate for date of transaction. Then there will be exchange rate for year end, and there will be exchange rate for settlement date. Initially, you will record using this transaction rate. Then you will compare year end to this, and you will record a gain or loss. Again, year end rate and settlement rate you will consider and check whether there is a gain or loss. Any questions so far? Any questions so far? Okay, no questions? Great. So now with this understanding, let us jump into the important points that we need to remember from Accounting Standard 11. Accounting Standard 11 is applicable for accounting for transactions in foreign currency. So what are these transactions in foreign currency? You sell goods in foreign currency, you sell services in foreign currency, you buy goods in foreign currency, you take loan on foreign currency. All of these are foreign currency transactions. Okay, then it is applicable to translate financial statement of foreign operations. Basically, if you have, let us say, foreign branches or foreign subsidiaries, this aspect of the standard we will do when we cover accounting for branches comprehensively. Okay, so we'll just understand the concept here. Practice will happen when we do branches. And accounting for foreign currency transaction in the nature of forward exchange contract. This, though not frequently tested, two simple concepts you need to remember for the examination. Okay. Now, monetary items are money held and assets and liabilities to be received or paid in fixed or determinable amounts of money. This we already understood. Non-monetary items, other than monetary items, fixed assets, inventories, investments in equity share can be tested as an MCQ. Okay. Then, foreign currency is a currency other than the reporting currency of an enterprise. Now, if a company is registered in India, we have to report our financial statements in INR. So, INR becomes our currency. The currency other than INR becomes a foreign currency. Okay. Then, exchange differences. Now, what is this exchange difference? We saw an example where we initially recorded at 85, subsequently we valued it at 84. This difference of 1 is called exchange difference. Difference is resulting from reporting the same number of units of a foreign currency in the reporting currency at a different exchange rate. Basically meaning same number of units of foreign currency, $10,000. We reported at a different exchange rate and whatever amount results is that results in exchange differences, right? Then we have a foreign operation. See, if I have branches and all in India, subsidiaries in India, that is my domestic operation. If I have a subsidiary, associate, joint venture or branch of the reporting enterprise, the activities of which are based or conducted in a country other than the country of the reporting enterprise. So if my country is India, anything outside of India, if I have a branch, if I have a subsidiary, if I have a joint venture, if I have an associate, that is called a foreign operation. Foreign operation is divided or classified as integral and non-integral. We'll understand that subsequently. Foreign exchange contract also we'll understand subsequently. What is a foreign currency transaction? Transaction which is denominated or requires settlement in a foreign currency. Denominated means, for example, my invoicing is in dollar, so that becomes a foreign currency transaction. But there may be cases where I say my invoice is in rupee. My invoice is in rupee, but the settlement will happen in dollars. Even if the settlement means I'll receive money in dollars, I'll make an invoice in rupee, but I'll receive money in dollars. That is also a foreign currency transaction. So the transactions of buying and selling goods where price is denominated in a foreign currency, borrowing or lending, becoming a party to an unperformed foreign exchange contract. If I enter into a forward contract or foreign exchange contract, that also is a foreign currency transaction. Or acquiring or disposing of assets, incurring or settling liability denominated in foreign currency. I purchase assets, I take loan, right? All of that is foreign currency transaction. Now, initial recognition we have already understood. It should be recorded on initial recognition by applying the foreign currency amount, the exchange rate between the reporting currency and the foreign currency at the date of transaction. So basically you have to take exchange rate at date of transaction. Exchange rate at the date of transaction. Okay. Now, at each balance sheet date, if there is a foreign currency item, if it is a monetary item, you have to use the closing rate. So monetary item like account receivable, loan taken, loan given, all of that you have to report using the closing exchange rate. Very important, right? Then, if it is a non-monetary item, for example, fixed asset. If it is a non-monetary item, for example, fixed asset, then if you are using historical cost denominated in foreign currency, you will report using the exchange rate at the date of transaction. What does that mean? Might find it complicated, but let us say I imported a car. I have imported a car. This car was imported on 1st of January of 22. And I am carrying it, or I am using the cost model. I am using the cost model or historical cost model. Then whatever was the exchange rate on this date, I should value the gross block of the car at this rate only. So for example, at that point of time, if it was 60, just for example, then, and my car cost is $1 lakh, so I should value the car at 60 lakhs. I should not subsequently restate if I am using the historical cost model or cost model. Whereas, if I am using the fair value model, that is, let us say if I am using the revaluation model, then I will report using the rate when the fair value was determined. What does that mean? For example, I am using the revaluation model for my car. Okay. Now, if I am using the revaluation model, I have to calculate the fair value. Let us say fair value on 31st of March of 24 for this particular car was $90,000 fair value. Then, if I have to convert that to INR, I cannot take 60. I have to take rate on 31st of March. So 90,000 into, let us say, 70. That is the value at which I will recognize the car if I am using the fair value model. And if there is any contingent liability denominated in foreign currency, I will use the closing rate. So to summarize, there are three categories only. Closing rate for all monetary items, closing rate for contingent liability. Closing rate for all monetary items, closing rate for contingent liability. Then, if I am using cost model, I will use the transaction date value. If I am using revaluation model, then I will use the rate on which the fair revaluation or the fair value was determined. Now, one more example of this non-monetary item. Let us say I have inventory. And inventory is valued at, let us say, net realizable value because it is lower than cost. So when I'm determining NRV, I should use the exchange rate on the date I have determined the NRV. Okay, is that part clear? On non-monetary item, I have to take the rate on which I have determined the NRV and also the value on value when I have determined the NRV. Is that clear? Okay. Right. Now, what do we do with the exchange differences? And exchange differences results when there is a change in the exchange rate between the transaction date and date of settlement of the item. This we have already understood, right? Now, all exchange differences other than the exceptions that we talked about, okay, we'll talk about the differences. Generally, the rule is you will take it to P&L. Generally, the rule is that you will take it to P&L. But yes, if there is something called as non-integral foreign operation, or if there is a long-term monetary item where the government has allowed capitalization, in that case it is different. But generally, you will take it to P&L. Exchange differences on settlement of monetary items of an enterprise at which they were initially recorded during the period, and monetary items reported in previous financial statement. Basically, what it means is all the monetary items. All the monetary items you should recognize as income or expense in the period in which they arise. You should recognize in the period in which they arise. So, account receivable, account payable, loans, whenever there is an exchange difference on these items, you will recognize that in the P&L. You recognize that in the P&L. Both gain as well as losses. Okay. Now, if rate of transaction is 1st of January of 25, 31st March of 25 is the financial year end, and 30th of June of 25 is the settlement date, then what you have to do is from this date to this date, this is called unrealized gain or loss. This will also go to P&L. From this date to this date, whatever you get, this is the realized portion, and this unrealized also get realized subsequently, but this is already recorded. So realized portion here will go to P&L. So the thing to remember is if the transaction is settled in the same period, entire gain or loss will be taken to P&L. If the transaction is settled in the subsequent period, then you will only take the gain or loss between this period. Means from the year end till the date of settlement. Okay. So that is one thing you have to keep in mind. Now, there are some exceptions to the monetary items discussions that we had. And what about non-monetary items? See, non-monetary items, if I am purchasing, for example, fixed asset. If I am purchasing a fixed asset, okay, I am not required to remeasure it. I am not required to remeasure it. So please understand. If I am purchasing a fixed asset, I paid $10,000 or I didn't pay. I took a loan. Okay. I spent $10,000 to buy this fixed asset and I have taken a loan of $10,000. This loan of $10,000 is a monetary item. This has to be remeasured. This fixed asset of $10,000 is not a monetary item. This will not be remeasured. So if this is not remeasured, there is no question of getting a gain or loss on this particular item. That is one thing you have to keep in mind. Second thing is, even if you are doing fair valuation, you are doing the revaluation part as per accounting standard 10 and not as per accounting standard 11. So that will be a revaluation gain or loss. Right? Now, earlier what used to happen is, when I took foreign currency loan, and the standard what I said, you have to remeasure the monetary item and the gain or loss will be recognized in P&L. Any loan you take, I have taken a foreign currency loan, the gain or loss on that foreign currency loan should be recognized in the P&L. Very simple, straightforward. Okay, there was no dispute. But what happened is during 2008, okay, just around that time, there was a crisis and INR depreciated significantly, and also INR was volatile. So I have taken $10,000 at, let us say, 30. Suddenly the rate became 35. Then again the rate became 32, or suddenly the rate became 40. There was a huge depreciation of INR against the dollar. And I'm not talking about $1,000 or $10,000. If companies like Reliance, or if companies like Tata's and L&T, if they import a lot of items, then, or if they have a lot of foreign currency borrowings, their PNL was significantly getting impacted because of exchange rate volatility. Okay, that is the background. So what the government came up and said, the government introduced one paragraph called 46A subsequently, and said that if there is a long-term monetary item, if there is a long-term monetary item, what is the meaning of long-term monetary item? Maybe I have a loan taken. I have a loan taken. It is a long-term loan. It is a long-term loan. If there is a long-term monetary item which has been incurred to acquire fixed assets, which has been incurred to acquire fixed assets, what the government says is, for this long-term monetary item, whatever is the exchange loss or gain, or whatever is the exchange difference, default choice was to take it to P&L. If you want, you take it to P&L. But if you don't want to take it to P&L, what they said is, this exchange gain or loss, you can adjust, you can add or reduce from the cost of fixed asset. So what it indirectly meant is, let us say I spent $10,000 to buy a fixed asset. I spent $10,000 to buy a fixed asset. Okay. Then, of this $10,000, I took a loan, long-term loan of $10,000. For example, when I took the loan, the rate was 35. Now the rate is 40. This is the closing rate. The closing rate is 40. Now this difference of 35 to 45 into 10,000, the loss is how much? 50,000. The default choice, or the earlier accounting standard applicable, or even now Ind AS when it is applicable, this 50,000 of loss, you have to take it to P&L. This is the default thing. But because of this paragraph 46A, entities have a choice that instead of taking this loss to P&L, you can add it to the cost of fixed asset. Now, what do I mean by that? See, $10,000 was spent to buy a fixed asset. So fixed asset will be $10,000 into 35. That is 3,50,000. Right? Now this loss, first choice is debit P&L, credit loan 50,000 and 50,000. Basically, transfer the loss to the P&L. When I say debit P&L, exchange loss. 46A gives us an option that if you want, don't take this to P&L. Instead of debiting it to P&L, use that amount to add to the cost of fixed asset. So basically, in conclusion, any exchange loss which is incurred on a long-term monetary item which is related to a fixed asset, I'll come to depreciable and non-depreciable separately. If it is related to a fixed asset, just remember this, then the cost or the loss or gain, it is a choice, okay, all the exchange differences should be added or reduced from the fixed asset. So the loss, instead of taking to P&L, you have a choice to either add it to the cost or reduce from the cost. So why will you reduce from the cost? If there is a gain, you will reduce. So basically, loss you have to add, gain you have to reduce. From what? From fixed asset. This is as per the choice given by paragraph 46A of accounting standard. Remember this paragraph. But if this question comes, write 46A and come. Okay, that will actually make a very good impact on the examiner. So if there is a long-term monetary foreign currency item if it is related to a depreciable asset. I gave you an example of fixed asset, but now it is, if it is related to a depreciable asset, then the exchange difference arising on reporting of long-term monetary items, if they are related to acquisition of a depreciable asset, can be added or deducted from the cost of the asset, and subsequently depreciation will be calculated considering the revised cost. So can we take it to P&L? Yes, that P&L option is always there, but if the entity wants, and it is not revocable. Once you have decided that you will take it to P&L, next year you can't come. Once you have decided that you will take it to fixed asset, next year you cannot come and say, no, this year will not take it to fixed asset, we'll take it to P&L. Losses will add to fixed asset, gain will transfer to P&L. That is not allowed. That is not allowed. So you can either take it to P&L, or you can add it to or deduct from the cost of asset. That is if it is a depreciable asset. If it is a non-depreciable asset, or if it is related to some working capital and all of that, but such technicalities are not tested. If it is in other cases, then you will create something called as foreign currency monetary item translation difference account, FCMITDA, foreign currency monetary item translation difference, foreign currency monetary item translation difference account. So you can accumulate in FCMITDA account and amortize over the balance period of the long-term liability or asset by recognizing in the income and expense. So basically what it means, for example, if it is land, okay, I have taken a foreign currency loan to buy a land, and the loan is 5 years. There is an exchange difference. There is an exchange difference. I don't want to take it to P&L. What can I do? Because land is non-depreciable, this exchange difference has to be accumulated in foreign currency monetary item translation difference account. Then over a period of 5 years, I have to amortize it and take it to P&L, every year. So what is the advantage of this? The advantage is the earnings are smoothened, especially when the currency appreciation and depreciation is very, highly volatile. Then in that case, it will help us to have even earnings. So instead of recognizing, let us say 10 crores of loss in the first year itself, you will split that over, let us say 5 years, 2 crores, 2 crores, 2 crores, 2 crores, 2 crores. So the losses get evenly smoothened out. Okay. Now this was given as an option, and they thought initially they will wind it up by March of 2020, but this has kind of become a permanent option itself, right? 46A for long-term foreign currency monetary item. Okay, this is the table. Compulsorily you have to remember. Yes, realized P&L is from initial recognition till date of settlement, but because you have already recorded unrealized P&L as on 31st of March, only from the period of 31st March to the date of settlement, you will record in the subsequent. Okay, any questions here? Before we move to the actual questions, any questions? Okay. Now, we'll take a few questions before we move ahead to the remaining part of the chapter. BK Limited purchased a fixed asset costing rupees 5,000 lakhs on 1st of April of 2012, payable in foreign currency USD on 5th of April. Sorry, very careful with the dates. Okay, now what is the date? Here they have said 1st of April is when they are purchased. Settlement is the 5th of April, means after 1 year. Exchange rate of $1 is rupees 50 and 54.98 is on 1st of April and 31st March. So 1st of April of 12, the rate is 50. 31st of March of 13, the rate is 54.98. Now what have we done? We have purchased, we have imported. Rate has increased. If the rate has increased, means there is a loss to us. Okay, this should over a period of time come automatically to you, as with you keep on practicing, not only for exams but also for real life. If I imported, rate has gone up, loss for me. So it should trigger automatically. Okay, then the company also obtained a loan of $100,000 on 1st of April 12, payable in 3 equal annual installments. First installment was due on 1st of May. We are required to state how these transactions are to be accounted for in the books of accounts for the year ended 31st March of 13. Right. Now, first date of acquisition 1st of April. Cost of acquisition 5,000 lakhs. Now they have given in INR, but it has to be paid in dollar. So what is the value? Value is 5,000 lakhs divided by 50. 100 lakhs. Okay. Then we have also taken a loan. Now Here you may argue, sir, they did not tell us that this loan is for the loan or not for the loan. Okay, so now we have to make some assumptions and solve the question. If this loan is taken on 1st of April and payable in 3 equal annual installments, means what? And interest has not been given. So let us keep interest aside. 100,000 is taken on 1/4/12. So 100,000 is taken on 1st of April, payable in 3 equal annual installments. The first installment will be due when? First installment will be due on 31st of March of 13. That is the first thing. And here also, this 5,000 that has been incurred on this is payable in foreign currency on 5th of April. So here also there is a restatement required, right? And will we restate the fixed asset? We will not restate the fixed asset. So fixed asset which is recorded at 5,000 lakhs will continue to remain at 5,000 lakhs unless there is a loan which is taken for the purpose of acquisition. Okay. Creditor dollar value is 100 lakhs and we have purchased on 1st April, we have to restate on 31st of March, so there is a loss. What is the loss? Loss is 54.98 minus 54.98, that is the loss. So the creditor payable consequent to reinstatement is 4.98 into 100 lakhs, 498 lakhs. Okay, now this is a long-term monetary item. This is a long-term monetary item. Sir, how do you say it is long-term? More than 1 year. Now, this exchange loss of 498 lakhs, I can debit it to P&L. That is the first treatment. Or I can take the forex fluctuation and capitalize this loss to the cost of fixed asset. Why? Because paragraph 46A gives me an option that if I have incurred a long-term monetary item and there is an exchange difference on that, it is relation to acquisition of a fixed asset. So the loss can be added to the fixed asset cost. Okay. So in that case, 498 will be added to the fixed asset cost. Clear? Any confusion here? Okay. Then what about this $100,000? They have said there is a loan of $100,000. Now what happens is, out of $100,000, we have 33,333.33 repaid and 66,666.67, this is outstanding. When we repay, we repaid it at 54.98 and this outstanding also has to be remeasured at 54.98. Can I say entire 1 lakh should be remeasured at 54.98? When we took, it was at 50. Now it is at 54.98. So the loss is 4.98 into 1 lakh. So in the second case, the $1 lakh of loan into 4.98, 4.98 is the loss. Now, how do I treat this loss? Again, they have not said whether they have used it to buy the asset or something else. So again, you can give both the option. You can charge it off to P&L, or if there is a depreciable asset, you can add it to the fixed asset account. So first option, 4.98 lakhs has to be debited to P&L. 4.98 lakhs has to be debited to P&L. That is the default option. Sir, we can make assumption that it is in respect of acquisition of a depreciable asset. Then we can add it to the cost of asset. If it is not in relation to depreciable asset, the other option that is available is to debit it or transfer it to foreign currency monetary item translation difference account, FCMI TDA account, and amortize it over the life of 3 years, 3 years of the loan period, right? So this is one question which revises whatever we have done. I'll do one more question that is from compiler. Very nice question, and the thing there is, if at all such kind of question comes in the examination, you should be able to do it. See, it has been asked for 5 marks, slightly long question as far as 5 marks is concerned. And one suggestion is, if you feel that there are too many numbers and it can be confusing to you at times, then you can park it off for subsequent handling. Means you can do it subsequently. Okay, no need to break your head and lose time. You can do it subsequently, but even if you attempt it, 70-80% correct, you will get good marks. Okay. Explain briefly the accounting treatment needed in the following cases as per AS11 as on 31st of March of 20. Debtors include amount due from Mr. S, rupees 9 lakhs, recorded at the prevailing exchange rate on the date of sales, transaction recorded at US dollar 172. US dollar 1 is 73.5 on 31st March and US dollar 1 is rupees 72.5 on 1st of April. Okay. Now, here they have not told what is the date of sale. Okay, what they have assumed? Initial recognition only they have assumed. Okay. So we'll assume that this transaction is during the period, because if it is from the previous period, 72.5 becomes relevant, but here it is at 72. So we recorded it at 72. On the closing date, the rate becomes 73.5. So 72 to 73.5 rate has increased. When you have sold, when you have exported, if the rate has increased, it is beneficial to us. Now, when I say rate has increased, I am talking about dollar rate. Dollar rate has increased from 72 to 73.5. So there is a gain. How much is the gain? Gain of 1.5. Now, how to account for it? See, they have given us in lakhs. First, we have to convert this to dollars and then see what is the gain. So, dollar value of sale is equal to 9 lakhs divided by, on the date of transaction, it is 72. So, 9 lakhs, if I do 9 8 is 72, 1 lakh. So, 8 8 is 64, 8 9 is 8 12 is 96. So 12, 1, 2 and 40 is 12,500. Yeah, 12,500. Okay, you use your calculator, no need to do manually. I make sometimes mistakes also, but I like to do it manually. So 12,500 is what? Dollar value. It has increased from 72 to 73.5. So the gain is 1.5 multiplied by 12,500, that is equal to 18,750. Very simple. 1 mark or 1.5 mark, you will directly get it here. There is no confusion. Now, second part of the question is slightly not very complicated, but if you approach it step by step, you will be able to do it. Long-term loan was taken on 1st April from a US company amounting to 75 lakhs. 5 lakhs was repaid on 31st of December 2019, recorded at US dollar 70.5. Interest has been paid as and when debited by the US company, and they have not told the interest component. If they tell interest, it gets covered under AS16, other complications arise. But at CA intermediate level, you don't expect to get so much of complication. 73.5 on 31st of March and 72.5 on 1st of April. Now, they have taken loan of how much? 75 lakhs. First thing is to calculate dollar value of the loan. What is the dollar value of the loan? 75 lakhs is the value, INR value, and the exchange rate is 72.5. Why? Because we have taken the loan on 1st of April. So, we should know that the value on the date of recognition is 75 lakhs divided by 72.5. So, if I do 75 lakhs divided by 72.5, I get 1,03,448. I get how much? 1,03,448.28. This is the dollar value of loan taken. This is the dollar value of loan taken. Now, what has happened is, we have repaid 5 lakhs. They should have actually given in dollars, but yes, we have repaid 5 lakhs at 70.5. So, please hear this out clearly. 5 lakhs has been repaid at 70.5, which means $7,092.2 has been repaid. So, out of this total loan of 1,03,448.28, we have repaid 700,092.2. So, how much is left? 96,356 is outstanding. 96,356 is outstanding. I am repeating once again. First, 75 lakhs of loan is taken at 72.5. So, the dollar value becomes 1,03,448. Out of this loan, we have repaid 5 lakhs at 70.5. So, we have repaid 7,092. So, the balance loan is 96,356. This has to be restated. And on the 7092, we have to see whether there is an exchange gain or loss. Now, at what rate did we borrow? We borrowed at 72.5. At what rate did we repay? 70.5. So here there is a gain. And what is the closing rate? Closing rate is 73.5. So on this amount there is a loss. Two components. One, 7092 we repaid at 70.5. There is a gain, and on the outstanding balance amount there is a loss. Okay, so 96,356.08 multiplied by 73.5 minus, we have taken it at what value? We have taken it at 72.5. Right? So this becomes 96356.08 multiplied by 1. Sorry, 72, not 72.5. It is taken at 72. So this multiplied by 1.5. Did I miss out something? The loan was again. Loan was taken at 72.5 and the closing rate is 73.5, not 72. I don't know why did I take 72. I got confused because of this. So it is 72.5 only. So 96,356, which is the balance amount of loan, you have 96,356. That is the loan value. Okay, the loss. Then there is a gain. Why it is 92? Just give me a moment. It cannot be. Okay, so exchange difference loss net of adjustment of exchange gain on repayment has been calculated. Alternative considering otherwise also is possible. So what they have done is they have considered this 5 lakhs whatever has been repaid. So this is not an appropriate adjustment. 70.5. Why 70.5? That is for this gain transaction. This I am talking about loss. Okay, then as far as gain is concerned, we have repaid how many dollars? $7,092.2 multiplied by 72.5 minus 70.5. So the gain is 7,092.5 multiplied by 2. So the gain comes to 14,185 on the date of settlement. That is the first thing, right? Second thing is, here this is incorrectly done. This is as per the suggested answer, but this is incorrect because this 5 lakhs of repayment includes gain. This 5 lakhs of repayment includes gain. We have to exclude that gain and do the accounting. So loss is 96,356.08, that is 96,356. Gain is 14,185. So net loss is equal to 96,356 minus 14,185. So 96,356 356 minus 14,185. If we do, it is 94,830. Sorry, 82,071. This is the net loss. Now the problem in this answer given as the suggested answer is I cannot reduce the entire 5 lakh from my outstanding because 5 lakhs includes 5 lakhs include gain component. 5 lakhs includes gain component. So you have to don't do it that way, but do it this way, that this is outstanding multiplied by 1 and the gain that was recognized earlier 14,184. So basically they are doing double counting. This 5 lakhs include 14,184. So you cannot include that gain. You have to use the amount without the gain. So the net loss is 82,071. I think I have to report this question too. They are given a note also anyways. Exchange different loss net of adjustment has been calculated in the above solution. Okay, so that is what they have done, which is incorrect. Now, what is the treatment? Treatment is either debit to P&L or transfer to foreign currency monetary item translation difference account. Okay, then number 23, 5 marks. Such a simple question if you see. 5 out of 5 is possible. Okay. Karna Limited, an Indian company, has the following foreign currency transactions during the financial year 22-23. On 1st of July, imported goods from Tri Limited, a German-based company, amounting to rupees 30,96,000. Amounting to rupees 30,96,000. So, on 1st of July, import has happened, amounting to 30,96,000. On 1st of October, imported plant and machinery from another company, German-based company, for euro 18,500. The amount was paid on the date of import. So, immediately they are paid. Then, on 1st of December of 22, exported goods on credit to Cream Limited, a German-based company, amounting to rupees 50,40,000. All the transactions were recorded in the books of account at the prevailing exchange rate on the date of transaction. Ignore taxes and duty. Payment due from Cream Limited and payment due to Tri Limited is outstanding, means both these amounts are outstanding. Rate of exchange is on 1st of July, 1 euro is 86, 1st of October 88, 1st of December 84, 31st of March 90. To show the value at which the above items will appear in the balance sheet as on 31st of March, to calculate the amount of gain or loss in each of transaction on account of exchange difference. Now, 1st of July 22, rate is 86. How much is sold? 30,96,000 is sold. How many euros? Divide by 86. So you will get the euro value. That is 30,96,000 divided by 86. 36,000. Then on 31st March, rate is 90. So on 31st of March, you will show 36,000 into 90. 36,000 into 90. So the first case, 36,000 in euro into 90, 32,40,000. Okay, that is the first thing. Then what will happen to gain? There is a, what is this? This is imported. So there is a loss. So loss will be debited to P&L. Okay, then second, on 1st of October, imported plant and machinery for 18,500 amount was paid on the date of import. 1st of October 18,500. 1st of October 18,500 into 88. So the plant and machinery will be shown at 18,500 into 88, 16,82,000. Now, will we restate this? See, this is a non-monetary item. Non-monetary item is not restated. Non-monetary item is not restated. It will be shown at the same value itself. Of course, subject to depreciation, they are not given us information. Then, or on 1st of December, exported goods at 50-40. 1st of December, rate is 84. So, what is the value? 50-40 divided by 84, 60,000, multiplied by 90, 54 lakhs. So, this 54 lakhs will be, the closing balance, and in the import, there is a loss which will be reported. On the export, there is a gain, that is 54 lakhs minus 50 lakhs 40,000. There is a gain of 3 lakhs 60,000. So this 3 lakhs 60,000 will be shown as gain. Okay. Simple question. There are 3 bits to it. So most likely the segregation would be 2 marks, 1 mark, 2 marks in this particular question. ABC borrowed $5 lakh on 1st of July of 17, which was repaid on 31st of July of 17. ABC Limited prepares financial statement ending 31st of March of 17, not 1st of July. This is 1st of January. Rate of exchange is 68.5, 69 and 70. You are required to pass journal entries in the books of ABC. Now, here, should we assume it is for a fixed asset or should we assume it is for a normal case? Enough information is not given, so you can assume you can directly take it to P&L. When you take the loan, bank account debit 5 lakhs into the exchange rate to loan account. On 31st March, INR value has, the USD rate has increased, means there is a loss to us. Loss of how much? $5 lakh into 1. So 5 lakh is the loss. Foreign exchange difference account to foreign loan account. Then this will be transferred to P&L. P&L debit to foreign exchange difference. Then on settlement, it is 70. So what you will do, you will compare 69.5 and 70. Here is the difference of 0.5. This 0.5 into 5 lakhs is the loss and amount paid through bank is 5 lakhs into the closing rate of 70. And the loan account balance is 347.50. Okay. Now this type of questions, if they come again, no, you should be able to score good marks here. This we have done similar question already again for 5 marks it was tested. Branches will do subsequently in the branches chapter, not now, so that you have clarity. Okay, any questions? Now, this part again is covered also along with branch accounting. Foreign operations classified as integral and non-integral. Now the thing is, sometimes the question does not give us clear indication, so we can assume based on the information given, we can assume whether it is integral or non-integral, right? Now what is integral? Integral means, think of something like a body, okay, human body. This hand is integral to my body, means it is just an extension of my body, right? So when we say integral, it is something which is fully dependent on the head office. So if there is a lot of dependency, sir, how do we get to know whether it is dependency or not? They purchase goods from head office only. Okay, they get continuous, they get inflows from head office, they get money from head office, sales are remitted back to head office immediately. If that is the nature of transaction, then it is called integral operation. Whereas if it is a non-integral operation, the entity will purchase, the branch, the subsidiary, they will purchase goods from outside. That is not integral. Okay, so for something to be a non-integral foreign operation, then the foreign operation should have significant degree of independence, means they are working independently, they are not dependent. Now if I have to give, if I have to extend the example, till the time you are studying, till the time you become earning on your own, you are dependent on your parents. But after you start earning, you start becoming independent. That is how you can understand. Then the transactions with reporting entity are not large in number. So between the head office and the branch office, there are not frequent transactions. There are only limited transactions that you can see. Cost of material, labor and other expenses are paid or settled in its local currency. So the non-integral foreign operation will carry out lot of transactions in its local currency only, not in the head office currency. Sales are mainly not in reporting currency. Whose reporting currency? Reporting currency of head office. So they are handling sales independently. They are collecting amounts in foreign currency. They are keeping the amounts with them only. They are remitting only partially. Sale price are determined based on the local competition. So if it is an integral foreign operation, sales price and all are determined by head office. Whereas if it is non-integral, they will take their local conditions, they will take their local surroundings, how the things happen in the environment, business environment, and accordingly they decide the price. Activities are funded either from profit from its own operation or from local borrowings. Sometimes they may take money from head office. It is not that they should not take, but largely it is self-contained. Largely it is within the local economy. So if you have to understand, if there is a US based company, let us say there is Domino's, for example. Domino's has Indian. I'll not call it branches, I'll call it outlet. There is a company which runs it, or it gives out franchise, right? Now, a lot of things other than the brand, a lot of the money, lot of money that comes, a lot of sales that happens, the taste, the preferences, that everything happens locally. Then this we can say is a non-integral foreign operation. Same way Amazon India, Amazon US. Okay. Now Amazon India works as per the local conditions in India. So again, that is a non-integral foreign operation, right? Now, when it comes to translation of integral foreign operation and non-integral, we'll just give a quick reading. In detail, we'll understand in the branch accounting chapter. Now, what is the meaning of translation? What happens is the foreign operations, the branch, the subsidiary, it has to be incorporated in the head office. So if I have a branch, the branch information has to be incorporated in my books for preparation of financial statements, right? Now, if there is a foreign operation, the foreign operation will prepare its trial balance in, let us say, dollar. Now, the dollar amount, I cannot directly add it to my Indian trial balance. So, what should I do? I should convert. Or this is also called translation. The difference between conversion and translation is, the difference between transaction and translation is, in transaction, I am entering into a transaction. In translation, I am taking just a trial balance and I am converting that into my INR value. Okay. Translation for integral. Integral means it is fully dependent. It is an extension of my own office. Everything is as if I am only doing. So in that case, individual items in financial statement are translated as if all the transactions had been entered into by reporting enterprise. So if it is an integral foreign operation, I am assuming that I am entering into the transaction. And accordingly I will translate. So when I do the translation, what I will do? I will take the exchange rate on the date of transaction, or I may take an average rate as well. Okay. Then for fixed asset, exchange rate on the date of purchase. For inventories, date on which the cost was incurred. If there is a recoverable amount of an asset, if you have to determine, for example, if you are talking about impairment and all, or if you are calculating NRV and all, rate on which the amount was determined, right? So very simple, translation of individual financial statement items as if I am entering into the transaction. So all whatever the sales I do using that rate, purchases I do using that rate, all of that will be as if I myself am doing the transaction. Then if it is a non-integral foreign operation, then it is slightly different. Here you have to remember a lot. So the balance sheet items, closing rate, asset and liabilities. Okay, equity of course remains as it is. Income and expenses, rate on the date of transaction. You can use an average rate also. Exchange differences is accumulated in something called as foreign currency translation reserve account. If there is any goodwill, closing reserve, again this is a balance sheet item. If there is any contingent liability, closing rate. So basically what you have to remember, balance sheet items, asset and liability, closing rate, and income and expenses item, rate on the date of transaction or the average rate. Okay. This classification, reclassification, all of that we'll do when we do the branch accounting. Right. Now, very important part of forward exchange contract. Now, what is this forward exchange contract? Let us have a quick understanding. Say for example, we teach CFA. When we teach CFA, we buy some subscriptions from Kaplan. We provide this to our students. To Kaplan, we have to make payments in US. So let us say today you purchased a course, and say for example, I have to pay $1,000 to Kaplan. You made the purchase today, 1st of January of 25, for example, and I have to make the payment to Kaplan on 31st of January of 25. Now this $1,000, I have to convert, when I pay, I have to incur in INR. But I don't know on this 31st of January, whether the rate, today the rate is 85. If it becomes 87, I am at a loss. If it becomes 84, I will gain. But my business is not to make gain or loss out of foreign exchange differences. I want to safeguard my cash flows. So what do? I go to a bank, or I can go to the market also, and I say, I want a contract Now I need dollars to buy dollars on 31st of January of 25. The bank says you pay or you have to pay 85.5. Sir, why not 85? See, bank also does not want to take a risk. Okay, there is a huge interbank market which works on. So the bank says you have to pay me 85.5 on 31st of January and take $1,000. This is called a forward contract. This is called a forward contract. Now, the difference between today's rate and this rate on which we have agreed, if this amount is higher, it is called premium. And if the amount is lower, it is called discount. Okay. So what has happened? I am sure that I have to pay 85.5 into 1000, that is 85,500 to settle the transaction. 85,500 to settle the transaction. Now the question is, if the rate comes down to 84, even then I have to pay this amount. If the rate goes up to 87, even then I have to pay this amount. I am not here to make money on exchange differences. I want to safeguard my cash flows. Okay. Now the contract entered into to buy a foreign currency at a future date is called a foreign currency contract. The difference between the spot and the forward rate which is agreed is called either premium. If the amount is less, it is called discount. Okay. This is the concept of forward contract. Now the accounting treatment depends on whether it is speculative or non-speculative. So what is the meaning of speculative and non-speculative? Non-speculative means I am entering into the transaction to safeguard myself. I don't want the risk of paying extra. That is non-speculative. Speculative means I am entering into the transaction to make gain or loss because of exchange rate differences. I want to make money because of exchange rate differences. For example, even if I don't have to pay money to Kaplan, I can go to the market and buy USD futures. Okay, similar to forward, but I can buy. And if the rate increases, I make money. That is what speculative. Now, if it is non-speculative, the premium and discount at inception should be amortized over the life of the contract. Means, if for example, if it is 3 months, 1st of February 25, settlement happens on 30th of April of 25. It is 3 months, 1, 2, 3. Premium is, let us say, $1 into 10,000. Okay, so the total premium has to be split between 3 months. So till here, 31st of March of 25, I have to recognize in the current period, and the balance I have to recognize in the subsequent period. Okay, that is one. Then any exchange differences. So the rate movement between this date and this date, the exchange difference has to be recognized in P&L. Premium and discount amortized, exchange difference recognized in P&L, and if at all you cancel or renew the contract, that is also recognized in income and expense. This you can just ignore it. Only these 2 points. If you are thorough, it is sufficient. Whereas if it is a speculative forex contract, speculative means what? I don't want to safeguard myself. I am just entering into the transaction to make money because of exchange rate differences. Then in that case, the foreign currency amount, whatever I have entered into, and the rate on the date versus the rate which is contracted, whatever are the changes, that is gain or loss. For example, if I have entered into to buy a forward contract and the forward contract has moved, the gain or loss whatever arises will be mark to market and recognized in P&L. We will do an example and understand this. Premium and discount is ignored. So let us look at this example. This one. Sterling Limited purchased a plant for $20,000 on 31st December, payable after 4 months. The company entered into a forward contract for 4 months at 48.85. On 31st December, the exchange rate was 47.5. How will you recognize the profit or loss on the forward contract in the books for the year ended 31st March? Now here, I am entering into this contract to safeguard my position for this amount, the dollar that is purchased. So, what is the forward premium? On 31st December, the spot rate is 47.5 and you have agreed to buy at 48.85. So, difference between 48.85 and 47.5 is the premium. 1.35 into 20,000 is my premium. So, 1.35 into 20,000 becomes 27,000. This 27,000 is for 4 months. So, what we will do? from December, that is 31st December, 31st January, February, 29th February and March, 3 months, 27,000 into 3 out of 4, that is 27,000 into 3 divided by 4, 20,250 will be amortized in the year ended 31st March of 12, and the balance will be amortized in the subsequent period. So 20,250 will be recognized as forward premium expense for the year ended 31st March of 12. Okay, that is one thing. PowerTrack Limited purchased a plant for 50,000 payable after 6 months. Company entered into a forward contract for 6 months at 64.25. On 31st October, the exchange rate was 61.5. So again here, 64.25 minus 61.5, the difference is 2.75 multiplied by 50,000. The total loss, or this is not the loss, you call total premium, is 137,500. Out of this 137,500, 5 months will be expensed in the current period and 1 month will be expensed in the subsequent period. Okay. Now, how do we value the gain or loss? Okay, so how do we value the gain or loss? What happens is, you will see, you have entered into this contract at 64.25. Okay. Now, company entered into a forward contract for 6 months means what? I want to buy. Let us say on 31st of March, this rate has now become 65. Means what? I am gaining. Okay. So that gain, if at all it happens, that gain will be recognized in the P&L. Gain will be recognized in the P&L. Of course, at your level, such concepts are not tested. Okay, those questions are not tested. But if at all there is any gain, that will be recognized in P&L. So what is the use of this gain? See, when you finally settle the transaction, assume for a moment, when you settle the transaction, the rate is 65. You are settling on 31st of March. So there is a gain on the forward contract, and on the payable there is a loss. So the gain and the loss will get offset. That is why it is called non-speculative. Now for you, no need to venture so much into details regarding these entries. Generally, premium is tested. If at all they test for gain or loss, calculate the gain or loss and recognize in P&L. Same question. Similar question here also. Okay. So we largely covered various types of questions which are tested as far as foreign exchange are concerned. Disclosure, you can have a reading. FCMI TDA, very important as far as examinations are concerned. Okay, I am not overemphasizing, but this can be a pretty good scoring chapter when it comes to examination, right? So now what we'll do, we are done with this. We'll start with Accounting Standard 4 and follow up with Accounting Standard 5 tomorrow. Okay, AS4 will start, we'll complete whatever we can, and we'll start with Accounting Standard 5 subsequently. Just give me 2 minutes, I'll move the files and we'll continue. If you have any questions in the meanwhile, you can ask. So now let's start with Accounting Standard 4 that deals with contingencies and events occurring after the balance sheet date. So there are two parts. One is contingencies. Here it is talking about loss contingencies. Okay, and there are events occurring after the balance sheet date. This is the dominant part of the standard. Most of the aspects of the standard is what we deal with, events occurring after the balance sheet date. Same thing is also very important when it comes to subsequent events when you learn in right. Now, what are these contingencies? Now, these contingencies, what you are referring to here is other than those covered by other standards. So, for example, Accounting Standard 29 covers provisions and contingent liabilities. So, for contingent liabilities, you will refer to Accounting Standard 29. But for other contingencies, for example, there is a provision for bad debt. Now, what is this contingency? That we will not recover full amount from the customer. That is covered under Accounting Standard 4. Provision for bad debt, don't say that it is covered under Accounting Standard 29. It is covered under Accounting Standard 4. Okay. And then we have events occurring after the balance sheet. What is contingency? A condition or situation whose ultimate outcome, gain or loss, will be known only on occurrence or non-occurrence of one or more uncertain future events. Now, these loss contingencies, for example, customer may not pay us. Customer may not pay us. Subsequently, when let us say the customer's financial positions deteriorate, we will not receive the amount. So that is where we say it is a loss contingency. Okay. If at all there is a loss contingency, we are anticipating that we will not recover the full amount. By applying the concept of prudence, we will provide for that loss in the financial statement. All contingent losses we will provide under the financial statements. Now the difference between loss contingency here and the contingency that we put it in the accounting standard 29, it is more about liability that we are paying or incurring. Here it is more from the point of view of that there is a contingency and we may incur a loss. Now if it is likely that the contingency will result in the loss of enterprise, we will generally make an estimate of this and we will provide for it. Okay. If there is conflicting or insufficient evidence, then you will make disclosure of that. Now there could be a case that we have a particular asset. That asset has been involved in an accident. Let's say car is involved in the accident. Okay. Now insurance company may pay, may not pay. So there is no conclusive evidence that whether there will be a loss or not. Then in that case you will do the disclosure. Okay. Then if there are contingent gains, I may make a gain also. As there is a loss, there could be a gain also. The gains are not recognized in the financial statement unless the realization of the gain is virtually certain. So only these two small points that you need to keep in mind as far as contingencies are concerned. Now we'll move to the most important part, that is events occurring after the balance sheet date. Generally what happens is we prepare a balance sheet on a particular date, let us say 31st of March of 25. Okay. For this date we prepare the balance sheet, but it is not that on the same date you can finalize everything. What happens is you carry out a lot of review, you carry out a lot of closing journal entries, you calculate depreciation, you post depreciation, you value inventory, auditors will audit. So many things happen that take time. So typically, let us say about 2 months time, generally. Okay, some listed companies publish in 10 days itself, but generally 2 months time, assuming it will take to finalize the statement and to get the approval on the financial statement. Who will approve? Normally the board of directors. Okay. So 31st March, the financial statements are being done on 31st of May of 25. That is the date on which the financial statements are approved. This is the balance sheet date. This is the date of approval. The events which occur between these two dates are called subsequent events. Now those events can be favorable and unfavorable, and those have to be significant events. Now, those have to be significant events. Minor events, small events, which does not have a significant impact on the financial statements, are not considered. So, significant events, favorable and unfavorable, occurring between the balance sheet date and the date of approval of the financial statement are called subsequent events. These are called subsequent events. Now, the most important thing that is required is if there is a condition existing on the balance sheet date and we get subsequent evidence of the conditions existing on the balance sheet date, then we adjust those conditions, or we adjust those conditions in light of new evidence. And this might sound complicated. The best example and the standard question which is asked from this chapter is, there was a customer, the customer was facing financial difficulties, so we made a provision of 10% on the balance sheet date. This is a condition existing on the balance sheet date. This is a condition existing on the balance sheet date. So subsequently what happened? During this period, we got to know that the customer became bankrupt. Now, once the customer has become bankrupt, it is not proper to show the customer at a higher value. Whatever amount we realize, we should show only that. So here we got an evidence. There is an unfavorable event. We got extra evidence of conditions existing on the balance sheet date. So we should adjust the impact of that particular item. Or think of a situation where there is a case which we are fighting. Someone has filed a case against us and we are fighting this case. It is undecided on the balance sheet date. Before the date of financial statement approval, this was unfavorable. this was decided against us. Because it has happened before the approval and for this condition we have got extra evidence, we should update our numbers. So if there is any event which is adjusting, we should adjust the impact of that on the date of the financial statement. If something happens after this, then you will ignore. Okay. So events, the subsequent events are either adjusting events or non-adjusting events. Adjusting events are those which occur after the balance sheet date, which provide further evidence. See, this you have to remember. This you have to remember. Further evidence of conditions that existed at the balance sheet date. Whatever conditions existed at the balance sheet date, if you are getting extra evidence for that, that becomes an adjusting event. This definition, learn it by heart. Learn it by heart. There is no other choice also. These provide additional information materially affecting the determination of the amount existing at the balance sheet date, and these are adjusted in the books of account. So, conditions existing, provision for bad debt, event occurring, insolvency, provision created for legal claim, claim approved, theft before the balance sheet date. See, you may not have known it. There was a theft before the balance sheet date, and it was detected before the accounts were approved. So, that is also an adjusting event. Okay. Now, don't say, sir, we didn't know about that event, so how can it be an existing event? See, the theft had occurred. Whether we know or not is independent. On 31st of March, before that period, theft had occurred. And we got additional information when we were doing checking of accounts. So, that becomes an adjusting event. Non-adjusting events are after the balance sheet date, which are indicative of conditions that arose after the balance sheet date. Means, conditions did not exist on the balance sheet date. Typical question in the examination, there is a fire. There is a fire. So, if things like plant got damaged due to fire, payment of claims on account of litigations commenced after the balance sheet date, 31st of March, case was filed here, then it does not become an adjusting event. Okay. If case was filed before, then it becomes an adjusting event. Then decline in market value of investment, etc. are also not adjusting event. But in case of non-adjusting event, if there are significant non-adjusting event, see, one is adjusting event, we will account for it. Another one is non-adjusting event, we will not account for it. But if there are significant non-adjusting events, significant means 60% of plant damaged. 60% of plant got damaged. If that happens, then it is not a small thing to happen, right? It is a very big thing that has happened. So, what the standard says is, if there are events occurring after the balance sheet date which do not affect the figures in the financial statement, but these events are of such significance that they may require a disclosure in the report of the approving authority to enable the users of financial statement to make proper evaluation. So, if there is a significant non-adjusting event, then that you have to disclose in the report of approving authority. Board of directors may make a mention. Board of directors may make a mention stating that 60% of the plants have been damaged, and we are now evaluating how to get back the operations into normalcy, right? Then few special items. Dividends declared after the balance sheet date. This you don't recognize because it is declared after the balance sheet date, but they are disclosed in the notes. Dividend declared after the balance sheet date, they are not recognized. You will not pass an entry, but you will disclose in the notes, even though if it is a subsequent event which is non-existing. Then very important, event indicating that going concern assumption is inappropriate. What does this mean? There are subsequent events. They do not provide additional information of conditions existing on the balance sheet date, but they are of such a nature that the fundamental accounting assumption as per accounting standard 1 of going concern is inappropriate. For example, 90% of the plant got damaged, and now the directors believe that the company cannot run as a going concern. Then in that case, even though it is not indicative of conditions existing on the balance sheet date, if the going concern assumption is not valid, the financial statements are prepared on liquidation basis. That is, you will restate the financial statements. You will go back and restate the financial statements as on 31st of March. On the liquidation basis means the liabilities will be recorded at settlement value and the assets will be recorded at realizable value. Okay, that is what it is done. So if the events occurring after the balance sheet date, theory is very important here. date that may indicate that the enterprise ceases to be a going concern, then we have to evaluate whether it is proper to use the fundamental accounting assumption of going concern. Hence, what you will do, you will prepare the financial statement on a liquidation basis. So if the going concern assumption is no longer valid, that also becomes an adjusting event. Not an adjusting event, like an adjusting event, you will adjust the financial statement and you will prepare the financial statements on liquidation basis. If going concern assumption is valid, you will disclose in report. If it is invalid, you will prepare it on a liquidation basis. The following information should be disclosed for events occurring after the balance sheet date: nature of the event, an estimate of the financial effect, or a statement that an estimate cannot be made. So one, you will disclose the nature of the event. Second, you will provide an estimate of the financial effect. What is the financial impact? Or that estimate cannot be made. Okay, this is the summary. More importantly, you have to remember what is adjusting, what is non-adjusting. Then in non-adjusting, if it is significant, then what is to be done? If the going concern assumption is invalid, then what is to be done? If you understand this much, the standard is over. Now the most important thing is our question. Okay. You are an accountant preparing accounts of A Limited. After year end, the following events have happened. Fire broke out in the premises, damaging uninsured stock worth 10 lakhs, salvage value 2 lakhs. Now this is not providing additional evidence of conditions existing on the balance sheet date, and hence it is non-adjusting. Sir, can we consider this material amount? If you want, you can put that assumption and say, if the inventory loss is considered to be significant, you have to disclose him the director's report. Suit against the company was filed by a party claiming damage of 20 lakhs. Now this is non-adjusting. If it is significant, disclosure is required in board report. Otherwise, you can just no. How to answer? First, give the technical context or give the part of the standard. Then analyze the event and then give the conclusion. Events occurring after the balance sheet date that represent material changes and commitments affecting the financial position of the enterprise must be disclosed according to AS4, contingencies and events occurring after the balance sheet date. Okay. Now, what you need to understand is, it may not be possible for you to replicate everything. So what you can write, events occurring after the balance sheet date that represent material changes and that required adjustment should be adjusted, and that those and significant events must be disclosed. The event of fire damaging stock is an event occurring after the balance sheet date. In the case of loss due to fire, there is no reason to believe that circumstances existed on the balance sheet date. So there was no circumstance on the balance sheet date. If the loss is a matter affecting going concern, it will be treated as an adjusting event. In case the loss is material, it should be disclosed, and if not material, it will not be disclosed. So all the three scenarios you have to write. The fire occurred before the board of directors approved. So that is an assumption what we have taken. Okay. This one. MEC Limited could not recover an amount of rupees 8 lakhs from a debtor. The company is aware that the debtor is in great financial difficulty. Accounts of the company for the year ended were finalized by making a provision of 25%. In May, the debtor became bankrupt. Do you advise the company to provide for entire loss in the books of account for the 31st March? Now, here again, they have not said when was the approval given by the directors. So, you have to make an assumption. Here, there is an event existing on the balance sheet date. There is a subsequent event which has occurred between the balance sheet date and the date of finalization of the account. That subsequent event has given us additional information, additional evidence for conditions existing on the balance sheet date. Hence, because it is providing additional information, we have to disclose. Adjustments to assets and liabilities are required for events occurring after the balance sheet date if such event provides additional information to the conditions existing on the balance sheet date and is also materially affecting the valuation of assets and liabilities. You have to remember. Para number, no need to remember. You can make mistakes, so I will not suggest that. But theory you have to remember. Exactly also if you cannot write somewhere here and there. Key points here is events occurring after the balance sheet date if such event provides additional information to the conditions existing on the balance sheet date and is also material. Okay. In the given case, debtor was already in great financial difficulty, so it is a condition existing. In May 11, additional information is received, so the amount is also material, and hence 8 lakhs will be a loss to the company, so it should be provided. Assumption is that the financial statements have not been approved. Okay, that is the assumptions we are taking and doing the question. So there is basically this fire type question. So this actually we should put it up to AS 9, not here. We'll discuss it there itself. In Raj company, theft of cash 2 lakhs by the cashier in January 11 was detected in May 11. The accounts of the company were not yet approved. Now this again, event existing in January 11 itself. So because event is existing here, you have to adjust with proper theory. What if the company gets to know about the cash loss after the board approval? Then you will adjust in the subsequent period and will be treated as a prior period item. Dividends, if at all there are any, you have to make a disclosure. Earthquake 30th April, loss is estimated to be 25 lakhs. It is subsequent event, non-adjusting material to be disclosed. Okay. Then this fire is a common case, so there is nothing there. Yeah. Company follows April to March as its financial year. The company recognizes checks dated 31st March or before received from customers after the balance date, but before the approval of the financial statement by debiting checks in hand and crediting the debtors account. Again, what does it mean? Company follows April to March. The company recognizes checks dated 31st March or before received from customers after the balance sheet date. When are we receiving the check? Subsequent to the balance sheet date. So, is there any event existing on the balance sheet date? The event is not existing on the balance sheet date. We have received the checks after the balance sheet date, hence it is not an existing event. Okay, so this event has itself occurred after 31st of March. Sir, but check is dated 31st of March. No, so that is not relevant. Okay, if you have received it after 31st of March, you should account for in that subsequent period only. Checks are received after the balance sheet date should be accounted for in the period in which they are received. Now, when you handle these type of questions in the examination, we can create n number of scenarios. So what you have to do is, you have to carefully see what is the balance sheet date. Is the event or condition existing on the balance sheet date? If yes, then you have to see whether there is additional information. If the additional information requires changes, then carry out the changes. If it is non-adjusting, then you have to see if it is material, then disclose. If it is going concern affecting, then adjust, otherwise ignore. So if I have to give you in a tabular format, summary. Adjusting event, non-adjusting event. Adjusting you have to anyways adjust. If it is non-adjusting, if it is material, disclose. If going concern is affected, then you have to adjust and prepare the financial statements on liquidation basis. Okay, I would suggest you to write down these answers of the questions from this particular standard to get a proper grade for the examination. Okay, so a lot of writing practice is needed here. That brings us to the end of accounting standard 4 as well. And tomorrow we'll start with accounting standard. If there are any questions, you can let me know, or else we'll end the session. Good morning. So yesterday we completed accounting standard 4 and today we'll continue and complete accounting standard 5, and after accounting standard 5 we'll start with accounting standard 9. Okay, so initially we did a lot of computation related standard. These are more theory related standards. Again we'll move back to computation related standard, right? Now, as far as accounting standard 5 is concerned, this is a simple standard like accounting standard 4. There are few concepts that you need to be aware of. Then it is more about writing those concepts, applying those concepts in the scenario given in the examination. Okay, and please ensure in this standard, remember the definition and the concept, right? Now, what does AS5 deal with? It deals with net profit or loss for the period. That is, how do we determine the profit or loss? Prior period items and changes in accounting policies. 3 things. Largely you get questions on prior period items and changes in accounting policies. Okay. Now, AS5 is applied by an enterprise in presenting profit or loss. So when you are preparing the profit and loss account from ordinary activities, these are your day-to-day activities. Ordinary means on a routine basis, like for example, purchase of goods, sale of goods, right? Where the enterprise engages on a day-to-day basis, that is called ordinary activities. Then extraordinary items. Now extraordinary items are those which are not ordinary items, which are maybe like a one-time item and is not expected to occur regularly. For example, a fire broke down, a fire occurred, right? When a fire occurred and there is a damage to, let's say, inventory or damage to the premises, that is called extraordinary item. And then we have prior period items. Now, prior period items means there has been some error or omission. These are the keywords. There has been some errors or omission in one or more previous period, and that has been detected in the current period. Now, what is the meaning of errors? Say for example, we calculated depreciation incorrectly. Okay, it is not that the estimated life was different. We calculated depreciation incorrectly, or we totaled the value of inventory incorrectly when in the previous period. In the current period, we identified that, oh, we made a mistake. Now we have to rectify it. Those are called prior period items, right? So we have in P&L, ordinary activities, your routine transaction; extraordinary activities, one time which is not expected to reoccur frequently; and prior period items, which are errors and omissions from the previous period. That is the first aspect. Then it also talks about accounting for changes in accounting estimates. What do we do when we account for changes in estimates and changes in accounting policies? So whenever you get a question on any of these, something should strike in your mind that this question has come from Accounting Standard 5. Now, what are ordinary activities? These are undertaken by the enterprise as a part of its business and related activities in which the enterprise engages in furtherance or incidental or arising from these activities. So, for example, purchase of goods. Now, when I am purchasing goods, of course, there will be transport cost incurred. I have to store those goods. I have to, take a warehouse on rent. Anything which is my part of my business, my buying and selling transaction, or my manufacturing activities, or my service activities, and related activities to this part of business. So, for example, just to give one more dimension, I am taking classes, okay, or we record classes. Now, we also conduct live classes. Now, these are also related to we offering classes to the students. That those are called ordinary activities. Then, what are extraordinary items? This is very important. You have to learn this definition. You have to learn this definition because this is what will give you extra marks whenever you write in the examination. Income and expenses that arise from events or transactions that are clearly distinct from the ordinary activities and therefore are not expected to recur frequently or regularly. So, fire occurred, large part of assets have been sold, okay, or a significant customer went bankrupt, something which is not expected to occur frequently. That is what we classify under extraordinary items. Now, sometimes what happens is there are ordinary activities which are exceptional in nature. Okay, so day-to-day transactions, but the value is significant or the kind of transaction is significant. Then we say ordinary activities which are exceptional in nature. Extraordinary, once in a lifetime, not once in a lifetime, but very less occurrence. So for example, we purchased another company. Okay, when we purchase another company or when we sell a subsidiary, these are extraordinary activities because these are not expected to occur frequently and they are distinct from the ordinary activities. So what is ordinary? What is extraordinary? We have seen. As far as extraordinary items are concerned, we have to disclose the extraordinary items separately. We have to disclose extraordinary items separately. That is the logic. Then prior period items. What are prior period items? As we discussed earlier, income and expenses. Here we talked about it, which arise in the current period because of error or omissions in the preparation of financial statements of one or more prior periods. We did some mistake in the past and we identified that mistake now, and now we have to rectify. And when we rectify, we have to record an income or expense. For example, as I told you, depreciation calculated incorrectly. Okay, we knew the rate of depreciation is 20%, but what did we do? 10,000 into, instead of doing 10,000 into 20%, we did, let us say, 9,000 into 20%. So what happened? This is right, this is wrong. So this is 1800. This should have been 2000. So what do? This difference of 200 we will record in the current period. Okay. I am not talking about changes in estimate of useful life or changes in estimate of residual value. We applied the rate to the wrong amount. That is called prior period item. Then we have accounting policies. What are accounting policies? These are principles and the methods of applying those principles adopted by an enterprise in the preparation and presentation of financial statements. Now, when you look at a financial statement, there are multiple different items in the financial statement. For example, inventory. Okay. Now, inventory, you can value inventory using multiple methods, FIFO, weighted average, LIFO, and all of that. So, the accounting principle and the method of applying those principles. Which principle am I applying? Which method am I applying? How am I applying that accounting principle? Which is adopted by an enterprise in the preparation and presentation of financial statement. So you can have, accounting policy related to inventory. You can have accounting policy related to PPE, cost model or revaluation model. Okay. Then, so that is one more aspect where you are choosing an accounting policy. Then accounting policy related to, let us say, accounting standard 11. Will we capitalize the exchange losses or will we write it off to the P&L? All of those are accounting policies. Okay. So quickly, ordinary activities, these are day to day, these are part of the business, these are related to the business, and any other activity which is carried out to carry on the business. Extraordinary items, these are distinct from the ordinary activities. So what you have to understand is these keywords are important. These are distinct from the ordinary activities. These are part of its business. Then prior period items, error or omissions, and accounting policies, specific accounting principles and methods of applying those principles which are adopted by the enterprise in preparation and presentation of financial statements. Now, this part related to net profit or loss for the period, this is not very significant, but still we have to learn it. All items of income and expenses which are recognized in a period, whether from ordinary activities or from extraordinary activities, should be included in the determination of net profit or loss for the period. This is something which we clearly know. Okay. The net profit or loss for the period comprises of P&L from ordinary activities, that is you have to disclose, and extraordinary items. The impact of extraordinary items should be disclosed on the face of the statement of P&L separately. So, even if you prepare Schedule 3 financial statements, even there, the impact of extraordinary items you have to disclose separately. Okay. Now, profit or loss from ordinary activities are part of the business. For example, sale of merchandise, loss on sale of inventory, etc. Then there could be ordinary activities of exceptional nature. That is what I was discussing, right? So, if disclosure of an item of income and expense from ordinary activities is relevant to explain the performance of the enterprise, the nature and amount should be disclosed separately. That is called ordinary activities of exceptional nature. So, let's say huge write down of inventory. Okay, huge write down of inventory. Ordinary activity, yes, but exceptional nature. Loss of inventory, theft of goods, ordinary activities, exceptional in nature. So how do we decide? Based on the size, nature and incidence. If it's a huge size, or if it is based on the nature also. For example, let us say there is a director. Okay, now director, you do some transactions with the director. Ordinary activities, director purchase goods, ordinary activities, but accounting standard 18, we know it is a related party, you have to disclose separately. So that is because it is exceptional in nature. Okay. So like this, some standards directly tell you that you have to disclose, but otherwise you have to see if the size, the nature, the incidence of the item is such that a separate disclosure is required, you will present it separately by calling it ordinary activities of exceptional nature. Circumstances where separate disclosure is necessary: write down of inventories to NRV and reversal of such write downs, legislative and statutory changes having retrospective application. That is one very, so for example, you pay taxes regularly. Suddenly they came up and say GST on a retrospective basis you have to pay. You have to pay GST on a retrospective basis. They will not say, but let us say there is question whether it is taxable or exempt. And so far we have been treating it to be exempt. GST came up and said, no, it's not exempt, it is taxable. So right from beginning you have to pay. So it is ordinary item of exceptional nature. Disposal of long-term investment of fixed asset, litigation, settlement. Okay. So what you have to see is, if it is ordinary, if it is routine, if the nature and amount is okay, then you will not make a separate disclosure. But if the nature, timing, incidence, size is such that a separate disclosure is required, then you need to disclose. Now the question comes, how do we decide that in the exam? We will not know whether it is material or not. So there you have to make a guess. So for example, if they say inventory loss of 10 lakhs, you can say, if we assume that this is a significant item, then we have to make a separate disclosure. Something like that you can write. Extraordinary items should be disclosed separately with respect to nature and amount in the statement of P&L as a part of net profit for the period. So when you prepare Schedule 3, when we come to Schedule 3, there you will see extraordinary item as a separate line item. How to determine? Based on the nature of the event or transaction in relation to the business ordinarily carried on by the enterprise. Okay, so if my business is, for example, buying and selling of computers, and suddenly I start, in one of transaction I bought and sold a car, that can be an extraordinary item. Okay, so you cannot have a blanket rule. You have to see, is it related to my day-to-day business? If yes, ordinary. If no, extraordinary. Some events that generally give rise to extraordinary item could be attachment of property of the enterprise. Government has attached the property. Earthquake has occurred. Loss has occurred. Refund of government grant that we understand there. So all of these have to be disclosed separately. Okay. Then the next part is prior period item. Now see, what you have to understand is, in all of this, the theory part is very, very important. You understand the concept, but make it a point to learn and write it. The definition part, learn and write it, so that if a question comes in the exam, automatically you can write the answers. What is a prior period item? It's an error or omission. It is rectified in the current period, affect the current period P&L, and it is coming from the previous period. So errors of past period rectified in the current period. So it could be anything. Now how do I decide whether it is prior period or not? So what you have to ask is, when I prepared the financial statement on 31st of March, did I have the information? If I have the information and I did not account for it, then it becomes an error or omission. Or if I calculated it wrongly, error or omission. Now there could be a situation where theft has occurred in the previous period. On 31st March we did not know. By 31st May also we did not know. That the theft had occurred. Now on 31st May, financial statements have been approved. I did not know here. So this, when I finally know here, this is not a prior period item. Why not a prior period item? Because I was not aware. It was not an error from my side. It was not an omission from my side. Error or omission means either I calculated wrongly, or after being aware I have omitted. That is when we call it error or omission. Okay. Now, if it was identified here, then we would have adjusted. But if it is identified here, we cannot do anything. It becomes a prior period item. Right? So far we have seen ordinary items, extraordinary items, and prior period items. Now, there are two related concepts. One is accounting estimate and one is accounting policies. So the questions are asked based on whether the following is a change in accounting estimate or a change in accounting policy. So for that, let us see. What is the estimate? Estimate is basically of an amount or quantity or life. Okay, estimate is basically of an amount. For example, provision for bad debt. We make a provision at 5%. This is called an estimate. We are estimating the amount of bad debt. Now, why do we call it an estimate? Because we cannot determine the exact amount. When we cannot determine the exact amount, we say it is an estimate. It is an estimate. Now, we have to provide for bad debt. That is a part of our policy. But this amount that is calculated for provision for bad debt, that is called an estimate. Now, these type of estimates we make a lot of times. For example, useful life. Then we make estimates of residual value, right? We make a lot of estimates while preparing the financial statements. We make estimates of net realizable value. These estimates are used to prepare the financial statements when we don't have the exact amount. Now, for example, we said provision for bad debt is 5,000. Actual bad debt became 6,000. Now, this is not a problem of accounting policy. This is a problem, or this is a difference which has arisen because we made an estimate, the estimate turned out to be different. This is called change in accounting estimate. This is called change in accounting estimate. Now, for you in the examination, the best way to distinguish between an accounting estimate and an accounting policy is that you have to see whether it is something related to amount, quantity, life, etc., where the management has made an estimate. Where the management has made an estimate. Right? So, if there is a change in accounting estimate, what we'll do, we will adjust in subsequent period. We'll adjust in subsequent period. Now, one more thing, as per accounting standard change 10, change in method of depreciation is a change in accounting estimate. Earlier, it used to be a change in accounting policy. Now, they have said that because one, it includes both an estimate and a policy, and hence we will use it as a change in accounting estimate only. So, this is one thing you have to remember. Changes as per accounting standard 10, changes in the method of depreciation is a change in accounting estimate. Now, why do we change accounting estimate? We change accounting estimate where there are changes in circumstances, or new information has been derived, or more experience because of subsequent development. Okay. Now, estimate also could be for a liability created. We have created a provision for, let us say, a suit which has been filed against us. Some party has filed a case against us, and for that case we have made a provision. Okay, it's not a contingent liability, it's a provision. Or it could also be a contingent liability. Subsequently, we figured out that the amount we have to pay is higher. Okay, so that is also called a change in accounting estimate. Now, this is important. The effect of change in accounting estimate should be included in the net P&L or determination of P&L in the current period. That is, in the period when we have seen the change in accounting estimate, and current and future period if the change affects both. So, if the change in accounting estimate affects only the current period, what could that be the case? I gave you an example of bad debt. 5,000 was the estimate, 6,000 became actual. This impacts only the current period. So, this will impact only the current period. Whereas, change in method of depreciation impacts not only the current period, but also the subsequent period. Change in method of depreciation, which is a change in accounting estimate, impacts the current period and all the subsequent period. So, here this line means it will impact both current and future period if the change affects the both. Okay. So, that is what is to be done with changes in accounting estimate. We will see good number of questions here because we have to clearly identify whether it is a change in accounting estimate or whether it is a change in accounting policy. What is an accounting estimate? The closest approximation of an account balance in the light of best available information. Because we don't have entire information, we use estimates. Disclosure for change in accounting estimates. The nature and amount of change in accounting estimate, if it has a material effect in the current period or subsequent period, should be disclosed. If it is impracticable to quantify the amount, the fact should be disclosed. So, this also you need to remember. Okay. Now, changes in accounting policies. What are accounting policies again? the specific principles and the method of applying those principles adopted by an enterprise in the preparation and presentation of financial statement. Remember this. I told you earlier also, you have to remember this. Because whenever there is a question on change in accounting policy, you need to give the definition. You need to give the definition. Okay. Now, the question is, when can we change the accounting policy? There are three things. Again, this you have to remember. We can change the accounting policy when the adoption of a different accounting policy is required by statute or law. If there is a law which says you have to adopt a different accounting policy. Now, a typical example I would give you. We follow accounting standards. Okay, as Indigo Learn, we follow accounting standard. Let us say we become listed. Once we become listed, as per the Companies Act and accounting standard rules and Indian accounting standard rules, we have to follow Ind AS. So the accounting policy is changed because law requires us to change it. That is the first thing. Second, for compliance with an accounting standard, a new accounting standard has been released or issued. If you have to comply with that, we can change the accounting policy. Or when it is considered that change would result in a more appropriate presentation of the financial statement of the enterprise. So, three things. If it is required by law, if it is required, or if it is required by a new accounting standard or a existing accounting standard, we have to adopt it to comply with the accounting standard. Third, if it is considered that change would result in a more appropriate presentation, or you can write it as in a better presentation of the financial statements of the enterprise. Three things: law, compliance with accounting standard, better presentation of financial statement. You need to write these reasons. Okay. Now, if there is a change in accounting policy which has a material effect, that should be disclosed. So, if there is an accounting policy which has a material effect, it should be disclosed. The impact in the financial statement should be shown in the period in which the change is made, and when the effect of such change is not ascertainable, the fact should be disclosed. So, what you have to do is, for example, inventory. Earlier we used to follow FIFO method. Now we have followed weighted average method. As per FIFO method, inventory is 1 lakh. As per weighted average method, inventory became 1,20,000. Now, if the inventory value increases, profit also increases. So what you have to disclose is, you have to disclose that we have changed the accounting policy. Because of the change in accounting policy, the value of inventory has increased from 1 lakh to 1,20,000, and consequently the profit has increased by 20,000. If the earlier policy was followed, the inventory would have been at 1 lakh and the profit would have been at so much amount. Okay, that is how you have to disclose. So, any change in accounting policy which has material effect should be disclosed. Impact in the financial should be shown in the period in which such change is made. If the change has no material effect in the current accounting period but is reasonably expected to have a material effect in the later accounting periods, the fact should be appropriately disclosed. Now, the second thing what it means is, current period there is no material impact. Subsequent period it will be a material impact, that also you have to disclose. So, accounting policy examination question will be either whether this is a change in accounting estimate or whether there is a change in accounting policy, or there could be a question which says when can an entity change the accounting policy and what are the disclosures requirement. Okay, so these are the things you have to remember. Now, if you are adopting an accounting policy for events or transactions that differ in substance from the previously occurring events or transaction, that is not called an accounting policy change. For example, in the past, we never had, a structured employee benefit program. Now we started a structured employee benefit program. Means earlier there was no policy. Now we have started the policy. So it is not a change in accounting policy. It is adoption of new accounting policy. Okay. Second, adoption of new accounting policy for transactions which did not occur previously or were immaterial. So if you have adopted new accounting policy, that is not called a change. If you are using an accounting policy for events that differ in substance from the previously occurring event or transaction. So earlier transactions were different, now the transactions are different. And for the new transactions, if we take a policy, it is not called a change in accounting policy. This also sometimes is tested in the examination. Okay, so just a quick recap. For net profit for the period, you have ordinary activities, And extraordinary activities of exceptional nature is disclosed separately. We have prior period item because of errors in omission, you have to disclose separately. Changes in accounting policies, changes with material effect to be disclosed, estimates also to be disclosed. Okay, now what we'll do is, this notes anyways you have, we can look at the question answers. We'll focus more on examination questions. Now, November 23, 5 marks question. The accountant of Beryl Limited has asked you to identify the following items as change in accounting policies or change in accounting estimate, extraordinary items, prior period items, ordinary activities. So many things have been asked, right? You have to appropriately classify, right? First, non-provision for salary already due in the earlier year. So first thing, we have not done something that we are supposed to do. We have missed something. So how should we check? How should we check? Should we directly start ordinary? No, because the residual category, or the category which is specifically defined is prior period item, changes in estimate, policies, etc. Ordinary activity is the last thing, because that is a day-to-day business of the enterprise. Now, payment of salary is ordinary activity. Don't say this becomes ordinary activity. This is specifically defined as a prior period item because we did not provide what we were supposed to provide. We did not provide what we were supposed to provide. So the first one is a prior period item. First one is a prior period item. Then attachment of the property of the enterprise. Now this is something. Is it related to error? No. Okay. Is it related to accounting policy? No. Accounting estimate? No. Something has happened. Now the last thing that we are left is basically whether it is ordinary or extraordinary. Attachment of property is not something that is happening as a part of our business. Okay. If it is a part of our business, then it means we are carrying out some illegal activities on a day-to-day basis. So if attachment of property has happened, it is not ordinary activity. It is nothing to do with estimate, policy, etc. So this we have also seen earlier. It is an extraordinary activity. Introduction of new pension scheme for employees. Now when we introduce a new pension scheme for an employee, it is not a change in accounting policy because new. We have introduced new. So can we say it is adoption of new policy? Yes. But the question has said classify estimate, policies, extraordinary items, prior period item, ordinary activity. Now it is not a change in accounting policy. It is of course not a change in accounting estimate. No error, no extraordinary item. It is part of ordinary activities. Change in the reserve for obsolete inventory. Now reserve for obsolete inventory basically means the loss that we have recognized when we value inventory at lower of cost or net realizable value. This is to do with estimate. This is to do with estimate. So it is a change in accounting estimate. Settlement of litigation case. Someone has filed a litigation against the company, we have settled it, right? Now this becomes a part of our business, ordinary activity, but this is an exceptional nature because it is related to our business. Actual bad debts exceeds the provision, standard question, change in estimate. Legislative changes having long-term retrospective application. Legislative changes, GST has changes, it has long-term retrospective application. Is it related to our business? Yes, but it is significant, it is material, so it is ordinary activity with exceptional nature. Capitalization of working capital, loan interest. So we have taken working capital, that loan interest we have capitalized, right? Now what is this? This is our error, we have done a mistake here. Change from cost model to revaluation model for measurement of carrying amount of PPE. So selection of measurement model, cost model or revaluation model. This is our accounting policy change. Government sanctioned grant in the current year for expenses incurred in the previous year. Right now, government has sanctioned grant. Grant has been received related to the business. So it is a part of our ordinary activity, but requiring separate disclosure. Or if it is one-off case, see generally government grants are also related to the business. So it will be extraordinary activity. Or if the enterprise feels that calling it to be an extraordinary because it is one time, it is not expected to occur in the future, then you can classify it as extraordinary activity as well. Now these type of questions, if it comes, attempt everything, 4 to 5 marks you should be targeting. Don't worry about perfection. Okay, perfection has never yielded great results. Can I score 4 to 5 out of 10 questions? That is identification 0.5 each one. Now the next question you may have is, so should we explain? You have to be smart. This question is for 5 marks. There are 10 items. So there is no scope for explanation because identification itself will help you get 0.5 marks. But if a 5-mark question and only 5 items have been given, then for the categories that is covered here, you may give 1-line definition or 2-line definition as well. Okay. Is this clear how to approach this question? How much to write? Because a lot of students, what they do is they will explain everything, they will classify everything, and then they will come back and say, sir, we did not have sufficient time, we could not complete the paper. That should not be the thing. 10 marks, 5 marks, 10 points. Very clearly, there is no marks that is given for explanation or justification. Are we clear? Are we clear, all of you? Okay, great. The accountant of Shiva Limited had sought your opinion with relevant reasons whether the following transactions will be treated as change in accounting policies or change in accounting estimate for the year ended 31st March of 21. Please advise him in the following situation in accordance with the provisions of Accounting Standard 5. So here they have said, not only identify, advise him in accordance with the provision, your opinion with relevant reasons. Just a moment. Sorry guys, some small interruption. So now in this question, if you see, as compared to the previous question, here they have said opinion with reasons. So you have to give opinion, you have to also give the reasons. And here if you see, they have given you 5 line items. So for each line item, 1 mark for reason with your opinion. Okay. Sir, will we get half mark for just writing the opinion? Generally, it is not provided unless the examiner, head examiner specifically says that you can give, or if the examiner is slightly, if they feel that we should give that marks, then they will give, but otherwise they will not give. Okay. Provision for doubtful debts was created at 3% till 31st March. From the financial year, the rate of provision has changed to 4%. Now here very clearly, here the company has revised the estimates based on the changed circumstances. Thus the rate of provision of doubtful debt is a change in the accounting estimate and not a change in the accounting policy. Then, during the year, the management has introduced a formal gratuity scheme in place of ad hoc ex gratia payment to the employees. Now, here what has happened? New policy has been implemented. So, how should we write? The adoption of an accounting policy for the events or transaction that differ in substance from previously occurring events or transaction. The notes, what we refer to those 2 exceptions, will not be considered as a change in accounting policy. Introduction of a formal retirement gratuity scheme by an employer in place of ad hoc gratia payments on retirement is a transaction which is substantially different. Hence, it is neither a change in accounting policy nor a change in accounting estimate. Till 31st March, furniture was depreciated on SLM basis for 5 years or over 5 years. Now they have changed it to 3 years. This specifically is covered as a change in accounting estimate. Okay, then management decided to pay pension to those employees who have retired after completing 5 years of service in the organization. Earlier, there was no such pension. So, we have introduced a new pension scheme. There was no pension earlier. So, this also is a change in, this also is a adoption of new accounting policy. There was a change in the cost formula measuring cost of the inventory. So, that becomes a change in our accounting policy. Are we clear on how to approach? See, my whole idea is in both Accounting Standard 4 and Accounting Standard 5, we should not lose out on marks. We should never lose out on marks. That is the whole idea. Okay. Then, May 22, again 5 marks. TQ Cycles is in the manufacturing of bicycle, a labor-intensive manufacturing sector. In April 22, the government enhanced the minimum wages payable to workers with retrospective effect from 1st of January of 22. Now, here, we have to be careful about the dates. Okay, which year are we looking? We are looking for P&L for 21-22. So we are talking about 31st March of 22. When did it become retrospectively applicable? From 1st of January of 22. 1st of January of 22. Now I think this is an error here. It is 20 to 23. Let us see. Due to the legislative changes, the additional wages for the period from January 22 to March 22 amounted to 30 lakhs. So, from Jan 22 to March 22, it is 30 lakhs. The management has asked finance manager to charge 30 lakhs as prior period item while finalizing the financial statement for 22-23. Now, what they are saying? They are finalizing the financial statement for 2022-23. For 22-23, they are finalizing the financial statements. Now, this amount that you have to pay, when was it decided? In April 22, it was decided. In April 22, it was decided. So, in 22-23, it was decided that you have to pay 30 lakhs for the previous period. Now, the thing is it a prior period item or is it an ordinary item or is it an extraordinary item? Now, we have to handle one by one. One is it belongs to the previous period, but it cannot be called a prior period item because we did not have the information when we were preparing the financial statement, right? The second thing is they have not told us when the financial statements were finalized, and here because they have not discussed that, we can assume, if we believe that the financial statements were finalized, negotiations were going on, then it can be an adjusting event or non-adjusting event. That is one scenario we can pick up. Okay. Now here specifically, the finance manager is the view that this amount being abnormal should be disclosed as extraordinary item in the P&L. So here we are talking about prior period item and extraordinary item. We have to clarify whether it is a prior period item or not. I already told you, as when we prepared the financial statement as in 31st March of 22, the information was not available. There was no error, there was no omission. We did not know about it. Hence, it cannot be called a prior period item. So, how do we approach this? First, define the relevant provision. Prior period items are income and expenses which arise in the current period as a result of errors or omission in the preparation of financial statements of one or more previous period. This does not include other adjustments necessitated by circumstances which, though related to prior period, are determined in the current period. This sentence, even if you don't write, it is okay. Now, the revision of wages took place in April with retrospective effect from 1st of January. Therefore, wages payable for the period 1st January to 31st March. It cannot be taken as an error in the preparation of financial statements, and hence this expenditure cannot be taken as a prior period item. This cannot be taken as a prior period item. Then what should we do? That amount should be taken as expense in the P&L for the current period. Now, is it an extraordinary item? Payment of salary and wages is a day-to-day activity for me. It is not an extraordinary item. Hence, it cannot be called an extraordinary item as well. So, you can give the definition of extraordinary item and say why it is not an extraordinary item. But it is what? My ordinary item. But it is ordinary item, amount or nature is significant. Why is it significant? Government has said you have to increase the wages. The shareholders should know. The stakeholders should know. So in that case, what do you should do? Ordinary activity, but exceptional nature, a separate disclosure is required. Right? That is how you have to frame the answer. Now, in the examination, you will get 1 mark for prior period item definition, 1 mark for extraordinary item definition, 1 mark for explaining why it is not a prior period item, 1 mark for explaining why it is not an extraordinary item, and 1 mark for giving you a conclusion that it has to be disclosed separately. Okay. Now, sometimes they make mistakes in financial year. You can assume that this is for 2022, 23. All right. Again, so similar thing what we have discussed earlier. So this you can go through it once. PQR Limited is in the process of finalizing its accounts for the year ended 31st March. The company seeks your advice on the following. Number 1. Goods worth 5 lakhs were destroyed due to flood in September. A claim was lodged September 15. Claim was lodged with the insurance company. No entry was passed in the books for insurance claim in the financial year 15-16. In March 18, the claim was passed and the company received a payment of 3,50,000. Explain the treatment of such receipt in the final accounts for the year ended 31st March of 2018. Okay. Now, there are two things. One, flood occurred in September 15. Claim was lodged with the insurance company immediately, but no entry was passed. Now, two things are there. One, if you look at accounting standard 29 related to reimbursement when when you have to receive some amount from another party, in that case, what you have to also see is if it is clear, if it is certain, if it is virtually certain that you will receive the amount, only then you can record an entry. Now, I can assume that because I have filed the insurance claim and it is virtually certain that the claim will be approved or insurance company has already approved the claim, then in that case, I can say it is an error or omission. But if I believe that it was not certain whether we will receive the amount or not, then it will not be a prior period item. So, depending on the assumption you take, your answer will change. Here, what they have taken an assumption is it's a case of error and omission in the preparation of financial statement. Hence, the claim received in 1718 is a prior period item. So, this is on the assumption that when we filed the claim, we were sure we will receive the money. We were sure we will receive the money. That is why it was considered as a prior period item. Okay. Then, company created provision for bad debt at 2.5% in preparation of financial statement. On review of the credit period and all of that, they have changed it to 8%. Accounts were not approved by the board till the date of decision. While applying the relevant accounting standard, can this be considered extraordinary item or a prior period item? Now, what is this? This is something where you have changed the estimate. If we have changed the estimate, it is neither a prior period item nor an extraordinary item. Okay, it is an item in the ordinary course of business, and this relates to an estimate. So, accordingly, you will write the answer. Okay, so you can look at the other questions because we have thoroughly understood how to approach, how to write, what is extraordinary, what is ordinary, what is prior period, what is changes in accounting policy, and what are changes in accounting estimates. Any questions, or we will move to the next standard. Okay. So now the next one, accounting standard 9, revenue recognition. On and off, we keep getting questions on AS9. The good part of this standard, I would say, is that it is again logical. There is nothing great for you to remember. Okay, if you understood the underlying logic, then it is very easy for you to handle the questions in the examination. Very important because revenue is the lifeline of the business. Revenue forms the most important part of the business. Without revenue, business cannot exist. Okay, of course, there are some startups and all of that, or there are some initial stage research companies and all who exist without revenue, but revenue recognition becomes very important, right? Now, what does AS9 deal with? AS9 talks about when should we recognize revenue in the financial statement and the circumstances under which revenue recognition should be postponed. One is when, how, what amount should we recognize revenue? Second is what are the situations where we have to defer the revenue recognition. Okay, that is what is the crux of the standard. Then we'll talk about transfer of risk and rewards. Okay, then we'll talk about what happens when there is a bill and hold transaction, sell and consignment sales, commission sales, interest, dividends, etc. But first thing, what is revenue? This is important because if I am selling computers, if my business is selling computers, and I also use computers for office, which is PPE. Okay, sale of this computer, the amount that I'll realize is called revenue. But this PPE, what is sold, that should not be classified as revenue. So that is where the definition of revenue also becomes very important. Now, what the standard says is revenue is gross inflow of cash. You have received cash, receivables, you have created a receivables or other consideration. So what you are saying, either you will receive cash or you will create receivables or there are other forms of consideration. So if I sell goods to you or if I sell these classes to you, what did you give me? You paid me money. So what did I receive? I received cash. What will I pass an entry? Cash account to sales account. If you don't pay me cash, we don't have credit sales, by the way. It will become debtors to sales. So revenue is gross inflow of cash, receivable or other consideration. Other consideration could be in form of other assets. The other party might give their share, they might give their investment, they might give some other asset arising from sale of goods, rendering of services. So either it is sale of goods, rendering of services, or used by others of enterprise resources yielding interest, royalties, and dividend. So used by others. Others are using what? Our resources, which will give us either interest, royalty, or dividend. Okay, so these are called revenue, right? Now, Revenue is measured by the charges made to the customers or clients for goods supplied by the service or services rendered to them, and by the charges and rewards arising from the use of resources by them. So, if I'm, let's say, if I'm, banking company, or if I have, given loan to someone and I've received interest, so that also becomes a part of my revenue. Okay. Now, once you have revenue, once we say that revenue has been established, or we need to recognize revenue for different transactions, how do we recognize revenue is the key question. First is sale of goods. If there is a transaction involving sale of goods, you will recognize revenue when performance have been achieved, when the following conditions have been fulfilled, or when there is a sale of goods, if the following conditions have been fulfilled, you can recognize revenue. Number one, seller has transferred to the buyer the property in the goods or a price. Seller, I am the seller. Okay, let us say I sell cars. I buy and sell cars. I am a seller of cars. I have transferred the property in the goods. Property means what? The ownership rights on the goods I have transferred it to you. I have transferred it to you by maybe entering into an agreement or by registering the vehicle in your name. We have agreed. Okay. And the agreement can be verbal, it can be oral, it can be written, it can be in any format. All significant risk and rewards have been transferred to the buyer, and seller retains no effective control of the goods transferred. This is by far the most important condition in revenue recognition. Others are also important, but here what we are saying is, once I have sold the goods to you, once you have taken the delivery of the car, the risk, the rewards. The risk means, let us say the car gets damaged. The car meets with an accident. I pray it does not happen, but assume for a moment car meets with an accident. Then in that case, who bears the risk? You will bear the risk. Sir, no, I have taken insurance. Correct. But if the insurance company does not pay, you have to bear the risk. I will not bear the risk. So in that case, we say risk have been transferred. Now, what is this reward have been transferred? Rewards being transferred means who will get the benefit by using that particular asset? You or me, you will get the benefit. So if all significant, it may not be all the rewards, but significant risk and rewards have been transferred to the buyer, and seller retains no effective control of the goods transfer. I don't have control. Means what? After I have transferred the car to you, it is you who will decide where to take the car, how to drive, whether to drive, not to drive. All of that you will decide. Can I come and say, you purchase the car from me, you cannot take it outside the city? I cannot say, because I don't have control over the car. Right? So second one is that. Third, no significant uncertainty exists regarding the amount of the consideration that will be derived from the sale of the goods. Means there is no significant uncertainty. I don't have any uncertainty in terms of what is the amount I should receive and whether you will pay the amount or not. There is no uncertainty related to that. Okay. So if these conditions are satisfied, then we can recognize revenue from sale of goods. So when there is a sale of goods, things to remember, property in the goods have been transferred, significant risk and rewards have been transferred, seller retains no effective control, and there is no significant uncertainty. Right? If these conditions are satisfied, you can recognize. You can recognize. Then there are some specific circumstances. Again, this is important and you need to remember. Buyer requests delivery but takes title and access bidding, not request delivery. Buyer request delayed delivery. Okay, buyer request delayed delivery. Okay, so buyer has said, buyer has accepted the goods. Buyer has said, okay, this is the particular goods I want to buy. Title has been transferred. You have entered into an agreement. Accepts, billing has been accepted. Everything has happened. So we'll recognize revenue even if delivery is not made, ensuring that the item is held in stock, ready for delivery. So if the item is held in stock and it is ready for delivery, we have done the billing, customer has accepted the billing, the customer has said, yes, this is my property, but I am requesting you please hold. This is called bill and hold transaction. Then in that case, can I recognize revenue? Yes, if the risk and rewards have been transferred. So how do we test? Simple thing. If the product gets damaged, who is responsible? You or me. Okay. Now, to give you some examples, say you purchase goods from Amazon. When you purchase goods from Amazon, Amazon or the seller is obliged to deliver goods to your doorstep. Till the time the goods are delivered to your doorstep, the company cannot recognize revenue because the company has not fulfilled its performance, the risk and rewards have not been transferred. After the goods have been delivered, then after that return period gets over, then the company can recognize revenue. Okay, so you have to see at what point has risk and rewards been transferred, at what point has been the risk and rewards been transferred. If there are warranties, warranties meaning you buy a product, the company gives a warranty that the product will function properly. Goods have been sold, revenue will be recognized, and provision will be made for warranties. Okay. Then, sale and repurchase agreement. Now, what does this mean? I have a car. I buy and sell cars. Today, I agreed to sell one car to you at 5 lakhs. And after 1 year, I agree to buy the car back from you at 5,50,000. Same car. This is the arrangement. Okay. Now, if this is the arrangement, what has happened is I have sold the car to you. I'll buy the car back from you at 5,50,000. I sold it at 5 lakh. When I sell it to you, you give me money. And when I buy back from you, I pay you back the money. Okay. Now, this could also have been a loan transaction. I give my car to you as a security. You give me 5 lakhs today. I use the 5 lakhs for a year and then I give back 5,50,000. So what the standard says is look at the substance. If the car has been sold, and again, if I'll buy back the car, means significant risk and rewards have not been transferred. And effectively, maybe I will be the owner, I will be the legal owner, I will be controlling how you use the car. Because in substance, I have given the car to you as a security. So here, buying and selling is not happening. Here, what is happening? Though I'm saying I've sold the car, it is more like I have given my car to you. You gave me 5 lakhs. It's like a loan transaction. I have taken a loan. After 1 year, I'll give you 5,50,000. So this becomes a financing transaction. This becomes a financing transaction. All right. So where a seller concurrently agrees to repurchase the same goods at a later date, it would amount to financing arrangement, and hence this will not be treated as. Then, if goods are sold subject to installation and inspection, I purchased an AC. The other party has agreed that the other party will come and install the AC. Only then the goods will be accepted. Then, in that case, revenue will be recognized only when the customer accepts the delivery and installation. Okay. Then, if there is something like a guaranteed sales or unlimited warranty, then in that case, what you have to see, what is the substance of the agreement? Okay. Generally, what you will do, you will recognize the revenue, but make a provision based on past claims. That is for guarantees, right? So when there is a sale of goods, what you have to see is, has the property been transferred? Has the risk and rewards been transferred? Has the title is not mandatory. Title is not mandatory, but still, has the title been transferred? And is there any uncertainty? If the property has been transferred, risk and rewards have been transferred, I don't have any control, and there is no uncertainty in relation to the consideration that will be received, then you can recognize revenue from sale of goods. All right. Then coming to rendering of services, this has a close relationship to Accounting Standard 7, which we'll take up subsequently. When we talk about services, for example, accounting services, security services, bookkeeping services, consultancy services, mobile phone services, all of them. Now, when it comes to services, you can recognize revenue either using proportionate completion method or completed service contract method. Okay, depending on the nature of the transaction. What is the proportionate completion method? For example, I have taken 1 year consultancy. I have taken 1 year consultancy from a particular company or a particular lawyer or a CA. Now, this 1 year consultancy comes to me at 1,20,000. Now, what I can do is every period, every month, I can say that the chartered accountant who has provided me the service, they can recognize every month 10,000 rupees as their revenue. Okay, that is one way. Or if, for example, I'm taking this live classes. Okay, we have agreed for 50 hours of live classes. It will exceed 50 hours. by about maybe 6 or 7 hours. 50 hours of live classes, right? Now, this 50 hours of live classes, let us say till 31st of March, only 20 hours have been completed and 30 hours will be completed subsequently. So what I should do, only 20 out of 50. So let us say if for simplicity of calculation, class price is 1000 for calculation purpose. So what I will do, 20 out of 50, that is 400, I will recognize in current year and balance I will recognize in subsequent period because I have only completed 20 hours. That is called proportionate completion method. Okay. Now, in proportionate completion method, we will recognize P&L proportionately with the degree of completion. How much has been completed? Now, construction also, when we come to construction contract, how much area has been completed? How much percentage of the work has been completed? Accordingly, the payment is done. Accordingly, the revenue is recognized. Right? Now, if there is a service, for example, just for example, I want to buy a particular customized software. Okay, that is a service that is being provided. Now there, only when the software is completed, installed, tested and all of that, only then the revenue can be recognized. That is used where it is a completed service method or completed service contract method. For example, auditing services. Now, if I'm doing the statutory audit, can I say every month you have to, I'll recognize revenue? No, you will recognize revenue only when the service has been fully completed. Now, completed service method is used when there is one act or which has to be completed. Proportionate is used when it is series of acts. Not only one act, continuous basis the performance is happening. Okay. Performance consists of execution of more than one act and revenue is recognized proportionately with reference to performance of each act. So, for services, you can use proportionate service completion method or proportionate completion method if there are series of acts. If there is only single act, finalization of accounts, lawyers related stuff. See, lawyer also depends. If it is monthly, then you can use proportionate completion method. If it is linked to one specific act, you can do completed service contract method. Telecom services and all. Okay, it is provided as a series. It is not provided as a single event. There you will use proportionate completion. Now, some examples: advertising agency. I run an advertising agency. So commission is recognized as revenue when an ad appears in the designated media. So I would have agreed. I will place 10 ads for which I will charge 20,000. Based on how many ads I have placed, I will recognize revenue. Now, another thing you have to keep in mind is as far as GST is concerned, the levy of GST and all of that will happen as per the GST provisions. Okay. Then insurance agency commission. So insurance agency commission again will be based on the effective date when we have issued or renewed. So whenever there is a renewal, I am entitled to the commission, I will recognize revenue. Okay. So that is as far as services is concerned. Then agency. So this also is typically tested in the examination as a question. Agency. For recorded classes provided, completed service method is used. No, again, there is proportionate. See, for recorded classes also, there is a validity. You purchase a class till May attempt, or you purchase a class till January attempt, right? So if you are purchasing till May attempt, let us say you purchase now till May attempt. So first 2 months, till 31st March, whatever is the period, this year, and for April and May in the subsequent. Okay, but let's say you purchase books. The moment the books are dispatched and the books are delivered, we are liable to deliver it to your doorstep. That time the revenue will be. Okay. Then agency relationship. So the agency happens when there is a principal and agent. Sir, what is principal agent? So principal, let us say, send goods to agent. The agent sells. Okay, generally you would have heard of consignment agent and all of that, right? Now, ownership is with the principal only. Agent does not get ownership. Agent doesn't get any control. Agent only has possession of those goods. Now, let's say goods are worth 1,000. Agent gets 2% commission. So when the agent sells it to the customer, the agent collects 1,000. 2%, that is 20, he will retain, and balance amount will be transferred back to the principal. Now, the revenue for the agent is only 20, not gross amount. So, whenever there is an agency relationship, The revenue is the amount of commission, not the gross inflow of cash receivable or other consideration. Okay, so the risk and reward remains with the principal. The control remains with the principal. The principal decides how much price is to be charged. The agent is merely acting as a facilitator. So agency commission will only be restricted to the amount of commission. This keeps on getting tested in the examination. Okay, then whenever we talk about something like interest is basically what you have given loan to someone. This will be used, recognized based on time. Royalties is charges for use of assets, and dividends is rewards from holding the investment. Okay. Now, interest basis of time, royalty based on usage, and dividend when there is a right to receive. When do we get the right to receive? When the company declares and it is approved by the board of directors in case of interim dividend and by the shareholders in case of final dividend. Interest on time proportion basis, royalties on accrual basis based on usage, dividend when there is a right to receive the payment. Okay, then whenever we have sale of goods and delivery is delayed at the buyer request and the buyer takes title and accept billings, we will recognize revenue. Sale on approval basis when it is approved. Goods subject to installation and inspection once it is accepted. Sale and repurchase agreement, we have to see if it is a finance part. Trade discounts and volume rebates, this will be reduced from revenue. Cash discount not reduced. Consignment sale, principal, gross value, agent, commission. And in case of consignment sale, revenue will be recognized by the principal only when the agent subsequently sells it to the customer. The key thing to ask is whether the risk and reward have been transferred or. Then effect of uncertainty is very, very important. What is the meaning of that? If there is any uncertainty related to, let us say, collection, then the revenue recognition has to be deferred. So if there is uncertainty regarding the ultimate collection of revenue, recognition is postponed to the extent of uncertainty involved. Meaning to say, I have entered into a contract with you. That you will pay me some specified amount every month. Okay, every month you will pay the specified amount. So what happened? In April, I recognized revenue of 10,000. In May, I recognized revenue of 10,000. In June, you have come up and said that the payments will not be made. Even the past payments will not be made. And even for June, the payment will not be made. Okay. Now what happens? April and May, I have already recognized revenue. Here I will create bad debt. June, there is uncertainty related to collection. So when there is an uncertainty related to collection, I will not recognize revenue. Sir, can we reverse this revenue? No. Revenue which has been recognized, you will continue to show it at revenue. Any subsequent changes in the circumstances, any subsequent uncertainties that have come, then you will recognize a bad debt. So when the uncertainty relating to collectability arises subsequent to the time of sale or the rendering of surveys, a separate provision is created to reflect the uncertainty rather than reversing the. This is very important. Questions have been continuously being tested from this dimension. Okay. Then AS9 does not deal with construction contract. Lease, this is covered by accounting standard 7. Lease agreements covered by accounting standard 19. Government grants and other subsidies, as we learn in accounting standard 12, and insurance contracts of insurance companies. Then some things which are not included in revenue, you have to keep in mind. One, gain on holding or disposal of non-current asset. Okay, so realized gain or unrealized gain, if at all there is any, on non-current asset. So let us say I have a building. For that building, I have used the revaluation model. And because of that, there is a gain. That gain is not called revenue. Or I have sold the building. The amount that I will receive from selling the building is not my revenue. Okay, only the loss or gain will be recognized as per accounting standard 10. Then unrealized holding gains from change in value of current assets and natural increase in agriculture and other product, not very important, but simple thing could be Inventory. I have inventory of, let us say, copper. Copper prices increase in the market. Can I say the increase in the copper price is my revenue? No. Only when you sell it, then I can call it a revenue. Realized or unrealized gains from changes in foreign exchange rates, adjustment arising on translation of foreign currency financial statements. This we have learned in accounting standard 11. So if there is a realized gain, I sold goods, customer has to pay me $1,000, dollar appreciated, rupee depreciated. So I am receiving more amount. Now, can this change in foreign exchange rates be considered as my revenue? It cannot be considered. Okay, then realized gains on discharge of an obligation at less than its carrying amount. I had to pay you 1,000. I settled the transaction at 800. The 200 is not my revenue. It cannot be called my revenue. Unrealized gain from restatement of carrying amount of obligation. If I have changed the provision value, liability value, these are not considered to be. Okay. So again, this particular standard is more of writing the answers. Okay, calculations very rarely they have asked. It is more about writing the answers. Yeah, in the September 24 attempt, there was a very good question on MCQ. Okay, how much of revenue should be recognized? That was good, but otherwise, fairly simple standard. 5 marks question. Delivery is delayed at buyer request, but buyer takes title and accepts billing. Already we have discussed. 1 mark. So what you have to do? You have to explain also. So how will you explain? If the delivery is delayed and the buyer requests, buyer takes title and access billing, revenue should be recognized notwithstanding that physical delivery has not been completed. So delivery is not the condition to be checked. We have to see whether the risk and rewards have been transferred. So before writing this answer, give a small explanation that revenue should be recognized when risk and rewards incidental to ownership has been transferred. As long as there is every expectation that the delivery will be made. However, item must be on hand, identified and ready for delivery to the buyer at the time sale is recognized. So this basically, you have learned in Sale of Goods Act also. You should not forget what you have learned. Okay. Same thing. So the goods have to be identified, risk and rewards have to be transferred. The seller does not have control. Now, seller does not have control means, for example, I have this pencil, just for example. Okay, this pencil I have identified with a particular serial number and I have said, okay, I'll buy this pencil. This has been kept aside. Now the seller cannot sell this pencil to anybody else. If the seller can sell this specific pencil to somebody else, then seller has control. So if it is identified, the seller should not have any control after the sale has been made. Installment sales. Now, in case of installment sales, what happens is you will receive amounts in installment, but the transaction, the property has been transferred, so revenue will be recognized. Trade discounts and volume rebates. Trade discounts and volume rebates are not encompassed within the definition of revenue since they represent reduction of cost. Trade discounts and volume rebates given should be deducted in determining revenue. Okay, received or given. So here they were not clear. Received is not revenue. Given should be reduced from revenue. Insurance agency commission, you will recognize only the commission portion, not the gross value, as and when the policies are issued or renewed. Advertising commission should be recognized when the service is completed. Okay, so this you can have a look at it. And you may not be able to write so much of content. Okay, this content itself will be around 1.5 page. But for every point, you should say whether revenue should be recognized or not, and why it should not be, or why it should or should not be recognized. This was asked as an MCQ for 2 months. Okay, here it is only for 1 month. On 15th of November, goods worth 5 lakhs were sold on approval basis. The period of approval was 4 months, after which they were considered sold. 15th November plus 4 months means December, January, February, March. So the cutoff date is 15th of March. Buyer sent approval for 75% goods up to 31st of January and no approval or disapproval received for the remaining goods till 31st of March. Now our period ends on 15th of March itself. So when the period ends by 15th of March, it is assumed that buyer has approved. So entire 5 lakhs should be recognized as revenue. Because the time period for rejecting the goods have expired, right? Then On 31st of March, goods worth 2,40,000 were sold to Bright Limited, but due to refurbishing of their showroom, on the request, goods were delivered on 10th of April. Delay delivery does not mean you have to defer the revenue recognition. If the risk and rewards have been transferred, physical delivery is pending, you can recognize revenue provided the goods are identified and the buyer has accepted the billing. So the entity should recognize the entire sale. Rainbow has supplied goods for 6 lakh to Sham Limited and concurrently agrees to repurchase the goods on 14th April. Now you have sold, you have agreed to repurchase, means control is not passed on. Effectively, it is a financing arrangement and hence no revenue should be recognized. Dew Limited used certain assets of Rainbow Limited and Rainbow Limited received 7.5 lakhs and 12 as interest and royalties respectively during the year 2021. So this should be recognized as revenue. Okay, how should you recognize the revenue? This interest on time basis, royalty on accrual basis. On 25th December, goods of 4 lakhs were sent on consignment basis, of which 40% of the goods unsold are lying with the consignee as at year end. So 4 lakhs into 40%. This is 1,60,000. This 1,60,000 is still lying. So how much has been sold? 60% has been sold. That is 2,40,000 has been sold. So 2,40,000, if it has been sold, you can recognize revenue up to 2,40,000. 5 marks. Such a simple question. Okay, this one, 5 marks question. A Limited sell goods with unlimited right of return to its customer. The following pattern has been observed. So generally what happens is if there is a right to return which is unlimited kind of a thing, then and for all the customers you are giving, you make an estimate of how much returns are expected. Okay. Time frame of return from the date of purchase between 0 to 1 month, 6%, between 1 to 2 months, 7%, between 2 to 3 months, 8%. The company has made sales of 36 lakhs in the month of January, 48 lakhs in the month of February, and 60 lakhs in the month of March. The total sales for the financial year have been 400 lakhs and the cost of sales was 320 lakhs. You are required to determine the amount of provision to be made and revenue to be recognized as on 31st of March. So actually, this includes AS 29, but we can quickly, discuss what is the value. So now sale value, January is 36 lakhs, February is 48 lakhs and March is 60 lakhs. Right? Now, what is the likely return? Between 0 to 1 month, 6%, 1 to 2 months, 7%, 2 to 3 months, 8%. And we are talking about what? 31st of March. Okay. So, let's erase this part. So sales is 60, 48 and 36. I don't know what happened. 60, 48 and 36. So sales that have been made in January 36, February 48, 60. So if you look at the total sales comes to 144 lakhs, right? Now, the period of return, what they're saying is how much return will happen within 0 to 1 month, 6%. So sales that are made in March of 60 lakhs, you will get 6% return. So likely return is 3.6 lakhs. Likely return is 3.6 lakhs. Okay, then February sales made is 48. So total sales in the previous 2 months, that is from February and March, is 108 lakhs. And between 1 to 2 months, 7% sales are expected to come back. So 108 into 7%, you get 7.56. Then for January sales, 3 months have passed, right? January sales, 3 months have passed. So there is January, February, March, 3 months would have passed. So cumulative return is 8%. So 144 into 8% is 11.52. This is the likely return. Likely return is how much? 22.6 lakhs. That is the first thing. Second, total sales is 400, cost of sales is 320. So if total sales is 400, cost of sales is 320, your gross profit is 80. This is nothing but 20%. So 20% of profit is what is likely that you will not be able to receive, and hence you will make a provision at 20%. Okay, so profit, whatever is the profit portion, you should not recognize that profit because there is an expectation that you will have sales being returned or the customer will return the goods. Revenue to be recognized in respect of sale of goods is recognized fully at the time of sale, assuming that the company has complied with the conditions stated in AS9 relating to the recognition of revenue. So revenue will recognize accordingly. As per AS9, in a transaction involving the sale of goods, performance should be regarded as being achieved if the following happens. Property has been transferred, risk and reward have been transferred, no significant uncertainty. AS9 also provides that in case of retail sales offering a guarantee of money back if not completely satisfied, it may be appropriate to recognize the sale, but to make a suitable provision for the returns. So how much returns will happen based on that? Make a suitable provision. Therefore, 36 lakhs, 48 lakhs and 60 made in the month of January, February and March will be recognized at full value and revenue at 400 lakhs, and 20% that the profit that you will not be recognizing, that part will be provided as your provision. Sir, why not full reversal? See, what you need to understand is, if I sell goods worth 100 and if you come back with that goods after 1 year or after whatever is the period, if I give you goods worth 100, when you come back, I'll get the 80 of cost back. So basically the profit portion I should not be recognizing. That is the logic for making this provision of 20%. Okay, this is a typical question. Has not been repeated subsequently again, but it is a good question for practice and writing in the examination. Why did we take January 8%? Because January, February, March, 3 months portion, 8%, 7% and 6% reactor. This is again same trade discounts and all we have discussed. Delay delivery, sale or approval basis. So here, one student had a question, not this one, in September 24 examination when I did the MCQ. The question said 3 months. Now, should we, if goods are sold on 1st of January, 3 months period, does it end on 31st of March or 1st of April? Okay, that was the confusion. Typically in businesses and all, when you say 1 month or selling on the 1st of the month, it will end at the last day of the month as 1 full month. Okay. Technically speaking, it can end on 1st of April also. I'm not disputing that, but that is how generally you will take the assumption when you write the examination. Okay, so again, similar concepts are being tested time and again. Important in this particular chapter and accounting standard 4, accounting standard 5 and accounting standard 9. Theory is very, very important. What you write as the explanation is very, very important. So what do we need to learn for that? What you need to learn for that is this condition of sale of goods, very important. Then services, they will not test frequently. How do you recognize interest, royalty and dividends? This is important. Then effect of uncertainty. Then how do you answer bill and hold transaction? For example, buyer request delay delivery, but accepts title and accepts the billing, accepts the title. In that case, what is to be done? If there is a sale on approval basis, then what is to be done? Now, one more thing what you have to understand is sale on approval basis is different from general return right that you are giving. Sale on approval basis means what? Only when you approve, I will recognize the sale. Sale with the right to return. You have accepted the sale, but I am giving you an unlimited right to return, kind of a warranty or a guarantee contract. In that case, you will make the provision for the return or the expected returns. Okay. So that is how you will do the questions. Go through all the questions in the study material and go through all the questions in the compilation that we are providing and also in the notes that we have provided. Any question you have on this, you can feel free to ask. But again, writing is very, very important, especially if you get those 5 bits, 2 bits, 3 bits, you should try to ensure that at least 2 of them are correct. If you get 3 bits, at least 2 of them are correct. Okay. Financing arrangement is also important. Sir, when will I get the access to last Saturday class in app? Law was conducted, accounting was not there. Okay, there was a communication issue from our side only. the file is being edited today or tomorrow. It should be available for law. Accounting class was not there. So please be in the group. I'll be posting messages if at all the class is not there. Okay, and accordingly you can access the class. Right? Any questions in this? No questions? Okay. So generally, I want to ask, we have covered so far a lot of standards. 2 is done, 4 is done, 5 is done. Okay, then 9 is done, 10 is done, 11 is done, 12 is done, then 16 is done, 19 is done, 22 is also done. Do you think your confidence has improved or increased, or these classes have been helpful in your preparation for the upcoming exams? I want honest feedback, okay? So that or you want me to say you ask me more questions, I'll do selected questions separately. That I don't want to mix it up here. But do you think that these classes have added decently to your preparation for the upcoming exams? You can type it out, or if you want to speak, I'm just you can unmute and speak also. Guys, you can speak. Okay, right. The discussion part with the students is not uploaded. Okay, doubts will be uploaded. All this towards end wala part will not go. Okay, great. Then one more thing. Okay, I'm teaching. You are attending the classes. If you are missing, you are going back and watching the recorded. That is perfectly fine. Your practice at your end is also very, very important. Okay, I will teach. I've been teaching this for so many years. I'll teach. I will explain shortcuts, how to understand, what to do. Practice is very, very important. And one other thing, what I want all of you to do is, don't aim for that 100% perfection. Everything I should know. This question bank, that question bank, this compiler, that compiler. Don't overburden yourself. If you see most of the questions, generally you'll be able to answer. Okay, with that confidence is how you should approach this thing. Not only in my subject, in any subject. Students who have tried to achieve 100% perfection, even I'm telling you, even those who have got ranks, they have not got 100% perfection. Okay, they have not got. Right? For example, just my example, I'll tell you. This question is there, right? Sale and purchase arrangement. We discussed just now. Where is it? The sale and purchase repurchase agreement. This was a question for 6 marks in CA final. It was not on concept, it was with some numbers, and I forgot the concept. Okay, so don't be too harsh on yourself that no, I should get everything, and I should understand everything. That should not be the idea. 90-95% are you comfortable with the subject? If that is there, examination you will be able to. Okay, so we'll conclude here and we'll continue tomorrow. Okay, sure. Thank you. So now AS20 again. There are few these are some of the standards that I have told in the beginning also, where there are specified set of questions. 90% of the questions are similar in nature, which are tested in the examination. AS20 is one such standard. If at all a question comes, you should not be scared. You should actually be solving for whatever steps you do or for whatever steps you solve. You will get stepwise marking, so you don't need to worry. Right now, when we talk about AS20, that is earnings per share, what this standard requires us to do, and this is a disclosure standard. Okay, there is no accounting entries done. So AS20, AS18, segment reporting, all of these are disclosure related standards where there is nothing talked about passing journal entries or recognizing some items in the financial statements. Now when we say EPS, which is earnings per share, the standard requires us to calculate earnings. Now when we say earnings, what is this? This is profit attributable to equity shareholders. We are talking about for every equity shareholder, how much is the company earning per year or per quarter. So it is always on a per share basis, and it is earnings attributable to equity shareholders. Two formulas you need to remember. when we come to diluted, we'll talk about diluted separately. So when we say earnings per share, the standard talks about calculating basic earnings per share and diluted earnings per share. Basic earnings per share and diluted earnings per share. When we say basic earnings per share, this is standard, this is normal for all the companies where it is applicable. It says what is the earnings available to equity shareholders divided by weighted average number of equity shares. Weighted average number of equity shares. So we need to know two things. Numerator is earnings available to equity shareholders. Denominator is weighted average number of equity shares outstanding. Now what is this earnings available to equity shareholders? We will start at net profit after tax. If it is given as net profit before tax, you have to calculate net profit after tax minus dividend payable to equity shareholders. Net profit after tax minus dividend payable, sorry, not equity, my bad, preference shareholders. So what is the net profit after tax? Let us say it is 10,000. Out of this 10,000, we have to pay, let us say, 4,000 to preference shareholders as dividend. So this 6,000 is what is called as earnings available to equity shareholders. Now when it comes to preference shareholders, there are two categories of preference shareholders. One, we say cumulative. Second one, non-cumulative. In cumulative preference shares, dividends accumulate even if not paid. In case of non-cumulatives, dividends do not accumulate. Dividends do not accumulate, right? So, cumulative dividends accumulate even if it is not paid. So, for example, the company has not declared dividend, but in the future, for the past years, you have to pay. That is what is called cumulative. For example, year 1, year 2, year 3. Year 1, for equity shareholders, no dividend was paid. For preference shareholders also, no dividend was paid. In year 2, no dividend was paid. In year 3, the company wants to pay dividend to equity shareholders. So, first it has to pay to preference shareholders dividend. Now, if it is cumulative, you have to pay the dividends for year 1, year 2, year 3. So, you will get dividends for all the 3 years. If it is non-cumulative, you will get dividend only for year 3. Year 1 and year 2 are gone. Now, how is it relevant? It is relevant because this dividend payable to preference shareholders, if the preference shares are cumulative in nature, then whether or not paid, please remember this line, whether or not paid, you have to deduct. Meaning to say, for cumulative, you will always deduct. Sir, why will we always deduct? We will always deduct because it has to be paid in the future. Whenever you pay to the equity shareholders, you have to pay. So you will always deduct this dividend attributable to cumulative preference shares. If it is non-cumulative, then deduct only when declared. Deduct only when declared. So, things what you have understood, you will take net profit before tax. You will reduce the preference dividend. For cumulative, always. For non-cumulative, when declared. Now, what is the rate to be taken? They will tell us. It is 10% cumulative preference shares. So, at 10%, you have to provide. Okay. So, that takes care of our net profit after tax minus dividend paid. We get earnings available to shareholders. Then the second component is weighted average number of equity shares. Weighted average number of equity shares. Now, what is the meaning of this? Generally, what happens is, if you take a timeline, this is the first day of the first month, this is the last month. Okay, here let us say 10,000 shares are outstanding. Somewhere here on 1st of July, the company issued 5,000 shares. Company issued 5,000 shares, right? So on 31st or in December, total shares you have is 15,000. Now, whatever earnings we have made is for the full year. Whatever earnings we have made is for the full year. But closing balance of shares is 15,000. If I divide the full profit, let us say 1 lakh profit. When I am saying profit, this is earnings available to equity shareholders. If I divide entire 1 lakh by 15,000, it does not give me a true picture because 5,000 shares came in between. So to these 5,000 shares, I cannot attribute full year's profit. That is why we need to do calculation of weighted average number of shares. How to calculate? There are two ways. You can use whichever way you are comfortable with. First method is first of January of, let us say, 25. Number of shares 10,000. These 10,000 shares are outstanding for 12 months. For full 12 months, 10,000 shares are outstanding. So, when you calculate weighted average, you will take 10,000 multiplied by 12 divided by 12, you get 10,000. Then, on 1st of July of 25, you have issued 5,000 shares. 5,000 shares. These 5,000 shares are outstanding only for 6 months period. Only for 6 months period. So, you will give the weight as 6 months out of 12. So, basically what we are saying is, if I have 5,000 shares on 1st of July, it is as good as 2,500 shares for the full year. So, this will be 2,500. The total becomes 12,500. This is the first method. Second method is using the cumulative basis. That is, 1st of January of 25, we had 10,000 shares. When did the next change happen? Next change happened on 1st of July. Next change happened on 1st of July. So what you will say, this is outstanding for 6 months. So weighted average number is 10,000 into 6 divided by 12. This is 5,000. Then on 1st of July of 25, this is cumulative. Cumulative shares became 15,000. Here, cumulative shares became 10,000 plus 5,000, 15,000. This 15,000 is outstanding for the next 6 months. This is outstanding for 6 months. So, you take 6 months for this. 15,000 into 6 divided by 12, you get 7,500. Total is 12,500. Are we clear with both these methods of calculating weighted average number of equity shares? Others, are we clear? Okay, great. Right? Now, when we calculate EPS, EPS is earnings available to equity shareholder divided by weighted average number of equity shares. So what is the earnings available? Here we have assumed it is 1 lakh. So it will be 1 lakh divided by 12,500. This will be 12 8s are 96, 4, 5, 8. So this will be 8 per share. So EPS is equal to 8 per share. Okay, this is the basic. Now, at least till here, basic earnings per share, whatever type of question comes, you should be able to do comfortably. Now, one more angle, if there is buyback, sometimes what happens is there is a buyback of shares. Whenever there is a buyback of shares, you will treat it as a negative number. Let us say minus 1,000. You just take it as negative number and do the calculation. Okay. Now, let us look at some theoretical aspects. So we have understood basic earnings per share. It is calculated as earnings available for equity shareholder and weighted number of equity shares outstanding during the period. Net profit after tax minus preference dividend. If there is a loss, then what happens? Let us say 500 is the loss, minus 2500 is the dividend. So it will be minus 7500. You are basically reducing. Okay. Now, this is where, which is important for calculating date or number of months. Okay, this part is very, very important, where there is sometimes a bonus issue, there is sometimes a rights issue, splits. How do we handle each of them? If equity shares are issued in exchange for cash, they are included from the date when cash is receivable. Now the meaning of that they are included is basically, if I issue shares on 1st of July, from 1st of July I will count the number of months. I'll count the number of months from 1st of July. So if equity shares are issued in exchange for cash, then when cash is receivable. If equity shares are issued as a result of conversion of debt instrument to equity shares, then date of conversion is relevant. Now what does this mean? This basically means that if I have convertible debentures, one fine day the holders of convertible debentures, they converted them into equity shares. So from the date of conversion, I will consider number of months for calculation of weighted average number of equity shares outstanding. Then equity shares issued in lieu of interest or principal on other financial instruments, they are included as of the date interest ceases to accrue. Meaning to say, if I give equity shares instead of interest, I have taken loan from the bank, I have to pay bank interest and principal. Okay. From the date on which the bank says I will no longer charge interest because I have received equity shares from you, from that date you will consider in weighted average calculation. Then equity shares issued in exchange for settlement of a liability of the enterprise are included as of the date the settlement becomes effective. If I have to pay a creditor, I don't have money, I give my shares. So from that date it becomes effective, or from that date you will include in the calculation. Equity shares issued as consideration for acquisition of an asset other than cash are included as of the date on which acquisition is recognized. If I issue shares to acquire property, plant and equipment, from the date on which I have made that acquisition of property, plant and equipment, the date I recognize the entry in the books, that is the date from which I will consider. Equity shares issued for rendering of services are included as the services are rendered. So if I'm taking some services and I'm issuing equity shares, as and when I get the service, as and when I recognize the expense, from that date I will include the equity shares for calculation. Then equity shares issued as consideration in an amalgamation in the nature of purchase are included as of the date of acquisition. So on the date I have made the acquisition, from that date I will consider. Equity shares in the nature of merger are included from the beginning of the reporting period. Generally not tested, but if it is in the nature of merger, you will assume in the pooling of interest method right from the beginning. Partly paid up shares are treated as fraction of an equity shares to the extent they are entitled to participate in dividend. Now what does this mean? Say for example, I have shares with face value 10, and out of these there are some shares which are paid up to the extent of 7 only. Some are fully paid up, some are partly paid up. Whenever there is a partly paid up share, so 7 means what? 70% paid up. So you will consider only 70% for the calculation of weights. Contingently issuable shares, which are issuable on satisfaction of certain conditions, are included from the date when the conditions are satisfied. If there is a contingently issuable shares, for example, I have acquired a business and I have told them that if your business makes profit of so much amount, then I will issue you more shares. The date when the conditions are satisfied, on that date I become liable to issue the shares. From that date I will consider for calculation of weighted average number of shares. Now here what you need to understand is, These are generally not independently tested nowadays because of MCQ. They may ask, but generally there is not much of testing directly on these concepts. But you need to remember what is the date from which I should consider. A quick revision: important ones: issued for cash, date when the cash is receivable; for convertible bonds or convertible debentures, date of conversion; when I am issuing in lieu of interest or principal, date when the interest stops; for settlement of liability, date of settlement; consideration for acquisition of an asset, date when the acquisition is recognized; amalgamation in the nature of merger, date of acquisition, purchase, date of acquisition; merger, beginning of reporting period; partly paid up, will take only proportionate. Then the next thing is bonus issue. Next thing is bonus issue. Now, what is this bonus issue? You issue shares for no consideration. So basically, there is no money that has come into the business. There is no fresh money that has come into the business. Same also applies with split. So, if my profit is 10,000 in year 1, profit in year 2 is also 10,000. Number of shares 5,000. After bonus, number of shares 10,000. If I calculate EPS, here I'll get 2, here I will get 1. But this is not a right presentation because shareholders have not changed, new money has not been received, just have increased the number of shares. So what the standard says is, whenever there is a bonus issue, you will treat it as if it was done at beginning of the period and restate previous year EPS as well. Meaning to say, whenever there is a bonus issue or bonus, split of shares, you will assume that it has happened at the beginning of the period, and hence you will consider it full year outstanding for calculation of weighted average number of shares. And also the previous year EPS, which is 2, that also has to be restated. How will we restate that? Now here bonus is 1:1. Bonus is 1:1. That is, if original shares is 1, total new shares will be 2. That is, original 1 plus newly issued 2. So you will do 1/2. So here you will do 2 multiplied by 1/2 and you will put out the factor. Okay. This is 1:1. Sometimes it can be 1:4. 1:4 means 1 share for 4 issued. 1 share for 4 issued means for every 4 share I will give 1 more share. So then the multiplication factor will be 1:4 means old shares are 4, new shares are 5. So 4 divided by 4 plus 1, you will multiply it by 4 by 5. Okay, that is how you will do. Bonus issue, assume that they had occurred at the beginning of the reporting period, also split, and you will also impact the calculation of EPS of previous period retrospectively. Now, before moving on to rights issue, let us have a look at a couple of basic questions and then we will continue. In April 2010, A Limited issued 18 lakhs equity shares of 10 each. Rupees 5 per share was called up on that date, which was paid by all the shareholders. Remaining 5 was called up on 1st of September. All the shareholders except one having 3,60,000 shares paid the sum in September 10. The net profit for the year is 33 lakhs after dividend on preference shares and dividend distribution tax of 6.6. Compute the basic EPS for the year ended 31st March of 2011 as per accounting standard 20. Right. Now first what you have to do, we have to calculate the weighted average number of equity shares outstanding. Now first thing, whatever is opening balance 18 lakhs from 1st of April 18 lakhs, right? Now here, what you need to understand is, on this 18 lakh shares, till 1st of September, amount paid is only 5. Amount paid is only 5. So if I draw a timeline, please pay attention. If I draw a timeline, April, September, March. From April to September, number of shares outstanding is 18 lakhs, but this is only 5 paid. That means we have received only 50%. So what you will do, you will apply the weightage 5 by 10 when you calculate weighted average number of shares outstanding. Okay. Now, sir, can we say 18 lakhs was outstanding for the full period and can we take the full amount? No, that calculation will not work. Here you have to see how many shares are there and to what extent it is outstanding and what is paid up. So, 18 lakhs, amount paid is 5 per share. So, 18 lakhs multiplied by 5 by 10. This 5 by 10 represents 50% paid up into 5 by 12. Why into 5 by 12? April, May, June, July, August. Now, very careful. Just because they have given 1st of September, sometimes what students do is April, May, June, July, August, September, they'll take 6 months. Please be careful in counting. We cannot make counting mistakes in the examination. Okay. So, 5 months, 5 by 12. So, 18 lakhs into 5 by 10 into 5 by 12, we have 3 lakhs 75,000. Right? Then, what happened? On the same 18 lakh shares, we got 5 more rupee. But we did not get from everyone. We got from only how much? We got from 14 lakh 40. Basically, 18 lakhs minus 3 lakhs 60,000. We got 14 lakh 40,000. This is the money we have received. So 14 lakh 40,000 paid us full amount of 10. And this part is outstanding for 7 months. So 1440 into 7 by 12, 8 lakh 40,000. Then on 1st of September, the balance 360, if you consider, only 5 was received. So here we'll apply 5 by 10 into 7 by 12. Like this, you will calculate the weighted average. Now, other way to calculate the weighted average is split into 2 parts. 14 lakh 40,000 is one part. 3 lakhs 60,000 is the other part. 14 lakh 40,000 is the first part. 3 lakhs 60,000 is the other part. Now on this 14 lakh 40,000, what can we say? For the first 5 months, again the calculation will be same only. For the first 5 months, you will do two parts. 5 by 10 into 5 by 12. For the second part, 10 by 10 into 7 by 12. And for this 360, we can take 5 into 12 by 12. Okay. So what happens is 1440 into 5 by 10 into 5 by 12. Then this is the second part, and 360 only 5 is paid for the full year. So that also is an approach which you can consider. Now after calculating this, the total comes to 13 lakh 20,000. Then earnings available to net profit for the year after dividend on preference shares and dividend distribution tax. So they have directly told us profit after dividend. This means this is my earnings available to equity shareholder. So what will I do? 33 lakhs divided by 13 lakh 20,000. The number comes to 2.5 per share. Okay. Simple question. Again, 4 marks or 5 marks, easily scoreable. And also now institute what they have done in September, and what I think they will continuously do is they will ask you MCQs where you have to calculate only the weighted average number of shares. Okay, so that thing you can keep in mind. This you can practice on your own. I've already done this. Only thing is when there is a buyback, but here buyback has happened on 31st of March. So when it has happened on 31st of March, there is no impact of that. Otherwise, you will treat it as a negative number. Just give me a moment. We'll pick up the compiler also. Both these files are available, the notes also and the compiler also, both of this is available in the resources section. And if you have not joined the WhatsApp group, please join the WhatsApp group. The link is also given in the dashboard. Okay, under my courses you will get the link. Okay, let's see this. Oh, this is a rights, we will do it after rights. So this is just now what we did, right? Okay. So what we'll do is we'll do the rights one first, and then we'll come to more questions. Okay. Now, rights issue is the issue of shares when the shares are issued to the existing shareholders, generally at less than market price. Now, understand the logic. Understand this underlying logic, why we calculate it differently. We are saying it is issued at less than market price. So, if market price, for example, is 100, I may issue at 80. I may issue at 80. Now, what I'm saying is the market price is 100, I'm issuing it at 80, means I am giving some shares for free. I am giving some shares for free. So, there is definitely a bonus element in rights issue. Meaning to say, if I had gone to the market, and if I had issued the shares, I could have issued at 100. But to my existing shareholders, from my existing shareholders, I am collecting only 80. Now, if I am collecting only 80, I am giving some shares notionally for free. For example, if let us say 5 shares are issued in rights, so amount collected is how much? 80 multiplied by 5, that is 400. If I had gone to the market against 400, I would have given only 4 shares. So technically I am giving 1 share for free. So that is why there is a bonus element in the rights issue, and that we will do a full year adjustment. I'll not get into the depth logic of this because that is not our objective, right? What we'll do is we'll see step by step what is the approach to solve questions involving rights issue. First thing, whenever there is a right issue, you have to calculate something called as theoretical X rights price. Now, what is the meaning of this? There is something called as come right price. Means this is the price before the rights issue. So when I say come right price, it means cumulative or including the right entitlement. Okay, they'll give us cumulative right, right price. Let us say this is 100. This is 100. Rights issue is 1:5. Meaning to say, I will get 1 right for 5 shares. I will get 1 right for 5 shares. So, if you see my total investment, if I have to subscribe to this, right, I can buy shares at 100. How many shares do I need? I need 5 shares for 1 right. So, I have to buy 5 shares from the market. 100 multiplied by 5. This is my investment for original shares. Plus, I have to pay for 1 right share. Let us say rights price is 80. For 1 right share, I have to pay 80. 180 multiplied by 1. And now I have a total of 6 shares. This is 5 plus 1. This is 5 plus 1. So, 100 multiplied by 5, this is my original investment. 80 plus 1, this is my new investment. Divided by original shares plus new shares, what I'll get? 500 plus 80 divided by 6, which is 580 divided by 6. that is 6 7s are 56, 2 6 3s are 18 to 73.33. 580 divided by 6, no, not 70, 6 9, 9s are 54, 40, 6 6 are 36, 96.66. 96.66. This is called theoretical X rights price. Meaning to say, in theory, after the right entitlement gets over or after the rights issue get over, then the price will be in the market. The price should come down to 96.66. It should come down to 96.66. I started at 100. I subscribed to new shares at 80. My theoretical exercise price becomes 96.66. This is the first step when it comes to rights issue. This is the first step when it comes to rights issue. Okay. Now, in the examination, you can use the formula, or if you get confused with the formula, just see what is my existing investment plus new investment divided by total shares. Existing investment plus new investment divided by total shares. Are we clear? Theoretical exercise price is fair value per shares prior to the exercise of right plus proceeds divided by number of shares outstanding plus number of right shares. Or you can say current market price into n plus rights issue into 1 divided by n plus 1. Multiple ways to derive. Okay. What you have to do is use the method that you are comfortable with. Okay. Now, as I told you that there is a bonus element. There is a bonus element in a rights issue which is given by fair value per share prior to exercise of right divided by theoretical X right price. Fair value per share prior to right divided by theoretical X right price. This will be the right adjustment factor. You will multiply the number of shares by this right adjustment factor to arrive at the total number of shares before the rights issue. That is basically, when you do this, fair value per share was 100. After that, it became 93. So I am increasing the number of shares. Basically, what I am doing is I am adjusting for the bonus element by using this formula. Okay. Now, we'll take one question, and once we do that question, you will have more comfort in this. Okay. Here, Sapphire, again, see, 5 marks question. Okay. Sapphire Limited earned net profit of 39 lakhs and rupees 59 lakhs 40,000 for 21, 22, 22, 23 respectively. Okay. The following information were given for 22, 23. Company declared rights issue of 2 new shares for each 5 outstanding share. 2:5. Now here, while doing the calculation, we will consider 2, not 1. 4 lakh shares were outstanding prior to the rights issue. Rights issue price was 27.5 and the last date was 1st of July. Fair value immediately prior to exercise was 143. Now what you have to do? First, calculate theoretical X-right price. This is the first step you should be doing. How to calculate theoretical X-right price? Existing shares 5. Existing shares 5 multiplied by fair value 143 plus 2 multiplied by what is the rights issue? 27.5, very less, divided by 5 plus 2. So this will be 5 multiplied by 143, 715 plus 54, 55 divided by 7. 715 plus 55 is 770. 770 divided by 7 is 110. So this is 110. Okay. Now here what they have done is they have taken total number of shares. Can we take total number of shares and do? Of course you can do. You can take total number of shares and you can do that as well. Okay. So first step is done. Then second adjustment is, or second calculation is the adjustment factor. As I told you, always greater than 1. So fair value divided by theoretical X rights price. What is the fair value? 143. X right price 110. 143 divided by 110. 143 divided by 110. You get 1.3. 3. Now, after that is done, we need to calculate basic earning per share for 21-22 and 22-23. For 21-22, what you have to do is, for number of shares, you will take 4 lakhs multiplied by 1.3. To calculate the number of shares for 21-22, you will take 4 lakhs by 1.3. Or what you can do is, for 21-22, EPS original is equal to 39 lakhs divided by 4 lakhs. That is 39 divided by 4, 9.75. This is the originally reported EPS. This 9.75 to restate, what you can do? You can do 9.75 divided by 1.3. So 9.75 divided by 1.3, if I do, I get 7.5. Or what you can do? You can change the number of shares like this, 4 lakhs into 1.3, and do this calculation. So EPS originally reported 9.75, restated EPS 7.5. Now what about 22-23? For 22-23, to calculate weighted average number of equity shares, original equity shares 4 lakhs multiplied by bonus adjustment factor 1.3 multiplied by 3 divided by 12. Why 3 divided by 12? April, May, June. This is one number. Then after the bonus issue, after the rights issue, 4 lakhs plus how many shares? 2 for 5. So new shares is equal to 4 lakhs into 2 divided by 5. That is 5 8s are 40. You get 1,60,000. This 1,60,000 is 1,60,000 plus 4 lakhs. 5,60,000 is outstanding for 9 out of 12 months. So 4 lakh into 1.3 into 3 divided by 12, that is 4 lakhs into 1.3 into 3 divided by 3, 4, 4, 1. 1 lakh into 1.3, 1,30,000. Then 5,60,000 into 9 by 12. So this is 3, 4, 560 into 9 by 12. $4,20,000. This will make it 5,50,000. So EPS will be 59,40,000 divided by 5,50,000. The number that you get here is 10.8. Okay. So to recap the steps: first, calculate theoretical X rights price, that is existing number multiplied by fair value or market value plus new multiplied by rights price divided by existing plus new. Second, right adjustment factor is equal to fair value divided by theoretical X rights price. Then third, weighted average number of equity shares is equal to first existing number of shares multiplied by right adjustment factor multiplied by, let us say, 3 by 12 in our case. It could be 5 by 12, 4 by 12, whatever it is. Then existing plus new multiplied by 9 by 12. For previous year, divide reported EPS by right adjustment factor or decompute. Are we clear with this? Any doubt in the calculation of theoretical X right price, right adjustment factor, and how to handle the question? Never mind, sir, I made a mistake. It's okay. See, even I did an error in calculation, right? First time. It happens. The idea is not to make these mistakes in the examination. Simple calculation mistakes, simple counting of month mistakes. Such things we should not do. Okay. You see, if the question itself is very, very different, very, very difficult, we can't do much about it. But these type of questions, if there is, so what I'm trying to tell you here is, if there is a question on rights issue, you should be happy that you will be able to score 5 out of 5 in that. That is our idea. Okay, right from day one, we have been focusing towards this to ensure that we get 60 marks in advanced accounting at least. Anything above that will be a bonus for you. Okay. See again, November 19, 5 marks. Same question. Rights issue, prior 50 lakhs, current year 75 lakhs. So calculate the theoretical strike price, originally reported, restated, and the new weighted average. Okay. Now, the next thing that we need to understand, and that is the only difficult part here is diluted earnings per share. Now, I want you to understand the logic why it is diluted, when it is not diluted, and then we'll do. What is diluted earnings per share? Basically, diluted earnings per share is when there are new shareholders who can come. Okay, I'll give an example for this. Let us say 4 friends are partying. You are partying. For the party, you have purchased 1 liter of drinks. Okay, you have purchased 1 liter of drinks. Now, if 4 of you are there, each one gets 1000 ml divided by 4, which is 250 ml. Okay, each one of you will get 250 ml. Now, say for a moment, one more of your friend who was not certain who may come, who may not come, he comes or he may come. Okay, if one of your friend comes, now you have 5 friends. What happens is you get 1000, now by 5, 200 only. Earlier you are getting 250, now you are getting 200. Your number has come down. This is called dilution. This is called dilution. But say for example, this new friend who came, that one friend who came, he got 500 ml bottle with him. He got 500 ml bottle with him. Then what happens? 1500 divided by 5, each one of you get 300. Here your share has increased. So when your share has increased, it becomes anti-dilutive. When your share has decreased, it becomes dilutive. When your share has increased, it becomes anti-dilutive. When your share has increased, it is anti-dilutive. When your share has decreased, it becomes dilutive. Okay, this is the concept of dilution of share. Now, these are day-to-day life. In real life, what happens is there are something called as potential equity shares. There are potential equity shares. So, what are these potential equity shares? These are the shares which can become equity shares in future. Now, the investors, they want to know that if these shares become equity shares in the future, what will happen to my earnings? Like in your case, when your friend came, what happened? When your friend came, your share reduced. Like this, the equity shares want to know if there are convertible preference shares or convertible debentures. If at all they come, what will happen to my earnings per share? That is what they want to know, and for that purpose we have to calculate diluted earnings per share. Now the way it works is, let us say earnings available to equity shareholder is 1 lakh. There are 10% convertible preference share. This is worth 1 lakh of face value 10. Okay. Now 1 lakh number of preference, value of preference shares. 10% is the dividend. Face value is 10. And let us say number of equity shares is 2 lakhs. Number of equity shares is 2 lakhs. Now, what is my basic EPS? My basic EPS is 1 lakh divided by 2 lakhs, that is 0.5. Now, assuming these preference shareholders, they get converted to equity shares, what will happen? Sir, what is the conversion ratio? Assume 1:1. Assume 1:1. How many shares are here? We have 1 lakh divided by 10, 10,000 shares are here. We have 10,000 shares. So, if they are converted, what happens is, earnings available to equity shareholders will become, see right now we have 1 lakh as the earnings. If they convert, we don't need to pay them dividend. While calculating this earnings available to equity shareholders, we had reduced preference dividend. Now we don't need to pay that dividend anymore. That is our savings. So our earnings will be 1 lakh plus 10,000 of preference dividend that has been saved, divided by, what are the number of shares? 2 lakhs, plus we'll get 10,000 more shares. Now this will be 1 lakh 10,000 divided by 2 lakh 10,000. So if you do the calculation, one lakh 10,000 divided by 2 lakh 10,000, it is 0.52. Oh, so when the preference shares got converted, earnings per share actually increased. So this is called anti-dilutive. So what could be the scenario when it is dilutive? Assume for a moment earnings available to equity shareholder was not 1 lakh, but it was 3 lakhs. So basic EPS is equal to 3 lakhs divided by 2 lakhs. This is 1.5. Now, after conversion, earnings available to equity shareholder is equal to 3 lakhs, our basic earnings, plus 10,000 of dividend saved, divided by 2 lakhs 10,000. This is 310 divided by 210, it is 1.47. Now what happened? Earlier it was 1.5, now it has come down to 1.47. This is called diluted EPS. Please remember, diluted EPS is reported. It is reported only when the earnings per share actually reduce. If the earnings per share actually increase, it is not called dilutive, it is called anti-dilutive or non-dilutive, right? So that is the first thing. Second scenario happens when there are convertible debentures. Now let us say we have 10% debentures of 1 lakh. Okay. Interest is 1 lakh into 10%. 10,000 of interest is payable. 10,000 of interest is payable. Right. Now when 10,000 of interest is payable, if these debentures get converted, I will save interest. When the debentures get converted, I will save interest. But the moment I save interest, I have to pay tax on that. Because when I save interest, my income becomes higher, I have to pay tax on that. What is the tax? Assume tax at 30%, tax is 3,000. So 10,000 of savings, 3,000 of tax, net savings is only 7,000. So we have to see what is the after tax savings. How to calculate that after tax savings? Interest into 1 minus tax rate. Interest into 1 minus tax rate. So whenever we are calculating diluted earnings per share, you will take earnings available to equity shareholders as per basic earnings per share plus what? Any savings after tax. For preference dividend, tax is not relevant because we don't have any tax payable on preference dividend. Okay. Then sometimes there may be share options. Now, whenever there are share options, these share options also create diluted EPS. And here, there is no savings. Here, there is no savings that you will see. So, whenever there are share options, first you will take share options, then in the order of dilution, you will consider the remaining options. For example, dividends and your interest. Now, how do we do that? How to check order of dilution? First, if there are any options, this is the first thing. It is first thing because in case of options there is no savings. We will give some shares for free, and to that extent it will be diluted. Okay. Then after that, what you do? You compute incremental EPS per share. What do I mean by that? For example, preference dividend or preference shares, not dividend. Preference shares. What is the savings? Savings was 10,000. What are the number of equity shares? 10,000. So savings divided by 10,000, 10,000 divided by 10,000, it is 1. For debentures, savings was 7,000 and assume the number of shares are 1,000. Number of shares means after conversion, how many shares do we have? After conversion, how many shares do we have? So 7,000 divided by 10,000, this is 0.7. This is 0.7. So here incremental EPS is 1, incremental EPS is 0.7. So this becomes dilutive. This is also dilutive, but you will take this as the first preference, this as the second preference. So first you will consider impact of debentures, calculate diluted EPS, then consider preference shares, and then calculate diluted EPS. Okay. Coming back to theory. Coming back to theory, potential equity share is a financial instrument or other contract that entitles or may entitle its holder to equity share. Examples: debentures which can be converted, preference shares which can be converted, share warrants, options including ESOPs, shares issuable on satisfaction of certain conditions from contractual obligation, etc. Okay. Right. Now, for the purpose of calculating diluted EPS, the amount of net profit or loss for the period attributable to equity shareholders is adjusted by following after tax. Dividends on potential equity shares which have been deducted in arriving at earnings available to equity shareholders. Interest recognized in the period for dilutive potential shares. Any other changes in income and expense. Generally, we get only the first two ones in the examination. For calculating diluted EPS, weighted number of equity shares outstanding and weighted number of equity shares which would be issued on conversion of all the dilutive potential equity shares are used in the denominator. Now the question is, from which period or when do we say or at what time have we issued those shares? So for conversions, it is deemed that they have been converted at the beginning of the period or the date of issue if it is later. Meaning to say, if this is 1st of April, this is 31st of March, they were issued here. Issued in the previous period, you will consider 1st of April as the relevant date. If it is issued during that period, you will consider from this date. Okay. Now, share warrants and options. This is one more calculation that we have to be aware of. So share warrant and options, they are dilutive when they would result in the issue of equity shares for less than fair value. How to calculate? Very simple. Let us say I have given 1,000 ESOPs, share options, which can be exercised at 100 per share. Which can be exercised at 100 per share. 1,000 ESOPs can be exercised at 100 per share. Fair market value of this is, say for example, 120. Fair market value is 120. How many have I given? 1,000. At what value? 100. So, amount collected is equal to 1 lakh. number of shares at fair value is 1 lakh divided by 120. 1 lakh divided by 120 is 12 8 is 96, 85, or 850. I'll cross check. I have been making this silly error. 1 lakh divided by 120. See, again made a mistake. Not 850. It is 833. 833.33. So, what we are saying is, whatever amount the shareholders have given us, how many full value shares can be issued? How many full value shares can be issued? We can issue 833.33 full value shares. Full value shares. Which means, out of 1000, 833.33 is full value shares and 167.67 are free shares. 1000 minus 833, 167.67 are free shares. So, for options and warrant, what you will do is, these free shares, you will directly add to the denominator. Free shares, you will directly add to the denominator. Okay, that is one treatment that you have to remember. Okay, so now we can directly jump into the question to calculate 2 or 3 varieties of diluted earnings per share. On 1st of April, ABC has given the following information: 50,000 equity shares of 100 each, 80 paid up by all shareholders, 40 lakhs. 2 lakhs 8% preference shares of 10 each, 20 lakhs. 10,000 12% of debentures of 100 each, 10 lakhs. This is the value of these. Okay, each debenture is converted into 3 equity shares of rupees 100 each. Preference shares, they have not told anything, so we'll assume those are non-convertible. On 1st of July, the remaining 20 was called up and paid up by all the shareholders except one shareholder holding 10,000 equity shares. During the year, the company had a profit after tax of 344, tax rate is 30, calculate basic and diluted. Slightly long question given 5 marks, but we can score 5 out of 5. First, basic. For calculation of basic, what do we need? We need weighted average number of equity shares outstanding and earnings available to equity shareholder. Now, what they have told us? The company had a profit after tax of 3,44,000. Now, for preference shares, have they told whether it is cumulative or non-cumulative? They have not told us. Had they told it is cumulative, we would have considered cumulative and done the treatment. Because they have not said whether it is cumulative or not, we will not consider. Okay, so for basic, it is very simple. We have to calculate weighted average number of equity shares. How to calculate? First, on 1st of April, 50,000 shares are outstanding, 80 paid. So, and the call happened on 1st of July. So, April, May, June, 3 months. So, when you calculate, 1st of April of 23, 50,000, amount paid is 80. So, what we will do? 50,000 into 80 by 100 into 80 by 100. Why 80 by 100? 80 is paid up into 3 by 12, 10,000 first. Then, on 1st of July, 40,000 paid, 100 fully, because 180 was already paid, 20 has been paid. So 40 into 100 by 100, so basically 40,000 into 9 by 12, 30,000. And on 1st of July 23, these 10,000 shares, they are paid us only 80. For the remaining 9 months, it is 6,000. Total becomes 46,000. The other way, what I told was, you consider 40,000 is 80 paid up for 3 months. Then 40,000 is 100 paid up for 9 months. Then 10,000 is only 80 paid up for full 12 months. So this also can be done. Okay, right? We got 46,000. So for basic earnings per share, net profit attributable to equity shareholders So this is, I think, a printing error in this question itself. It is not 344. Net profit is 344. Okay, we'll do considering 344, right? There is some error in calculation here. 344, I'll get it cross checked, divided by 46,000. That is 344, 123 divided by 46,000. We get 7.47. We get 7.47. Or if you say that this profit is before interest, before tax, then that's a different question. Then we have to do the actual calculation. Okay, that is the first. Then second is for diluted EPS. Now for diluted EPS, what do we do? Okay, so here they have assumed preference shares are cumulative. If you assume preference shares are cumulative, then it is 344 minus 160 divided by 1,84,000. Now I don't think there is any ground to consider that the preference shares are cumulative. I'll cross check this question with the actual question in the exam. Okay, but I don't see that this has been, there is no dividend declared. They have not mentioned it is cumulative, so generally it is considered to be non-cumulative if nothing has been mentioned. If it is cumulative, they have to mention it is cumulative preference shares. So what happens if you write, if you do this in the exam, you will get the marks, provided you write the assumptions clearly that the preference shares have been considered to be non-cumulative. If you consider preference shares are cumulative, 3,44,000 minus dividend, you get 1,84,000, and accordingly the EPS becomes 4 per share. And if you have time, you can do that, both the workings also. Okay, be prepared for questions having incomplete information where you have to make an assumption. For example, recently in AFM paper, what happened was they did not give the discount rate. 8 marks question, I think. 8 marks question, discount rate was not given, and you can solve only half the question without the discount rate. So what do we do in that situation? Assume discount rate is, let us say, 10% and solve the question. You may also get, I think in September paper, the costing question had some ambiguity. Okay, there also what you have to do, you have to assume and you have to do it. Okay, then for diluted EPS, what we'll do is we take earnings available to equity shareholders plus interest savings. Now what is interest savings? 12% debentures of 100 each, 10,000, 10 lakhs into 12% is my interest. So my interest is 1,20,000, but I have to take after tax. So savings will be 12 lakhs multiplied by 1 minus 30%, 0.7. So not 12 lakh, 1,20,000. 1,20,000 into 0.7, my savings will be 1,20,000 into 0.7, savings will be 84,000. So if I take 184 plus 84,000, I get 268. If I take 344, where was that? If I take 344, assuming preference shares are non-cumulative, then I will do 344 plus your 84. Okay. Then how many shares? 3 shares you can convert. So you have 10,000 debentures, 3 shares when you convert, you get 30,000 shares. So in the denominator, you will take 46,000 plus 30,000, 76,000, and then you will calculate the EPS, which is 3.53, or if you take 344, the pencil got disconnected. I'll just explain it orally and then I'll charge the pencil and we'll continue. Or you will take 344 or you will take 344 plus 84 divided by 76 and you will do. Now, sometimes what happens is, here you got 4. The EPS what they have calculated is 4, and here you got 3.53, it is diluted. Sometimes if this number becomes bigger, you will say the convertible or the potential equity shares are non-dilutive and hence diluted earnings per share is not to be reported. You have to make this statement. Only then you will get the marks. Okay. Okay. Then number 22, 5 marks. Following information is provided to you. Net profit for the year 72 lakhs. Weighted average number of shares outstanding 30 lakhs. Average fair value of one equity shares 25. Weighted average number of shares under option during the year 6 lakh shares. So this is about option. Exercise price for shares under option is 20. You are required to compute the basic and diluted. Now basic earnings per share is basically your net profit divided by weighted average number of shares. 72 divided by 30, 2.4. No problem there. How about diluted EPS? As far as diluted EPS, for options, what you have to calculate? Free shares. You have to calculate free shares. How to calculate free shares? First, number of shares under option, 6 lakhs. So you have to see what is the amount you will collect from here. 6 lakhs multiplied by 20, you will collect 6 lakhs multiplied by 20, you will collect 6 into 20, 6 into 12, 0, 0, 0, 0, and one more 0. Okay. One more 0. Okay. Amount. Number of shares at fair value is equal to 1.2 crores divided by, what is the fair value? Fair value is 25. So 25. Okay. 1 2 divided by 25, if I do, I get 4,80,000. This is the full value shares. This is the total number of shares. So dilutive shares is equal to 6 lakhs minus 4,80,000, that is 1,20,000. So dilutive shares are 1,20,000. Again I am repeating how to calculate. Take the total proceeds divided by fair value, that is the full value shares issued. Remaining shares we will assume is diluted. Right. Now to calculate diluted earnings per share in case of option, there is no adjustment required in earnings available to equity shareholders. There is no adjustment required in earnings available to equity shareholders. Whatever adjustment has to be done in the denominator only. What is to be adjusted? Take the weighted average number of shares as per basic earnings per share plus 1,20,000. You get 31,20,000. Okay, 31,20,000. So diluted EPS is 72 divided by 31.2, 2.31. Always remember, options are dilutive. Options are dilutive if they are issued at less than the fair market value. Okay. Any doubt in options calculation? This is important. Huh? Any doubt? Okay. This one. A listed entity on 1st of April had the following capital structure. See, for listed entity actually Ind AS is applicable. Okay, but anyways, we'll have to do as they have given the question. Okay. 10 lakh equity shares having face value of 1 each, 10 lakhs. This is the number. 10 lakh 8% preference shares having face value of 10 each, 1 crore. During the year, company had profit after tax of 90 lakhs. On 1st January, NAT made a bonus issue of 1 equity share for every 2 equity shares outstanding as of 31st December. On 1st January, they issued 2 lakh equity shares of 1 each at their full market price of 7.6. NAT shares were trading at 8.05 on 31st of March. Further, it has been provided that basic earnings per share for the year ended 31st March was previously reported as 62.3, that is previous period. You are required to calculate basic earnings per share to be reported in the financial statement before the year ended, including the comparative figure in accordance with AS 20. Explain why the bonus issue of shares and the shares issue at full market price are treated differently in the calculation of basic earnings per share. Now here, this part is straightforward. This is where they have asked more, technical part. Why should we do it? Now, first thing, why we should do it is, in case of bonus issue, shares are issued to existing shareholders for no additional consideration. Therefore, the number of equity shares outstanding is increased without an increase in the resources. Since the bonus issue is an issue without consideration, issue is treated as if it had occurred prior to the beginning of the period. Now, when I am issuing bonus shares, I am not getting any additional resources. Because I am not getting any additional resources, the earnings will not have a change. And when I am reporting, I have to report as if I have received those shares, or those shares have existed from the beginning of the period, because there is no change in the capital that I have invested. There is no change in the capital that I have invested. So if I have not invested anything new, my earnings will not change. So if I provide it comparatively only for the current period, it will not give a true picture. So that is why we restate from the beginning of the previous period reported. Whereas share issued at full market price does not have any bonus element and results in proportionate change in resources available. Means if I get money, my earnings will also increase. If I get money, my earnings will also increase, and hence I will not treat it as the same as the bonus element. Okay. Then how to calculate adjusted EPS? Now for adjusted EPS, what you have to do is, for the previous period, what are the total earnings divided by existing shares plus bonus issue. Existing shares plus bonus issue. Okay, so even in this question, they have taken these preference shares as cumulative. So I think I have to change my statement slightly. If nothing has been given, consider them to be cumulative. This is not the right approach, by the way. Though they have said it is non-cumulative, though they have not mentioned anything, assume it is cumulative and solve the question, so that there is no confusion in the examination. December 21, 5 marks. Net profit for after tax 64,12,500. Number of equity shares outstanding 15 lakhs. Number of 9% convertible debentures of 100 issued on 1st of July 75,000. Now, if you have issued on 1st of July, factor has to be considered from 1st of July only. Each debenture is convertible into 8 equity shares. Tax relating to interest expenses 35%. You are required to calculate diluted EPS. Now, for diluted EPS, you will take earnings, then you will adjust the interest. Interest is how much? 9% into 100 into 75,000. 75,000 into 9% into 100 into 1 minus 35%. Basically, that is how you will do the calculation. So, 75,000 is the total number of shares multiplied by 100, total number of debentures, 100 into 9%, that is 6,75,000, right, into 65%, we get 438. Oh, again, see, I missed this. 1st of July, so I'll do it again here. Interest savings is equal to 75,000 multiplied by 100 multiplied by 9% into 9 divided by 12. See, you have to be, I tell you and I only miss the date. 1st of July 2020, so 9 months. Okay, so the into 1 minus 35%. So this will be into 9 divided by 12, 3,29,062. Okay, so adjusted profit will be 64,12,500 plus 3,29,062, which is plus 64,12,500, which is 67,41,562. Right? This is the earnings. Now, in weighted average number of equity shares also, what you have to do is, you have to take 15 lakhs for full period plus how many debentures? Each debenture is convertible into 8 equity shares. 75,000 multiplied by 8, that is 6 lakhs. Okay, plus 6 lakhs. This also into 9 by 12. This we will not take it from the beginning of the reporting period. This we will take only from the date of issue. But if this was 1st of July of 19, then we would have taken from the beginning of the previous period. Okay, so number of equity shares is 15 plus 6 lakhs into 9 by 12, that works out to 19 lakh 50,000. Diluted EPS is 6741,562 divided by 1950, 3.46. Basic EPS was how much? Basic EPS is 6412,500 divided by 15 lakhs, 4.28. Now 4.28, and this is a reduction to 3.46, it is considered to be diluted. Sir, there was sufficient profit for preference dividend, so maybe they have assumed to be declared. See, practically it doesn't happen. Okay, so for example, I'll tell you. Of course, one is what you write in the exam, second is what you learn for real life. For exam, you can assume that, but like for example, we have issued compulsorily convertible preference shares. Compulsorily convertible preference shares. Okay, now I cannot say that this is a cumulative preference share. I have to specify that this is cumulative. Otherwise, how will I know whether it is cumulative or not cumulative? Anyways, by looking at the past two questions, we can assume that it is cumulative and accordingly solve the question. Because think of it, no? If I am not declaring dividend and it is a non-cumulative preference share, then there is no liability on my side to pay the preference shareholders. So that is the logic. This you can do it. This is again basic and diluted EPS on your own. This you can have a recap at it. Again, rights are standard. The rights issue are standard. So you can okay. Presentation. Basic and diluted EPS should be presented on the face of statement of P&L for each class of equity shares with equal prominence. So you have to disclose basic and diluted EPS, and also you have to compute it excluding extraordinary items and considering extraordinary items. This will not be tested. This is only for your remembering. What's the time? We are already at 11:40. So again, we'll pause here. Just wanted to check with each one of you. Can we extend the class timing by another half an hour so that we can complete it faster? See, there are other students who have taken, but they are watching on a recorded basis. You 4-5 of you are, Preeti I think joined today only. Others, Shamla and Ram, if you can confirm, so that we'll try to extend it because what is happening is one chapter I'm not able to see, 1.5 hours it took, right? In 20 minutes it will be a break again. So I want to extend it so that at least we can cover 2 chapters comprehensively, and now we'll be moving to the longer chapters of cash flow statements, financial statements and all of that. There also we need to spend slightly more time. Okay, right? So we will extend. Tomorrow we don't have a class, ICI election, so have to go out and vote and all of that. Monday onwards, we'll do 10 o'clock to 12:30. Okay? Sure. Thanks a lot. Hello students, I am CA Suraj and I have some amazing news for you. We have started a live fast track batch for advanced accounting with a target of scoring 60 plus in the examination, and we'll be conducting these classes on live basis. So it will be live class through Zoom. We've already started the session, and if you want you can still join in now. All the recorded sessions or all the completed sessions are available as a backup. The focus will be covering the complete syllabus, all the concepts of the entire syllabus in the live class in a quick manner so that you have comprehensive understanding, followed by some very important questions from study material, past exam papers and RTP. So the idea is to make you exam ready, so that without any problem you can score 60 plus. And I'll also give you tips how to maximize scores in these bigger chapters or bigger questions like financial statement, internal reconstruction, amalgamation and consolidated financial statements. In all of these chapters, there are few things which you need to keep in mind so that you get high marks in this particular questions. A lot of time what students do is, because they find a difficult question in consolidation, they will leave it. We should not make that mistake. Out of 14 marks, there are very easy ways to score at least 6 to 8 marks, even if you are not able to solve the full question. How to do that? I will be teaching that to you in the class and giving you how to handle MCQ in the examination, some tips to save time, some tricks to find out the answers very quickly. If you are looking for a fast track batch, I suggest you to have a look at the demo lectures which is given in the comment section. Have a look at it, and if you like the classes, do enroll for the classes. It'll be very helpful for you to prepare for your upcoming examination. Now, the next one, Accounting Standard 29, that deals with provisions, contingent liabilities and contingent asset. Almost every alternate term you will see one question that has come from this standard, and theoretical, but if you understand the background and logic of why we do certain things in this particular standard, it is actually easily manageable, so you don't need to worry about that. Accounting Standard 29 deals with provisions, contingent liabilities and contingent asset. Most important are these two. Before that, we need to know or understand the meaning of a liability. Now, you have been hearing about this term since the time you started learning accounting, right? So liability is, there is something which is there in present because of past, and something will happen in future. That is, there is what we say a present obligation. Obligation means something which you are supposed to do. You have an obligation, you have that responsibility, you have that burden which you cannot escape. If you can escape, then it is not a liability. Okay, so if you can escape something, it is not a liability. There is an obligation which you cannot escape, which is at present. At present there is an obligation. At present there is a headache. At present there is a liability, what we say. Okay, so as of today, let us say as on 31st of March of 25, there is an obligation. Why did this obligation come? Because of some past event. For example, you have occupied a building for 1 month. You have occupied a building for the past 1 month, which is a past event, because of which there is an obligation on your head to make a payment, which will happen in future, where you will see outflow of resources. So there is a present obligation which has arisen out of any past event, which will result in future outflow of resources. That is what we say is a liability. This is one definition you have to learn by heart. Okay, so that is one. Then if there is any liability, what we do, we recognize the liability in the books. That is very clear. There is rent outstanding, we will recognize. If I have to pay interest, I will recognize that. Okay, so whatever we do for the past event, whatever has happened, if there is an obligation as of today which will result in future outflow, we will recognize a liability. Now this standard deals with 3 items. One is provisions, which is related to a liability. Then there is something called as contingent liability, which is also related to the liability. And then it talks also about contingent asset. As far as contingent asset is concerned, it is very simple. There is nothing to break our head on. We have to be more careful about when do we say something is a provision or something is a contingent liability. That is what we need to understand, right? So liability is a present obligation of the enterprise arising from past events, the settlement of which is expected to result in an outflow from the enterprise of resources embodying economic benefit. If you cannot remember this as it is, you can simply say liability is a present obligation arising out of past event, and the settlement of which will require outflow of resources in the future. Okay, that is what is a liability. So then what is a provision? Liability which can be measured only by using a substantial degree of estimation, that is what is called a provision. So, provision is also a liability, but for the amount we need to make an estimate, that is when we say it is a provision. Now tell me one thing, this is a question for all of you. Is provision for depreciation covered under Accounting Standard 29? Is provision for depreciation covered under Accounting Standard 29? Yes or no? A simple question. Come on, future chartered accountants. Yes or no? It is not covered, right? Why it is not covered? Because when you say provision for depreciation, there is no liability. When you say provision for depreciation, there is no liability. So, provision for depreciation, it is not covered. Those who are saying yes, it is not covered. Provision for depreciation, provision for bad debt, that is for, the term used is provision, but it is not a provision as per Accounting Standard 29. For Accounting Standard 29, the provision has to be a liability, which can be measured by using a substantial degree of estimation. To give you a very simple example, warranty provision. I sell goods or I sell mobile phones, I provide warranty to the customers. In future, there may be warranty claims that may happen, for which I make an estimate and I create a warranty provision. That is called a provision. Okay, like that I may make certain provision for expenses where I don't know the exact amount of expense, but I can make an estimate. Okay, this is the amount of expense I need to incur for the past event, for which I create a provision. Okay, now we have understood the meaning of provision, we have understood the meaning of liability. Then here we said present obligation. So present obligation arises either because of a contract or statutory requirement, or also due to customs or practices. For example, a company has a practice of giving gold coins to every employee who completes 5 years of service. Every 5 years they give a gold coin. It is a customary practice, and every year they have been doing. So this creates an obligation. This creates an obligation. Same way, there can be a contract or a statutory requirement. What could be a statutory requirement? There could be a statutory requirement that you have to make payment of gratuity to all the employees who have completed 5 years of service. Now, that 5 years of service, whoever have completed, I need to make payment of gratuity. Now, if I have to make payment of gratuity, I need to make an estimate. Now, that's why we say provision for gratuity. Why? Because we are making an estimate. We will pay after 15 years. How much of amount has to be recognized today? We are using a substantial degree of estimation. That is why it is called a provision. Alright? Right? So, we have understood provision, we have understood liability. Now, what is a contingent liability that we need to understand? Now, contingent liability is two categories. There are two categories of contingent liability. One is, for us to simply understand, contingent liability is something which will happen in the future when an event which is not within the control of the enterprise either occurs or does not occur. For example, someone has filed a case against company. So we have, let us say, Apple and we have Samsung. Apple has filed a case against Samsung saying that you have violated my patents, you have copied my patents, so I am filing a case against Apple. Now, as far as Samsung is concerned, there is no present obligation. As far as Samsung is concerned, there is no present obligation. Okay, just a moment. As far as Samsung is concerned, I said Apple has filed a case. I might have forgotten. I'm just restating. Apple has filed a case against Samsung. As far as Samsung is concerned, there is no present obligation. Why? Because the case has not yet been decided. The case has not yet been decided. Only when the case gets decided, that is when we can say whether it is the obligation or not. So this kind of scenarios where there is no present obligation is called a contingent liability. So what is a contingent liability? Again, these two, you have to remember the definition. One is a possible obligation. It's a possible obligation that arises from past events and the existence of which will be confirmed only by the occurrence or non-occurrence of one or more uncertain events not wholly within the control of the enterprise. So here we said liability is a present obligation. Liability is a present obligation. Contingent liability, we are saying, is a possible obligation. It may happen in the future. It may happen in the future. But it may happen, but existence of which will be confirmed only when an event will occur or not occur. Or it is a present obligation. Second category. First category, it is a possible obligation. Second category, it is a present obligation, but it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Means I have an obligation, but I know I don't need to pay any amount in the future, or it is not probable. It is first category. Or a reliable estimate of the amount of the obligation cannot be made. Now, if you link this to the definition here, I'll just make a summary for all of you. If it is a present obligation and it is probable that outflow will happen, then this becomes my liability. I have to recognize the liability. Okay. Then if it is a possible obligation, if it is a possible obligation dependent on future events, then it becomes a contingent liability. Or if it is a present obligation but outflow is not probable, then also it becomes a contingent liability. Or if outflow cannot be estimated, then also becomes a contingent liability. So what is the meaning of this probable? Probable is more than 50% chance. Possible, less than 50% chance. So how do we understand in examination? If you see a question, first thing you have to see if whether it is a probable or a possible thing. Possible is less than 50%. Okay. And if it is present or not. So if it is present obligation and outflow of resources is probable, then it is a liability which you need to recognize, or it is a provision which you need to recognize. Provision is when you have to make an estimate. First thing. For contingent liabilities, there are three scenarios. First, it is possible dependent on future events. If something is possible but it is dependent on future events which may occur, which may not occur, that is a contingent liability. First thing. Second, it is a present obligation, means obligation is there but outflow is not probable. Outflow is not probable. In that case, it becomes a contingent liability. Or outflow cannot be estimated. Now, if I cannot estimate the amount, I cannot recognize or I cannot pass an entry for provision. So, in that case also it becomes a contingent liability. If it is probable that there would be outflow of resources and an estimate can be made, the entity will recognize the provision. So, if the moment you see that there is a probable outflow of resources and I can make an estimate, it will become a provision. Present obligation, its existence at the balance sheet date is considered probable, which is more than 50%. So, if it is greater than 50%, it becomes present obligation. Otherwise, it becomes a possible obligation. Now, when should we recognize a provision? We should recognize a provision when an enterprise has a present obligation greater than 50% probability as a result of past event, and it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. So greater than 50%, and a reliable estimate can be made. So there is a present obligation, outflow of resource is probable greater than 50%, and reliable estimate can be made. Then you say it is a provision you will recognize. Contingent liability. An enterprise should not recognize contingent liability. Not recognize means I cannot pass an entry. Provision I should recognize, liability I should recognize. I cannot recognize a contingent liability. We only need to disclose. Contingent when, again, if it is possible, that is less than 50%, or outflow is not probable, or estimate not made or cannot be made. When an enterprise is jointly and severally liable for an obligation, the part of the obligation that is expected to be met by other parties is treated as a contingent liability. So this happens in case of, let us say, there is a joint venture, 60% A, 40% B. If there is any liability, A has to pay 60%, B has to pay 40%. If B does not pay, A will have to pay 100%. So in that case, what you have to do is, A will record a liability of 60, and whatever is pertaining to B, there will be a contingent liability of 40. For example, you and I, both of us, we have started a joint venture. Okay, I am responsible for 60% expenses. You are responsible for 40% expenses. There is an expense of 100 to be met. I will record a liability of 60. That is my share. Remaining 40 is your liability. You will record. But if you don't pay, I have to pay. So there is a possible obligation that you will not pay the amount which I have to pay. So that becomes my contingent liability. So I will say 40 is my contingent liability. Same way for you, you will say 40 is my liability. If sir does not pay, I have to pay 60. So 60 becomes my contingent liability. Okay. So contingent liabilities are only disclosed. Then contingent assets. An enterprise should not recognize contingent asset. It is not disclosed in the financial statements. Contingent asset means what? Contingent asset means an asset, the existence of which will be confirmed on occurrence or non-occurrence of an uncertain event. For example, I have filed a case against some party. The case is not yet decided. If the case comes in my favor, I will make money. I will earn money. I will receive money. It is a contingent asset. Can I record it? No. Can I disclose in the financial statements? No. Only when the case is decided in my favor, I can record it as my asset. So, once it has become virtually certain that an inflow of economic benefits will arise, the asset and income are recognized in the financial statements. So far, any question? Okay. Now, we said we have to recognize a provision. Contingent liability should be disclosed, and contingent asset you should not do anything. Right? Now, when we say we have to recognize a provision, at what amount? Because provision, we said, is a liability which requires substantial degree of estimation. So we have to measure it. How do we measure it? Provision recognized should be the best estimate of the expenditure required to settle the present obligation at the balance sheet date. So it has to be using the best estimate. So sometimes what we do is, we will see some questions, we calculate expected value. When there are range of outcomes possible, we calculate expected value. Or sometimes we use most likely amount. When there are only two outcomes possible, we will use the most likely amount depending on the type of question. For example, case has been filed. Now case, the outcome is either you will win or you will lose. If we win, someone has filed a case against us. If we win, no outflow. If we lose, let us say 10 lakhs of outflow. Winning probability is 60%, losing probability is 40%. Winning probability is 60%, losing probability is 40%. Then what we will do? Then we will not recognize this because we are likely to win. It is it doesn't result in a liability. But if losing probability is 60%, means what? Greater than 50%. So outflow is probable. Outflow is probable. If there is an outflow, the outcome is 10 lakhs. So 10 lakhs has to be recognized as a provision. as we do questions, you will get more clarity on how to handle those numbers. Provision amount should be discounted to its present value in case of these liabilities that are recognized as per accounting standard 10. And how do we take the estimates? Judgment of management, past transactions, report from independent experts, and other evidence. Provision should be reviewed at each balance sheet date. Then reimbursements. Okay, I'm not, these are all simpler things, no need to worry about them. Reimbursement. Sometimes what happens is, say for example, I have incurred an expenditure which you have agreed to reimburse. I have incurred an expenditure of 100. You said you will reimburse 40, right? I'm not talking about joint venture. Now, if you reimburse 40, I have to incur an expenditure of 100. I have to recognize liability for full amount of 100. This reimbursement should be recognized as a separate asset when you confirm, when you agree that yes, you will reimburse. So, reimbursement of expenses by other parties should be recognized when and only when it is virtually certain that the reimbursement will be received if the enterprise settles the obligation. So, these happens generally in case of, let us say, insurance. Okay. So, let us say I have taken an insurance for accidents which happen in my factory. Okay. Now, an accident has happened. When an accident has happened, I have to compensate the workman. So, compensation for the workman is a liability which I will recognize separately. Insurance company, what they will pay me, once I am certain that the insurance company will pay me the amount, then I will recognize the asset. You cannot say my liability is 100, insurance company will pay me 60, so I will recognize only a net liability of 40. That is not allowed. Recognize full liability of 100. Asset you will recognize when the other party gives a confirmation that yes, we will reimburse you that particular amount. Reimbursement should be treated as a separate asset, very important. And the amount recognized for the reimbursement should not exceed the amount of provision. So that is of course a noted thing. Then sometimes we have a question on restructuring. Restructuring. Whenever an entity is committed to a restructuring program, it should recognize the liability or provision related to that. What is restructuring? Restructuring is a planned and controlled program by the management which materially changes scope of a business or the manner in which it is conducted. Some examples could be, let us say I have 100 branches. Okay. As a part of reorganizing and as a part of cutting cost and all of that, 100 out of 100 branches, I have said that I will close 40 branches. Now when I say I have closed 40 branches, what will happen? I have to pay employees some compensation. I have to cancel some contracts, there I have to pay some amount. I have to renegotiate terms with my customers, suppliers and all of that. So all of these activities will create a liability. So the moment I announce a restructuring program, the moment the restructuring program is communicated, any associated liability for that should be recognized. So example of restructuring could be sale or termination of a line of business, closure of business location in a country, relocation of business, changes in management structure, fundamental reorganization that has an effect in the enterprise operation. So, a restructuring provision should include any direct expenditure arising from the restructuring activities which are necessarily entailed by the restructuring and not associated with the ongoing activities of enterprise. What it basically means is, if I have announced the restructuring, because of which I have to terminate the employees, the termination part of the employees, the termination benefits of the employees should be recognized as a liability or a provision. Okay. Now, it may happen that we are on 1st of January, 31st of March and 30th of June. Okay. As on 1st of January, you have said we announce restructuring. Now, the moment we announce restructuring, it does not mean we'll close everything. Closure will take time. Closure is expected to complete it by 30th of June. Now, because of this restructuring, I have to give termination benefit to employees. This termination benefit should be recognized as a liability in this period itself. But the monthly salary that you will pay every month for operation, that has to be recognized in the respective month. You cannot say next 6 months salary is also restructuring provision. No. Only those things which you pay because of the restructuring activity, that will be recognized as a liability. Remaining part, the day-to-day operating expenses and all of that will be recognized as and when incurred. Okay, so that is part related to restructuring activity. Remaining things we have all discussed. Disclosures, you can have a look at it. This is more about solving questions and writing answers in the examination, and that is what will our focus be on. First, X Limited has its financial year ended 31st March, 15 lawsuits outstanding on this date, none of which has been settled by the time. Now, 15 lawsuits are outstanding. So what happens? There is an event which will happen in the future which will determine the outcome. So normally, the moment you see a case being filed, what comes to your mind? It says it is a contingent liability. But then we also need to see what is the probability. Okay. The directors have estimated the probable outcomes as follows. For the first 10 cases, there is a win probability of 0.6. There will be no loss. Low damages 0.3 is the probability. 90,000 is the outcome or the loss. This is per case. Then loss high damages 0.1, 2 lakhs. For the next 5 cases, winning probability is 0.5, 0. Loss low damages 0.3, 60,000. Loss high damages 0.2, probability 1 lakh. The outcome is independent of other cases. Discuss the treatment. Now here, first thing is, if it is probable that there will be outflow of resources, then only you can recognize a provision. Now here if you see 0.3, 0.1, is it probable? No, it is less than 50%. Here also it is not probable. So this has to be a contingent liability. How to calculate the contingent liability? Probable 90,000 estimate is 0.3. So 90,000 of loss probability is 0.3 multiplied by 10 cases. So like this, for every set of probability, we calculate expected value. Expected value is equal to amount multiplied by probability. So we give, how to answer? We give the definition of contingent liability and loss in the first 10 cases 90,000 into 0.3, 2 lakhs into 0.1 for 10 cases, and next 5 cases 60,000 into 0.3, 1 lakh into 0.2 for 5 cases. Now this is per case. For one case, your loss will be 90,000 into 0.3, that is one probability. 2 lakhs into 0.1, that is the second probability. So what about this 0.6? See, if it was a 0.6 kind of a scenario where we are winning the case, there is no outflow. There is no outflow. Okay. So if you are winning, there is no outflow. Only when we are losing, these are the outflow possible, and because it is not probable, we will recognize a contingent liability. Is this clear? Okay. Sham Limited provides consultancy and engineering services to its clients. In the year 1011, the government has set up a commission to decide about pay revision. The pay will be revised with respect from 1st of January of 2006 based on recommendations of the commission. The company makes the provision of rupees 680 lakhs for pay revision in the financial year 1011. When did we do? 1011. Okay. On the estimated basis, as the report of the commission is yet to come. As per the contract with the client on cost plus job, the billing is done on the actual payment made to the employees and allocated to the job based on work hours. Okay, so what has happened? On one side, I have to pay, and on the second side, I have to recover. Recover from whom? Recover from the client. The company makes the following disclosures in its notes to account. Salaries benefit include provision of 680 lakhs in respect of pay revision. Amount chargeable from the for reimbursable job will be billed as per the contract when the actual payment is made. The accountant feels that the company should also book the income of 680 lakhs in the P&L account as per the terms of contract. Otherwise, it will be a violation of matching concept. Comment on the opinion of the accountant. Okay. Now, what has happened here? First thing you have to say, do we need to recognize provision? Yes, provision is a liability which requires substantial degree of estimate. Now, as per the given facts and circumstances of the case, you will recognize the provision because you feel that there is an outflow of the resources. But this reimbursement asset, where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party. Reimbursement should be recognized when and only when it is certain that reimbursement will be received if the enterprise settles the obligation. So the keywords here that you have to note is reimbursement should be recognized when and only when it is virtually certain that the reimbursement will be received. This is what you have to mention very clearly. Okay. Now here they have not mentioned whether there is a certainty of reimbursement. They have not mentioned, but they have said billing is done on actual payment made to the employees and allocated to the job based on work hour. Has the actual payment happened? Actual payment has not yet happened. So if the actual payment has not yet happened, can I recognize the asset? I cannot recognize the asset. I cannot recognize the asset because I have not made the payment. So we should not recognize the reimbursement. The liability of 680 lakhs is matched by the client, but receivable towards the reimbursement should be recognized only if the ultimate collectibility is certain and only when it is virtually certain that the reimbursement will be received. In this case, there is no virtual certainty, so we should not be bothered about that. Okay. An airline is required by law to overhaul its aircraft once in every 5 years. The Pacific Airlines, which operate aircraft, does not provide any provision required by law in its final account, discussed with reference to Accounting Standard 29. Now, should we recognize provision for overhaul? Overhaul is like periodic maintenance. It's a huge maintenance activity which is required by law. Now, the thing is, whenever you have to recognize a liability, you have to ask a question: can I escape? Can I escape from the liability? Now, when will the liability come? After 5 years. Is it mandatory that I have to incur? Yes, provided you will operate. Now, can I escape? Yes, I can escape by selling the aircraft to somebody else. I can escape the liability by selling the aircraft to somebody else. So, because there is no present obligation, we will not be recognizing any provision for this. Okay. Now, this is very different from provision for dismantling and all that we create, because there, whether or not you are using the asset, you are required to remove that asset at the end of the life. So that's why you create a provision for dismantling provision. The following condition must be satisfied to recognize a provision. There must be a present obligation, probable that outflow of resources would be required, and reliable estimate can be made. This is there, but present obligation is not there. In the given case, there is no present obligation to service the aircraft. Cost of overhauling aircraft is a future obligation, and the expenditure would be incurred only if the company decides to continue the usage of aircraft. So, this should not be recognized. This is related to warranty. An engineering goods company provides after-sales warranty for 2 years to its customers. Based on the past experience, the company has been following the following policy to make provision for warranty on the invoices amount on the remaining warranty period. Less than 1 year, 2%, more than 1 year, 3% provision. Okay. Warranty is how much? For 2 years. Invoice date is so much. Less than 1 year. So if it falls in less than 1 year, you will give 2% provision. If it is more than 1 year, you have to make a 3% provision. Calculate the provision to be made for the warranty for 31st March 12 and 31st March 13, and the amount to be debited to P&L for the year ended 31st March of 13. So 31st March 12 and 13. Now how do we do? For 31st March of 12, one is this sale, this is the second sale. There are only 2 sales. Now, sale made on 19th of January of 2011, 40,000. Okay, how many years are left? That is how we have to see. Now, 19th of January of 2011, whatever you have sold, how many years are left? The number of years that are left is, so 11 to 12, 1 year is already over. So, you are left only with 1 year. So, if it is less than 1 year, 2% provision. Sale made on 29th January of 12, it is more than 2 years, so 3% provision. So, 800 plus 750, basically 40,000 into 2% and 25,000 into 3%, the provision should be 1550. This is liability closing balance. Okay. Then for 31st March of 2013, this 19th of January of 2011, whatever you have sold, 12 is gone, 13 is gone. So you don't need any provision for this. Whatever you have sold here, you need 2% provision, which is 500. Whatever you have sold here, you need 3% provision, which is 2700. So the liability should be 3200. The difference between this should be debited to P&L. So here what we are calculating is provision or liability balance at the end of each period, right? Now we'll see the actual exam questions. November 22, 5 marks question. This is what we have already discussed. Okay. So win probability 100%, 5 cases. Next 10 cases 50%. Lose 40%. So losing probability is 40%. Losing probability is 10%. So 40% into this, 10% into this. Similarly, loss probability that they have given, right? So only for that you have to disclose a contingent liability. How do you write the answer? Contingent liability should be disclosed if there is a present obligation, it is not probable that an outflow of resources will be required, possibility of outflow of embodying economic benefit is not remote. If it is remote, you will not even disclose contingent liability. If outflow of resources is remote, you will not even disclose the contingent liability, and the amount of obligation cannot be measured with sufficient reliability. So even if you write these 3 points, that is sufficient. In the case, probability of winning of the first 5 cases 100% and provision of loss does not arise. Probability of winning the next 10 cases is 50% and for the remaining 5 cases is 50%. As per AS 29, we make a provision if the loss is probable. As the loss does not appear to be probable and the possibility of outflow of resources of economic benefit is remote, therefore disclosure by way of note should be made. So do we need to reproduce exactly the same? Not required. If I was a student, what I would have written is, we will make a provision if the loss is probable. Here the loss is not probable and hence we will make a disclosure of contingent liability. And we will calculate by using the expected value method, which is 40% of 12 lakhs, 10% of 20 lakhs, then 30% of 10 lakhs and 20% of 21 lakhs. So accordingly we will do it. Okay. Now here 5 plus 10, 15 plus 5. So that is how they have given and total loss has been given here. Let's look at this question. Alloy Fabrication Limited is engaged in manufacturing of iron and steel rods. The company is in the process of finalization of accounts for the year ended 31st March and needs your advice. On 1st April, the company installed a huge furnace in their plant. Furnace has a lining that needs to be replaced every 5 years for technical reasons. At the balance sheet date, the company does not provide for provision of replacement of furnace line. Okay. Now, this is same like your overhaul example what we saw for aircraft. Same, right? Remote means very less chance. Remote means very less chance. So what we do? More than 50%, less than 50%, let us say less than 5%. Something like 5%, 6%, less than 10% you can put it. Remote, very, very unlikely chance. That is called remote. Okay, so this is similar to the airline example of overhaul that we have understood. So you will not do it. Second, case has been filed against the company in the consumer court and a notice for penalty of 50 lakhs has been received. Company has appointed a lawyer to defend the case for a fee of 5 lakh. 60% of the fees have been paid. Rest 40% will be paid after finalization of the case. There are 70% chance that the penalty may not be levied. Now, here what has happened? Someone has filed a case. 70% chance that the penalty will not be levied. Means it is not probable that there will be an outflow of resources. But is there a possible outflow possible? Yes. So what we will do, we will disclose a contingent liability for 50 lakh. Now the question is what to do with the fee of 5 lakh? The fee of 5 lakh, whether or not we win the case, we have to pay to the lawyer. Lawyer will not leave their fees, right? So you have to pay to the lawyer. If you have to pay 5 lakhs to the lawyer, that has to be provided for. Now out of this 5, 60 has already been paid. So for 40%, that is 2 lakhs, you have to create a provision in the books. So provision should be made for 40%. With reference to AS 29, how would you deal with the following? Company operates an offshore oil field where its licensing agreement requires it to remove the oil rig at the end of the production and restore the seabed. This is covered under AS 10 and AS 29. 85% of the cost relate to the removal of oil rig and restoration of damage caused by building it, and 15% arise through extraction of oil. At the balance sheet date, the rig has been constructed, but no oil has been extracted. First thing. Now here, 85% is for construction and 15% is for operations or extractions. So what you have to do is, whatever is the estimated cost, you have to split between 85% for construction, 15% for extraction. Construction is completed. So if the construction is completed, the provision for that has to be recognized. Extraction did not happen, so no provision is required for the cost of extraction. The 15% cost arise through the extraction of oil are recognized as liability as and when the oil is extracted. Right now there is no extraction, so there is no obligation, there is no expense to be recognized. As and when I extract, that 15% has to be apportioned on the basis of extraction. This we have already seen. Chaos Limited is in the process of finalizing its accounts for the year ended 31st March. It seeks your advice. Chaos Limited entered into an agreement to supply 1 lakh face masks to D Limited by 30th of April, failing which it will have to pay a penalty of 10 lakh per item not supplied. On 31st March, Chaos Limited assessed that it could only supply 50,000 face masks to D Limited by 30th April of 22. Then, Chaos Limited has filed a court case in 1415 against its competitors. It is evident that Chaos Limited may lose the case and would have to pay 3 lakhs being the cost of obligation. No entries have to be made. So 3 lakhs, even if you win or lose, you have to make a provision. A new regulation has been passed by the Healthcare Ministry to upgrade facilities. Deadline set by the government is 31st of March of 23. Company estimates that 10 lakh for the said upgrade. Give your answers with proper reasoning as per accounting standard 21. Now here, the first one, you have to supply 1 lakh face masks by 30th of April, failing which you will have to pay a penalty of 10 per item supplied. On 31st March, they have supplied only 50. They could supply only 50 face masks by 30th of April. Now, what happens here is, can we recognize a provision because the delay is, there is no further delay and delivery date is 30th of April. So, penalty will come in future only. Penalty will come in future only. Even if we estimate that the penalty has not yet been imposed, the due date is in the future. So, this becomes a future obligation. Because it is a future obligation, I will not provide for the expenditure. Okay. Then, second case, we have already discussed 3 lakhs cost of litigation I have to provide for. Third case, Healthcare Ministry has said that you have to upgrade the facilities. Now, when should I upgrade again? The deadline is 31st of March. Now, deadline is in the future. As and when I upgrade the facilities, I will incur the expenditure and I will recognize. See, if there is something like by 31st March, if you don't complete, then you have to pay a penalty. If the deadline passes and if I have to make a payment of penalty, then I should recognize for the provision. But here, the future, it is futuristic. The event itself is in the future. I should not recognize a provision. A company incorporated as NPO under the Companies Act is having main objective to promote the trade by organizing trade fairs exhibition. While organizing the trade fairs, it decided to charge 5% contingency charges for the participants on the income received from them by the company. While in case of fairs organized by outside agency, 5% contingency charges are levied separately in the invoice. The contingency charges in respect of fairs organized by the company itself are inbuilt in the space rent charged from the participants. Both are credited to the income and expenditure account. The intention of levying these charges is to meet any unforeseen liability which may arise in the future. The instance of such unforeseen liabilities could be on account of injury, loss of life, visitors, etc. So basically what they're saying is, so much of English, what they're saying is, we will charge 5% extra amount so that in case in future if there is any liability, if any fire occurs, accident happens, something happens, we can use that amount. The chance of occurrence of these events are high because of large crowds visiting the fair. The decision to levy 5% contingency charges was based on assessment only, as actual liability on this account cannot be estimated. The accounting treatment was made by the company as follows. 5% contingency charges are treated as income and matching provision for the same is also being made in the account. Suitable disclosures to this effect is also made in the notes forming part of the account. You are required to comment whether creation for provision for contingencies, considering the facts and circumstances of the case, is required in line with AS 29. Now here what is happening? Here What is happening is you are recognizing a provision for something which may happen in the future. Has the fire occurred? No. Has the earthquake occurred? Has the terrorist attack occurred? Nothing has occurred. So if nothing has occurred, how can you recognize a provision? So provision cannot be recognized because there is no present obligation. Sir, but I am collecting that amount. No, you are collecting that amount, but the obligating event has not yet occurred. So if the obligating event has not yet occurred, you don't need to create a liability. Neither a present obligation exists nor a reliable estimate can be made, and hence a provision cannot be recognized. Can we say contingent liability? That also is remote. See, if it's like every time it keeps on happening, then maybe you will disclose, or at the most you can make a disclosure of contingent liability, but provision cannot be recognized. Sorry. An oil company has been contaminating land for several years. It does not clean up because there is no legislation requiring to clean up. On 31st March, it is virtually certain that a law requiring cleanup of land will be enacted shortly after the year end. Is provisioning required? Now here, it is virtually certain that a law will be passed and we have to clean up the land. For that case, you have to create a provision. The company has not made provision for warranty in respect of certain goods, considering that the company can claim the warranty cost from the original supplier. Now, what is this? I am selling some goods to the customer. If there is a defect, I have to rectify the defect, and that amount I will claim from my supplier. Right? Now, there are two transactions. So this pencil is, anyways, so I'll just explain it to you. There are two transactions. I am selling to the customer, I am liable towards the customer, I have to create a separate liability for warranty provisions towards customer. What I will get from the supplier is a reimbursement. Reimbursement should be recognized only when it is virtually certain that the reimbursement will happen when I settle the obligation. So, applying these provisions, liability has to be created separately. Reimbursement should be recognized as a separate asset when it is virtually certain. Okay, so other questions also you can have a look at it, read all of them. The most important thing in AS 29 question is the theory part. Definition of provision, definition of contingent liability, definition of contingent asset, definition of liability. When do we recognize a contingent liability? If you are thorough with this, you will score good marks in accounting standard 29, right? So any questions? I don't think you'll have any question in this standard because it's more a logical standard. Reading patiently the questions is very, very important. Okay, so we'll conclude here and we'll continue tomorrow. Tomorrow we'll pick up financial statements. The remaining standards, which are a lot of disclosure standards and including AS 15 and all, we'll do it towards the later part, because AS 15 and all, I don't expect them to keep on testing frequently. Disclosures are more of remembering type of standards, which we'll do it towards the later part of the sessions. So the idea will be finish this, then take up the financial statements, finish up internal reconstruction, amalgamation, consolidation, then related associates, joint venture, then finish branch accounting and come back to the remaining standards. All right. So see you all tomorrow at 10 o'clock. Thank you. Good morning, everyone, once again. And we'll start today with A7, construction contract. Again, highly scoring, if you ask me, provided you understand the core concept of the standard, you'll be able to manage that. And then with the remaining time, whatever we have, we will start off with accounting standard 3, that is consolidated financial cash flow statement. And we'll try to complete as much as possible from the cash flow statement. So I'll just share my screen. Now, as far as construction contract is concerned, there is some part of disclosure that you need to remember. Okay. But apart from that, there is only one single logical flow that you need to understand. And this standard is closely related to accounting standard 9. When I say closely related, I say it because this has also got to do with recognition of revenue. How do we recognize? Of course, we will also recognize how much is the cost, and we'll also see how to recognize the profit. When you go to see a final level, you will understand accounting standard 7 plus 9 in a single standard. There will not be any separate standard that you need to refer to. Okay, so after you pass intermediate, you will understand it in a single standard. Now, before I jump into the core part of the standard, what I want you to understand is the logical flow which we need to understand. Okay, how is it different from the regular contracts? Once you understand that flow, the terminologies, the working and all of that, that is super, super simple. Okay. Now, in case of normal revenue recognition, when there are goods, we say, okay, when the goods, let us say when the title or risk and reward in the goods, when they have been transferred, we recognize revenue. So if I am selling one mobile phone, I give you the mobile phone, I recognize the revenue. There is no problem in that. Then when we come to services, we followed something called as proportionate completion method. That is, how much percentage have I completed? Based on that, I can recognize revenue. Now, when we come to accounting standard 7, this is also a kind of service. This is also a kind of service which is provided. But when we come to accounting standard 7, which deals with construction contract, I am providing some kind of services. You approached me, you asked me, can you construct a building for me? I said, okay, I'll construct a building for you. This is the cost. Sorry, this is the cost, right? But who is procuring the goods? Who is procuring the raw material? I am procuring the raw material. So I will procure the raw material. I will procure the labor related activities, and I will construct a building and I will sell it to you. Okay, so that is what is called as a construction contract. So it is slightly complicated because goods are also involved, services are also involved. Goods are also involved, services are also involved. Like I'm constructing road, or I'm constructing a bridge, or I'm constructing a building, or I might have purchased a land, constructed the building, and then I want to sell it to you. There could be multiple different scenarios, but this is specifically a case where there is a contract of construction. There is a contract of construction, and the key issues which are addressed here is, if it was only services, I would have said proportionate completion method. When there are goods and services, what is to be done? So here also, what we follow contract, percentage contract completion method. We recognize revenue and cost based on the percentage of contract completed, and the profit is also accordingly derived. Now, what is the meaning of percentage completion? It basically means, say for example, somebody came to me, they gave me a contract, and I have quoted a revenue, or I have quoted a price of, let us say, 1,000. Okay, I have quoted a price of 1,000 to you for constructing a particular item. Now, for this 1,000, I have estimated that my estimated costs are, let us say, material 200, labor some 300, overheads some 100. So 300 plus 200, 500 plus 100, 600. So I'll collect 1,000 from you. I will spend 600 to deliver the construction contract or construction services. Now, this 1,000 minus 600, that is 400 of profit. This is called outcome of the contract. This is called outcome of the contract. So by executing this contract, I will get a profit of 400. Now the key challenge here is, when should I recognize this 1,000 of revenue? When should I recognize this 600 of cost? Should I recognize revenue when the contract is completed? That will not give a true and fair picture because costs have been incurred over a period of time. So what the standard says is, for example, this is a 2-year contract. This is a two-year contract. In year 1, cost incurred is 400. In year 2, cost incurred is 200. Year 1, cost incurred 400. Year 2, cost incurred 200. Now, we calculate something called as percentage completion. How do we calculate that? total cost incurred in the current period, cumulative, we'll always do it cumulative till date, 400 divided by total expected cost 600. So percentage completion is cost incurred till date, cost incurred till date divided by expected total cost. See, we can calculate percentage completion based on outputs also, but as far as your examinations are concerned, mostly the questions will be based on input. Input means cost. Output is the final product. For example, if I am constructing a road, the kilometers built can be considered to be output. Okay. If I am constructing a building, square feet built can be considered as an output. But questions will be generally tested based on cost. So cost incurred 400 divided by 600, the completion becomes 66.67%. And in the second year, let us say we incurred entire 200. 600 is the cost incurred, 600 is what is expected. 100% is the total completion. 100% is the total completion. Now, revenue that you will recognize is 66.67% multiplied by 1000, that is 666.7. Here, by the end of year 2, 100% revenue means 1000. So this is cumulative. This is cumulative. So what do? First we take what is the cost we have incurred till date. Then we take what is the expected total cost. Then we calculate something called as percentage completion. This percentage completion is cumulative. This is cumulative. Okay. So cumulative revenue should be 66.67% of total revenue, 666.7. Here cumulative revenue should be 1000. So how much revenue should be recognized? Revenue for the year will be here 666.7. In the second year, total revenue should be 1000 till the end of year 2. And we have already recognized 666.7 at the end of year 1. So 1000 minus 666.7, what we get is 333.3. Okay, so this is the fundamental concept that you need to understand as far as revenue recognition is concerned. Then, how much should be the cost? Cost is, here we have incurred 400, here we have incurred 200, profit will be 266.7 and 133.3, total profit becomes 400. Do we have any question in this logical flow of concepts? That is, what is expected cost, what is cost incurred, what is percentage completion, and how we calculate revenue, the basics part. Is there any question? Clear? Okay. Right. Now, after having understood this, we will look at few key terms. We will see how things are calculated and then we will start solving the questions. What is a construction contract? A contract which is specifically negotiated for the construction of an asset or a combination of assets closely interrelated or interdependent in terms of the design, technology, function or their use. Now what does that mean? Either it is a negotiated contract for construction of a single asset. Single asset means bridge. It could be a road. Or a combination of asset. Combination of asset could be, let us say, I want to build a township. Okay, in the township, there are residential apartments, there are commercial apartments, there are amenities which are to be provided, which are interrelated to one another. Okay, or I have given a contract to build a highway. That highway has highway as roads and also bridges and tunnels. Okay, so those are interrelated. So construction of refineries or other complex pieces of land and equipment where there are multiple aspects coming together. So combination of assets closely interrelated or interdependent, that is called a combination. That is also called a construction contract. So one is a single asset. It could be a combination of assets. This is more for your understanding, nothing to do for the examination. Construction contracts also include service contracts directly related to the construction of the asset. For example, services of project managers and architects. So this basically means if I have to build a building, construct a building, then I also need interior designers, I need some project managers. Those related services which are provided are also included as a part of construction contract. Okay. Now, there are two types of contract. One is fixed price contract, second one is cost plus contract. Now, fixed price contract, basically it means that I will give you a fixed rate. I will give you a fixed rate. Means if you construct 5 kilometers of road, per kilometer I'll give you so much. That is fixed. It will not change, it will not vary. I will give you 100, I have given you contract to construct 100 kilometers of road. 100 kilometers multiplied by 100 rupees, that is your price. Okay. So a fixed price contract has a fixed sum and a fixed rate per unit. So it could be something like I will give you 10,000 plus rupees 5 per kilometer. This is also fixed because kilometer is fixed. Kilometer doesn't change. This is also fixed. This is also fixed. Then we have cost plus contract. This is where you find sometimes difficulty in exams question. So here you have to be slightly more careful. Cost plus contract, basically what it means is you will incur a specified amount of cost. For example, if I have to construct a road from point A to point B, the government and I will agree that okay, this is the cost I will be incurring, or the government will say this is the estimated cost, or will define some parameters. On that cost, I will add a percentage of cost as profit, and that becomes the contract price. This is called cost plus contract. So for example, if 10,000 is the cost and 20% is the markup, which is 2,000, the total price becomes 12,000. Generally in cost plus contract, you will not incur losses because whatever is the cost incurred, a profit percentage of that is given as allowance, right? Now, these are the two types of contract, fixed price contract and cost plus contract. Now, when you determine the revenue for a fixed price contract, whatever is the price agreed will become your revenue. And whenever you talk about cost plus contract, the total cost plus the percentage markup, that will become your revenue. Okay. Now, there is one more aspect that we need to understand, which is called as variations. Variation means, let us say, first you and I agreed that I will construct a 3-storied building. Okay, this is what you have initially agreed. As we started constructing, you also realize that we can add one more floor or half a floor as maybe, let us say, a terrace clubhouse or something like that. So subsequently, we varied terms of the contract. Varied the terms of the contract means earlier we have initially agreed, initial amount we agreed was for 3 floors. Then one fine day you came up and said, sir, can we have a 4th floor, which is a party house? I said, yes, of course you can have it. But then I will charge extra for that. I will not give it for free. I will not provide that service for free. So that is what is called variations. Okay. So initial fixed amount plus variations will become your contract revenue. Apart from this, there could be incentives. There could be penalties as well. Penalties you will reduce. Now, what is the meaning of incentive? You came and said, sir, if you complete the work within 6 months, then I will give 1% extra as a incentive or bonus. Penalties may also be there. If you delay it beyond 1 year, then 1% penalty is there. So that kind of arrangements can also be there. Now, these incentives and penalties, you cannot directly add it to the contract revenue. You have to see whether the revenue is probable and whether we can measure it reliably. For example, I am very sure or I am very certain that by the end of 4th year, 80% of work is completed. 4th month, not 4th year. By the end of 4th month, 80% work is completed, and it is highly probable that I will complete the remaining part in 1 month itself. So I will be entitled to the incentive. Only then I can add it to my revenue. So in revenue, whatever initial amount you have agreed, this you will take it directly. There is no confusion on that. And variation also, as and when there is variation which has been agreed, that you will include. When it comes to some claims, incentives or penalties also, you will see whether it is probable. Will I complete on time to be entitled to the incentive? And can I measure it reliably? If these two conditions are satisfied, that also gets added to the contract revenue. Okay, so this is the first one. So how do we calculate contract revenue? Initial agreed revenue plus or minus variation in contract work. If I increase, I will add. If I decrease the scope, I will reduce. Incentive payments. Incentive payments, if at all, here it has to, you have to check whether it is probable. Price escalation. So price escalation, what happens is sometimes we enter into a contract, let us say construction. It's a long-term contract, and if I am taking the contract, there is a risk that prices of cement, prices of rods, prices of other material, labor, all of that may increase. So to safeguard myself, I can add something called as price escalation, where I say that if the price of cement increases by more than 10%, then so much of amount will be added to the contract price. Okay, so that is escalation. Claims, if I have to claim something, so if I have some claim, if I have incurred some cost and I want to get it reimbursed from you, I want to claim from you as a part of the contract, this also is included. Minus any penalty. Any penalty means if there is a delay in work beyond 1 year, if it is delayed, 1% penalty. I am already in the 9th month and I know I will not be able to complete within 1 year. This penalty I will reduce from the contract revenue. So this is how we will calculate contract revenue as the first part. Now in an examination question, the three critical aspects actually. One is to determine the contract revenue. Generally straightforward, they will say that this is the contract revenue. Second is contract cost. How much should be the cost that I should incur, that I have incurred and that I will incur, that I need to measure. And then percentage completion. If these three things are in order, you can score out of out marks in this particular chapter. Okay. Then when it comes to contract cost, there are costs which are directly relatable. Directly relatable means the direct raw material, the direct labor, right? Whatever you understand as direct cost as a part of your costing. So that is included as a part of contract cost. Sometimes what happens is, let us say you sent iron rods worth 10,000 for the contract work. Out of this, only 9,000 worth of rods were used and the remaining is scrap. The remaining is scrap which you sold off for 500. So what you will do, 10,000 minus 500, 9,500 is what you will consider as a part of the cost. Assuming the remaining 500 are normal losses. So when you take all the set of rods, everything may not be useful. Some may be bent, some may be damaged, some may be small pieces, right? So to the extent it is normal, you will include it as a part of the cost. Any scrap sale, any incidental revenue that you get from the leftover material, that you will reduce from the cost. That is the first thing. Then any cost which are directly allocable to the contract based on normal levels of construction activity. Now, what is this? For example, there is an insurance at site that you will be able to allocate for the particular site. Now, insurance I may take for 10 sites together because I am not carrying out only one construction activity. I am carrying out 15 different construction activities. For everything I have taken a single insurance contract or single insurance premium I have paid for site insurance. This I should allocate to the construction contract on a reasonable basis based on the normal level of activity. Or there could be cost of design and technical assistance indirectly related to the contract. Maybe some kind of design work has been given to the centralized head office where there are a lot of designers, engineers and all of that. They work on multiple projects together. If that can be allocated, you can allocate. Construction overheads and borrowing cost, if they can allocate it. Directly related cost, material cost, labor cost, depreciation or cost of hiring plant and equipment, design and technical assistance directly related to the contract. Now, what is the difference between this and this? Here, I have hired an engineer and I have said you'll work only for this project for 3 months. Here, I have hired an engineer, he is working on 3 different projects. So that is the difference. Right. Then any cost specifically chargeable to the customer, meaning to say, I have to, let us say, construct a building. For constructing the building, I need an interior designer. I don't have the interior designer. I agree with the customer that I will get an interior designer. Whatever costs are there, I will charge it to you. So that is a cost which is specifically chargeable to the customer. Now, sometimes what happens is there are materials which are unused. Sent 10,000 worth of materials, 2,000 is still in inventory. In this case, cost for the year is only 8,000. Cost for the year is only 8,000. Cost that cannot be attributed to contract activity or cannot be allocated to a contract from should be reduced from the cost or excluded from the cost. For example, general administrative cost for which reimbursement is not specified, selling cost, R&D cost for which reimbursement is not specified, depreciation of idle plant and equipment that is not used at a particular contract. All of these should be excluded. Okay, so any abnormal cost should be excluded because that is our cost. Now, this depreciation of idle plant, think of it. For construction activity, I need a JCB. I have a JCB, but on that JCB is used for 3 months on a particular contract. Then 2 months it is idle. This idle time cost should not be charged to this particular contract. Okay, whatever time it has worked on, or for whatever period it has been dedicated for the project, only that depreciation should be charged. Right. So this is the theory part or conceptual part which we need understanding of. Then, most important, this from examination point of view, that is where most of the questions are tested in the examination, apart from the disclosure requirement. Okay, so first is recognition of contract revenue. So out of the total price, how much should I charge? How much should I charge, or how much should I record in the P&L? That is what we are discussing here. So for that, we need to check the final outcome of the contract. Final outcome of the contract means whether it will result in profit or loss. And if you can measure reliably, what is the final outcome of the contract, then you will recognize percentage completion method. Then, if you cannot measure reliably, I do not know the final outcome of the contract reliably, then revenue, very important, revenue should be recognized only to the extent of recovery of probable contract cost. Recovery is probable of contract cost which are incurred. What is the meaning of that? The meaning of this is, if I know the final outcome, I will use the percentage completion method. If I do not know the final outcome, then I will not recognize revenue more than cost. First thing. Second thing, whatever revenue I should recognize, there should be a possibility of recovery. Meaning to say, let us say in the same example, 1000 is the contract price. Now outcome I don't know because I don't know the future cost that I will be incurring. So in that case, in the first year I incurred cost of 400. This was the cost incurred. Cost I will recognize fully. Entire 400 of cost I will recognize. How much should be the revenue? For the revenue, maximum is 400. In that also I should say, see whether I can recover this 400. If I feel that I can recover only 300, revenue should only be 300. If I feel I can recover 400, revenue should be 400. But it cannot be more than cost. It cannot be more than cost if the outcome cannot be reliably estimated. Then, if the final outcome of the contract is a loss, this is a favorite question in the examination. If the final outcome of a contract is a loss, if the final outcome in a contract is a loss, then in that case, the expected loss has to be accounted for immediately. If there are uncertainties due to which outcome of the contract would not be reliably estimated, but those uncertainties have ceased to exist now, revenue expense should be recognized by the percentage completion method. Earlier, outcome was uncertain. We could not estimate the outcome. Now, we can estimate the outcome. So, start recognizing revenue and cost. Right? Now, what I'll do is, we'll take up a question. We'll come back to the theory subsequently. Because you need to work out the solutions in the examination. That is what is more important, right? Okay, so let's look at this question. PRZ and Sons are heavy engineering contractors specializing in construction of dams. Okay. From the records of the company, following data is available pertaining to the year ended 31st March. Using this data, applying the relevant accounting standard, you are required to compute the amount of profit or loss, arrive at the contract work in progress, determine the amount of revenue, work out the amount due from customers, list down the relevant disclosures. So this we have not yet discussed, but as a part of this question itself, we will discuss it. Disclosures, we know we can do it subsequently. Contract price, this is agreed price. Work certified. Now, work certified, what happens is, of course, you would learn this as a part of costing also. When I say work certified, then what happens is, when I'm building or when I'm constructing something, let us say I've constructed a road or constructed a building, till the time it is fully constructed, it is in progress. It is in progress. Now, the other party, that is my customer or myself, I can appoint an engineer who will come and say that, okay, out of the work that you have said, this much of work is certified, means whatever I have incurred as, the cost, whatever I've incurred as the cost, they would say this much of work is completed, they will give a certificate. Work pending certification, this means I have incurred some expenditure, but the engineer or the authorized person or the responsible person has not certified the work. So when I say work certified, it basically means that whatever cost I have incurred, there is a third party which has come and said this much of work has been certified, this much of work is not yet certified, it will be certified in the subsequent period. Estimated further cost to completion. So this is incurred, and this is future cost. This is future cost. Stage wise payment received. This 1100 is payment by customer. This is payment received from the customer. Progress payments in pipeline. This 300 is billed but not received. This is billed but not received. Okay. So basically, when we say stage wise payments received, I have already received the money from the customer, and this is still in pipeline, I have not yet received. Now, they have asked us to do many things. Okay, so some of them are related. For example, for profit and loss, I need to know the amount of revenue, and I will also need to know what is the cost and all incurred. So, first, what we have to do is we have to see always what is the outcome of contract. First step in construction contract related question, what is the outcome of the contract? Outcome is determine whether it is profit or loss. How to determine? Cost incurred, that is 1250 plus 250, and estimated cost of completion 1750, right? So work certified and work pending certification 1250, 250, this is contract work in progress or actual cost incurred. Contract work in progress or actual cost incurred. Why it is in progress? Because till the time it is completed, it will be in progress only. Okay. Then estimated future cost 1750, which means I have already incurred 1500. I am expecting to incur another 1750. So what is the estimated total cost? This is the total cost of contract, estimated to be 3250. This is the first step. Then what is the revenue expected? 2400. Revenue is less than cost, means the outcome is a loss. The outcome is a loss. This 850 of loss has to be recorded in the first year itself. Okay, if it was profit, it's a different thing, but here compulsorily you have to record in the first year itself. 850 of loss. Now, how much of revenue to be recognized? Now, for recognizing revenue, we need percentage completion, which is equal to actual cost divided by estimated cost. What is the actual cost incurred? We have already calculated 1500. 1500. Then what is the estimated cost? 3250. So 1500 divided by 3250, we get 46.15%. This is the most important calculation you will do, because remaining all steps will be dependent on this particular calculation. So percentage completion 46.15, percentage of revenue. Revenue is 2400. That is 46.15% of 2400, 1107.6 crores. So this is the revenue to be recognized. So far clear? Any questions so far? Okay. Now, one more thing I'll include here, which is not asked in the question. My revenue is equal to 1107.6 crores. And my cost for the year is how much? 1500. So the loss will be 1107.6 minus 1500. Loss is 392.4. But we have seen here that we need to calculate the loss of 850. There is an MCQ question also in the study material testing on the same concept, right? I need to calculate the loss, or my total loss should be 850. How much is my total loss here? Only 392. So I also need to provide for balance loss, that is 800 minus 392.4, that is equal to 800 minus 392.4, that is 407.6. This provision for balance loss, you should add it to the cost that you have incurred. So the total cost or expense, what you say, will be 1500 plus 407.6. So the total loss will become 800. Okay, so that is how you have to calculate the provision for the loss to be made or to be calculated. Okay, then the next thing which is frequently tested is amount payable or due from the customer. Amount payable or due from the customer. Now for this, you need to understand how it is calculated. Whenever I say amount is due from the customer, it is based on so here if you see, they have said we have received payments 1400, in pipeline it is 300, this is the amount receivable. Now we are saying how much amount is either due from the customer or how much amount we have to pay to the customer. Now think of it, in a normal scenario, this is, again, no need to remember the formula. In a normal scenario, amount from customer that I have to receive due, when I say, that is nothing but, what do I collect from the customer? Normally, I collect my revenue. Yes or no? I collect my revenue. This revenue, can I say it is cost plus profit or cost minus loss? That is what the customer has to pay me. So even in accounting standard 7, we have to see what is my cost plus profit minus any losses. This is what the customer has to pay me. In that, if any payments that I have received, this will be amount due or to the customer. Due from customer or due to customer. If I have to receive the money, it is due from customer. If I have received more, it is due to customer. Simple trick to remember, I will recover my revenue minus any payments received. I will recover my revenue. This revenue is as per books. Actual billing, progress billing, all of that may be different. We have to see as per books only. So in the given question, my cost is work certified plus work pending payment. This is 1500. So amount due is 1500. There is no profit, but there is a loss. How much is the loss we have recognized? Oh, I did here 800. None of you corrected me. This is not 800, but this is 850. So this number will also change automatically. So 1500 is my total cost minus loss of 850 minus how much have I received or is already in progress. Received 1100, in progress 300. So 1100 minus 300. So this will be 1500 minus 1400 minus 850, 750. Now if you see, this is what I am supposed to receive. 1500 minus 850. This is what I am supposed to receive. I have already received 1100 plus 300. So 1500 minus 850, that is what I'm supposed to receive. I have received more, so this is payable. So what about this 300? This 300 is my account receivable, which will be shown separately, or you can net it off and then finally show the net amount in the balance sheet. Okay, is this part clear? Clear how we calculated amount payable and amount due? Always take revenue, that is cost plus profit minus losses minus payments received and in pipeline. Any question in this? We'll do a couple of more questions because this is what is generally tested in the examination. Okay, generally this is what is tested in the examination. We'll take one more question from May 24 examination that will give you absolute confidence to handle this question in the examination. Yes, that 300 is still recognized as a receivable, as account receivable. We have already billed it. This is specifically from the point of view of contract payments due or to the customer. Let's look at this particular question. Uday Constructions undertake to construct a bridge for the government of Uttar Pradesh. The construction commenced during the financial year 16 and is likely to be completed by the next financial year. Contract is for a fixed price of 12 crores with an escalation clause. Cost to complete the whole contract are estimated to be 9.5 crores. You are given the following information. Cost incurred up to 31st March 4 crores. Cost estimated to complete the contract 6 crores. Now here cost estimated was 9.5. We have already incurred 4 and now we have already also incurred additional 6. So this is what is relevant. This is not relevant. Okay. Escalation in cost by 5% and accordingly the contract price is increased by 5%. So there is a 5% increase in the contract price. You are required to identify the state of completion and calculate the revenue and profit to be recognized. Right. Now, how do we recognize this? Very simple. First, what is the cost incurred? Cost of construction already incurred is 4 crores. Estimated future cost is 6 crores. So the total cost is 10 crores. Total cost is 10 crores. What is the contract price? Initially we have agreed for 12 crores. Now we have to add it by 5%. So 12 crores plus 5% of 12 crores, that is 12 plus 0.6, that is 12.6 crores. So total contract price is 12.6 crores. Now what is the outcome? Outcome here is profit. Outcome here is profit. We can measure it reliably. Right. Now what is the cost of completion? Completion till date is very simple. 4 crores incurred, 10 crores expected. Sir, but they have said here escalation is cost by 5%. That is already factored. See, it is not exactly the same number, but 9.5 versus 10, we have already factored in the increase so that you need not do it again. Okay, so the 40% is completion. Revenue is 40% of 12.6, 5.04 crores. Profit is 5.04 minus 4 crores, 1.04 crores. Simple question. Now we'll take one slightly, not a complicated question I would say, but if you are able to follow this question from May 24 examination 7 marks, construction contract is set. Okay, you will not have any trouble in solving that questions in the examination. Constructions Limited is engaged in the business of flyovers and rail over bridges. It obtained a contract from rail authorities to construct ROB for 400 crores. So this is not relevant for us. What is relevant for us is 400 crores, the contract revenue. The construction of the railway over bridge is expected to be completed in 4 years. Okay. It's slightly lengthy question, by the way. At the outset of the contract, it was estimated that total cost to be incurred will be 370 crores, but by the end of first year, estimate stands revised to 375 crores. What should we take? We should take 375. During year 3, so year 1 is gone, year 2 is gone. During year 3, Construction Limited has requested for a variation in the contract, which is approved by the authorities, and accordingly, contract value will increase by 10 crores and cost will increase by 7 crores in the third year. So when they say increase, from the third year onwards, we'll make it effective. The Construction Limited decided to measure the stage of completion based on the proportion of contract cost to the total estimated cost. Contract cost at the end of each year is given below. Now, sir, this is for the year or what? Contract cost incurred at the end means This is cumulative. This is cumulative number. Okay. Year 1 98.8 crores, year 2 202.4, year 3 310 crores, including unused material of 3 crores. If material is unused, we will not consider. Year 4 382 crores. Calculate the stage of completion of contract for each year, profit to be recognized each year. Now here in this question, the thing that you need to do is contract completion. Once you are done with that, calculation of profit is not a big deal. Now first year when it comes to stage of completion, actual cost is 98.8 and at that point of time, our estimate was 375, not 370. See, 370 was initial. By the end of year 1, it is already 375. So, we should take 375. So, 98.8 divided by 375, 26.35. That is the completion. Second year, 202.4. 202.4 divided by 375, 53.97. Third year, 310 crores including unused material of 3 crores. So, 310 minus 3, that is 307 divided by end of year 3. The total contract value will increase by 10, cost will increase by 7. So, our estimate was 375 plus 7. So, 307 divided by 375 plus 7. This is your number 80.37. And in the last year, fourth year, we have incurred how much? 382. Now, don't do 382 divided by 300. It's already 382, 5 and 7. But even if this number does not match, fourth year completion will always be 100%. Fourth year completion will always be 100%. Okay. Now this, instead of doing like this, you can plot it in the same table as well. No problem. Okay. Then, how much revenue should be recognized? Revenue recognition should be based on the contract price. Contract price is 400. So, first year revenue 400 into percentage completion. Second year 400 into 53.97 minus 105. What is the meaning of this? I gave you the example earlier. This is cumulative. What is cumulative? Not the subtracted part. 400 into 26.35 cumulative revenue at the end of year 1. 400 into 53.97 cumulative revenue at the end of year 2. But we have already recognized 105 here. So we will subtract that 105. In the third year, our escalation has happened, so 410 into 80.37 minus whatever you have recognized in the first 2 years, and in the fourth year 410 into 100% minus whatever you have recognized in the first 3 years. So if you want to make a simpler calculation, what you can do is you can actually have cumulative revenue. First year 105.4, second year 400 into 53.97. 400 into 53.97, you get 215.88. 215.88. 215.88 minus 105, you'll get 110. So like that also you can do. Then contract cost incurred, directly you can pick it up from here. 98.8 for the first year. Now second year, don't take again 202.4. This is cumulative. 202 minus 98.8. 202 minus 98.8. 307 minus 108.8, 98.8 minus 103, and lastly 382 minus whatever has been recognized. This is 75. Profit is revenue minus cost. This is the profit to be recognized. How many marks? 7 marks question. Most likely it would have been 2 marks for calculating this, and maybe 5 marks for this particular paper. Okay. If you get a question like this in the examination, tell me who can stop you from scoring 7 out of 7. And that should be our mentality. If at all we get these type of questions, just grab that question and solve it. Even if it takes 2 minutes extra, 3 minutes extra, you are assured of the marks. Out of the 7 marks, 7 out of 7 means then we are left to score only 57 or 53 out of 93. Our task starts becoming much easier. Okay, so that is how we have to do. So what will the institute do is they will try to confuse you with this kind of heavy English. Only with good amount of practice you will be able to. So if you solve all the questions in this particular compiler, it is already available as a part of your dashboard. If you are able to solve this, life is set. Okay, only thing is English. Read the English very, very carefully. What is included, what is not included. If you are able to do that, there is no challenge at all. So let us look at this particular question. Grace Limited, a firm of contractors, provided the following information in respect of a contract for the year ended so and so. Fixed price contract with an escalation clause, 35,000. I think this is slightly setting error. Work certified 17,500. Work not certified 3815. Estimated future cost to complete 17,325. Progress payment received. So we'll take the actual question. Just give me a moment. Hope you are able to see me in the video now. So the power was not connected properly. Suddenly it shut down. Okay. Anyway, so in the meanwhile, what I've done is I pulled out this question, actual question, which is incorrectly done in the format. Okay. So this is in the old advanced accounting. I was searching in accounting paper. This question again. Now this question has been asked for 5 marks. If you look at the solution, it's pretty lengthy. Calculation of estimated cost, stage of completion, revenue, loss, provision for the loss to be made, all of those things. It is lengthy, but the thing is, you can score 5 out of 5. That is the whole objective. Okay. Even if I'm spending 2-3 minutes extra, and if I'm able to make 5 out of 5, it serves my purpose. And keep one thing in mind, after Institute has introduced MCQs, they are setting theory, the descriptive part lengthy. This is what I've observed in the previous attempt. They have actually made it pretty lengthy. So be mindful that yes, questions will be lengthy. Accordingly, our speed has to increase. Okay. Now let's see the question. Similar, we have already done a similar question. Grace Limited, a firm of contractors, provided the following information: fixed price contract with an escalation clause 35,000. Now, a lot of students have this doubt, so how to write in the answer? You can directly write 35,000, but ensure you convert the other numbers also in thousands. Work certified 17,500. Work not certified includes 2625 for materials issued, out of which material lying unused is 140. So what does this mean? Work not certified is 3815. Out of that 140, I have to ignore these 3 zeros. 140 means minus 140 will be my work not certified. Why? Because this material is still unused. So if material is unused, that becomes my inventory as per AS2. Okay, so I should not include it as a part of my work cost incurred. Estimated further cost to completion. So here also they have given ulta. Estimated cost of completion 17,325. Progress payments received 14,000. Payments to be received 4,900. All these terminologies you are already aware of. Escalation is caused by 8% and contract prices increased by 8%. Similar, right? Compute the contract revenue to be recognized. Calculate P&L for the year ended 31st March of 22. And additional provision for loss to be made, if any, for the year ended 31st March of 2022. First thing, fixed price 35,000. Now coming to the solution. Contract price 35,000 and they say there is an escalation by 8%. So 35,000 into 1.08, 37,800. This is the revenue. Cost already incurred 17,500. Not certified is also cost incurred. So 3815 minus 140. Why minus 140? Because that material I have not yet used. It is still lying at the side. So 3675, 21,175. Estimated future cost given in the question 17,325. Total cost 38,500. Contract price 37,800. Cost is more than revenue. So there is a loss. Outcome of the contract is a loss. So the total loss should be 8 minus 5, 3, 300. and sorry, 15 minus 8, 700 should be the loss. Okay. Stage of completion. How do we calculate stage of completion? Total cost incurred divided by estimated cost, right? So what is the total cost incurred? 21175 divided by 38,500, 55%. So this is 1 mark for you. Okay. So you can directly say stage of completion is in exam is equal to work or cost incurred, work completed or cost incurred divided by total estimated cost. No need to write out the contract, percentage of completion till date to total estimate cost of construction. This also you can ignore so that you can save some time. Revenue to be recognized 55% of 37,800. So 37,800 into 55%, 2,790. Again, here also, this you need not write. If you just calculate this, you will get the marks. Then, loss to be recognized, that is cost incurred minus revenue, 385, and additional provision for loss that you have to make. So, here, this you have already, here itself we can calculate, loss is 700. So, no need to do this working again. This working you can skip. This 700, that working you can do here itself. So 700 is the expected loss minus 385 is the loss recognized, 315 you have to make additional provision. So you'll get 1 mark for this, 2, 3, 4 and 5. Simple, right? So that is how we should target and score wherever possible out marks in the examination. Any question in this particular question? Any question in this particular question? No questions? Okay. So see again, June 21 5 marks, similar question. Similar question. Okay, they'll add something. Labor expenses for worker engaged 16 lakhs out of 1 lakh is unpaid. Unpaid means what? It is an expense. You will recognize. Specific contract cost 5 lakh. Subcontract cost 5 lakh. Advance paid is not my expense, so that I should not consider. Right. So accordingly, you have to see advances should not be considered. Labor cost is already given to be 16. Outstanding does not make a difference. Okay. Then 21 lakhs out of which material 4 lakhs still lying unused. What I will do? 21 minus 4, 17 is what I will use. If material is unused, I will ignore. And institute is trying to play games with you by giving these things. Same again, percentage completed revenue. So here we'll do this one. At least one more round of practice will happen, and then we'll come back to theory. Okay. If you are able to handle these questions, trust me, you will score out in this particular questions in the examination. There cannot be any more complexity. Rajendra undertook a contract of 20 lakhs on an arrangement that 80% of the value of work done as certified by the architect of the contractee should be paid immediately and that remaining 20% be retained until the contract was completed. Now this is basically talking about retention. Just understand, if you have given me a contract and I have said I will charge 1000 from you, if I complete 500 of cost or work, you will not give me 500. You will keep something as a retention because the work should be completed. What if there is some damage subsequently? So generally what happens, typically 10% or 20% of the amount which is billed, that is retained as a retention money which will be released subsequently. Okay. In year 1, the amounts expended means spent, English, where 8,60,000 and the work was certified for 8 lakhs and 80% of this was paid as agreed. It was estimated that further expenditure to complete the contract would be 10 lakhs. So, how much is incurred? 8,60,000 is already incurred. This does not make any difference to me because I already have the number of 8,60,000. I am repeating once again. This 8 lakhs is of no relevance to me. I should not consider this. This I will consider because that is the amount which has already been incurred. That is already there. Then it was estimated that future expenditure would be 10 lakh. So what is the total estimated cost? 860 plus 10 lakh, 18,60,000. So done, 1 mark in your pocket. Okay. It was estimated that, in year 2, the amount spent were 475. 3/4 of the work under the contract was certified as done by December 31st and 80% was received accordingly. So, how much did we spend? 475 in the second year. It was estimated that future expenditure to complete the contract would be 4 lakhs. Now, this is for the second year. This is for the first year. In year 3, amount spent were 310 and on 30th June, the whole contract was completed. Show how contract revenue should be recognized in the P&L each year. Now, is it asking me cost? No. What is it asking me? Only revenue. How should I recognize the revenue? Every year in the financial statement. Now, first year is very simple. Actual expenditure 860, future expenditure 10 lakhs, total expenditure 18 lakhs 60,000. So, how much revenue should be recognized? Percentage completion 46.24%. That is 860 by 1860, 46.24%. So, revenue, I don't know why we missed it here. Revenue in year 1 is equal to 46.24% of 20 lakhs. 20 lakhs. Okay. So 46.24 of 20 lakhs means 46 into 2 is 92. 924800. 924800. This is in year 1. Now in year 2 what has happened is, in year 2 we have incurred expenditure of 475. That is the expenditure for year 2. Future expenditure we are expecting 4 lakhs and we have already incurred 860 here. So this 860 will also come in the cumulative expenditure. Now this is one standard where you have to be comfortable in handling cumulative numbers. Okay. So the cumulative numbers are 475, 4 and 860. Total became 17 lakhs 35,000. 17 lakhs 35,000. This is the total expenditure. How much have we incurred so far? 475 and 860. So 475 plus 860, 76.95%. How much revenue should be recognized? Cumulative is 20 lakhs into 76.95 minus 924. It gives us year 2 6 lakhs 14,000. So total percentage multiplied by total revenue will give me cumulative revenue. This cumulative revenue minus whatever I have recognized should be the revenue in year 2. Now when we go to year 3, till year 2 we have already recognized 15 lakh 39,000. So balance should be recognized in year 3. So in the third year it will be directly 20 lakhs minus 1539 461. Okay. We don't need to calculate percentage because in year 3 it is anyways 100% complete. Okay. Nothing has been asked about how much should be the cost, but if they ask, you will be able to compute from this directly. Again, similar question, May 18, 5 marks. Okay. Right? So we have handled the type of questions working that will be tested in the examination. Now coming back, a quick recap of the theory portions. Now, we spoke about outcome of the contract. For question solving purpose, you will just take what is the profit or loss, whether you can determine it properly or not. But there are some conditions we need to check. For a fixed price contract, the final outcome can be measured reliably or estimated reliably if the total contract revenue can be measured reliably. This is given in the question. It is probable that the economic benefits associated with the contract will flow to the enterprise. Basically, I will receive the money from the customer. Both the contract cost to complete and the stage of contract completion can be measured reliably, and the contract cost attributable to the contract can be clearly identified and measured reliably so that actual contract cost can be compared with the prior estimate. So basically what you have to see is I should be able to measure the revenue reliably, I should get future economic benefit, and the contract cost as well as the stage of contract or the future contract cost should be estimated reliably. For a cost plus contract, it is probable that the economic benefit associated with the contract will flow to the enterprise, and the contract cost attributable to the contract can be clearly identified and measured reliably. So contract cost you will be able to measure reliably, and economic benefits will flow to the enterprise. Of course, revenue you should be able to measure reliably. If you cannot measure the revenue reliably, you will recognize only to the extent of cost incurred. Percentage completion you have already seen, total contract cost divided by total expected cost, revenue, contract price into percentage of cost completed. Expected loss on contract is recognized as an expense immediately. Okay, this is the first step in your calculation, so that finally when you get to the loss for the year, let us say it is 200 and expected loss is 300. 200 minus 300, this 100 should be provision for loss. The amount of such loss is determined and recognized irrespective of whether or not work has commenced, stage of completion, amount of profit expected on other contract. Meaning to say, once you have estimated that there will be a loss, recognize the loss. Don't worry about what will be the future profit or I'll make profit in the future. No. Today, if it is an estimated loss, it is recognized immediately and fully. Okay, this is done. Yeah. Uncollectible contract revenue. When an uncertainty arises about the collectibility of an amount already included in revenue and recognized in P&L, then the uncollectible amount is recognized as an expense. Subsequently, this is basically your bad debt expense or your provision for bad debt. Then when it comes to stages of completion, you can use, most likely this is the question that is tested, proportion of contract work cost incurred till date to the estimated cost, or you can carry out survey of work performed. This is more like an output, or completion of physical proportion of contract work. This is also output. If at all they do not give you this information, and if they give you this information based on output, you can calculate. Then the next part is more on theory side. They may give you a case study and ask you whether you should combine multiple contracts into a single contract or whether you should segregate the contract. Now it becomes important because if there are two different contracts which are highly dependent on one another, for example, I take up a contract for construction of a building. In that contract for construction of a building, I am also required to give club facilities. I am also required to construct club facilities. Now what happens is, I know on the building side I will incur or I'll make profit. On the club and amenities side I will incur losses. Okay. To manage, what I do is, to manage my revenue, to manage my P&L, I enter into two separate contracts. So basically what I do, building separate, club separate. Building there will be profit, club there will be losses. Okay, I know that. So I enter into two separate contract. I manage the timing such that I can manage my taxes. Okay, but what the standard says is, if these two are related, don't segregate them. Combine them into a single contract and recognize accordingly. Meaning to say, take this profit, take this loss, treat the entire bunch as a single contract. So we have to see whether we should combine or segment. Combine means two different contracts and we can make together, or segment, single contract, divide into different contracts. Okay, so that is where we have to check the condition. Okay, now if a contract covers several assets, the construction of each asset should be treated as a separate construction contract. When should we treat it separate? When separate proposals are submitted for each asset is separately negotiated, and the contractor and customer can accept or reject part of the contract relating to each asset, and the cost and revenue of each asset can be identified. Now, this could be a case, for example, I have to construct buildings at 3 locations. I have entered into a contract with you, 3 locations. Let us say Hyderabad, Chennai, and Bangalore. I negotiated Hyderabad separately with you. I negotiate Chennai project separately with you. Bangalore project also I have negotiated separately. But to save cost on legal registration fees, stamp duty and all of that, what I do is I enter into a single contract. I don't enter into 3 different contracts. But tell me, Hyderabad, Chennai and Bangalore, did I submit separate proposals? Yes. You could have said sir, I accept Hyderabad proposal from you, I reject Bangalore and Chennai. Yes, that is also possible. So, if separate proposal has been sent, if separately negotiated, and you can accept or reject each part of it separately, and cost and revenue can be separately identified, the substance is that these are separate three contracts. Legal form, it is a single contract, but because I have negotiated separately, I have handled everything separately, these are separate contracts for the purpose of accounting. So what I will do, I will create three separate contract accounts in my books. That is the meaning of separation or segmenting of contracts. Then a group of contracts, whether with a single customer or with several customers, should be treated as a single contract when group of contracts is negotiated as a single package. Contracts are closely interrelated, that they are in effect part of single project. Contracts are performed simultaneously or in a continuous sequence. Now this happens in a case, for example, I have taken a building contract. First floor is for the holding company. Second floor is for the subsidiary company. So subsidiary company will occupy the second floor, holding company will occupy the first floor. Accordingly, we have negotiated the contract. But everything was done together. Negotiation of prices was done together. Then the prices were agreed together. The price of one contract, holding price, has impacted the price of the subsidiary. Maybe from holding I am charging 120, but from subsidiary I am charging only 80 for their management purpose. What the standard says is, because you have a group of contract which is negotiated as a package and they are closely interrelated, basically there is a continuation. Unless I complete the ground floor, I will not be able to complete the first floor. So it is a continuation of the contract, and they are performed simultaneously, and they are interrelated and a part of single project with a single margin. So this, they say, you combine or treat it as a single contract. Okay, so basically what you are saying, look at the substance of the contract, not the legal form of the contract. If the substance of the contract says that this has to be combined, you should combine. If the substance of the contract says that it has to be segregated, you will segregate or segment. See, this is more from accounting point of view. Then, if there is an additional asset under a contract, it should be treated as a separate contract when the asset differs significantly in design, technology, or function, and the price is separately negotiated. So, let us say you gave me a contract to build a particular, building. I was executing that, then you came up and said, sir, I like your work. So let us have another place. There is one more building which you need to construct at a different location. In that case, most likely the additional asset, though it is included under the original contract, it is a separate contract. But if I have entered for construction of 3 floors, you come up and say, sir, let's also build the 4th floor. Then in that case, it is a part of the existing contract. So looking at the facts and circumstances of each case, you have to decide whether it is separate or not. Okay. So if you see some questions, AP Limited, a construction contractor, undertakes construction of a commercial complex for K Limited. AP Limited submitted separate proposals for 3 units of the commercial complex. Single complex, 3 proposals. A single agreement is entered into between the 2 parties. The agreement lays down the value of each of the 3 units, that is 50, 60 and 75. Agreement also lays down the completion time for each unit. Comment whether AP should treat it as a single contract or 3 separate contracts. Okay. Now, when should we treat it as a single contract? When separate proposals have been submitted. When should we segregate? When separate proposals have been submitted, each asset has been a part of separate negotiation. Cost and revenue of each can be measured separately. So, here if you see, they have given separate proposals for 3 units. Proposal has been given separately, means negotiation also has happened separately. So you have to give these 3 conditions and say you need to treat construction of each unit as a separate construction contract. Okay. This again is a theory question. Look at this. GTI Limited negotiates with Bharat Oil Corporation Limited for construction of retail petrol and diesel outlet stations based on proposals submitted to different regional offices of BOCL. The final approval for one outlet each in region X, Y and Z is awarded to GTI. Single agreement is entered into between two. The agreement lays down values for each of the three outlets. Agreement also lays down completion time for each region. Comment whether they should treat it as a single contract or separate contract. Now again, when should we treat it as separate? When we have given separate proposals. Did we give separate proposals? Yes. To each of the regions we have given separate proposals. So then you have given separately, negotiated separately, approval is given separately, so they have to be applied separately, they have to be considered as separate contracts, right? Then sometimes what happens is in the examination they also ask you questions on disclosures. Okay, some standards where I have specified that go through disclosures thoroughly, like in case of let's say accounting standard 19, disclosures are very important. Accounting standard 7, disclosures are important. Please revise the disclosures as well. So what do we disclose? Contract revenue, amount recognized, what is the method used, and what is the method used to determine stage of completion. Then disclose cost incurred and profit recognized, advance received and retentions. Then this is very important. They have asked multiple times amount due from or due to. So how to do it? How to do it basically is, as I told you, cost incurred plus profit minus losses minus amount received, and if at all there are any billings which have been done. Billings means I have already billed you and it is in pipeline. So cost incurred plus profit minus losses minus progress billings, you have to calculate. If the amount is positive, due. If the amount is negative, you have to pay to the customer. Due from customer is an asset, due to customer is a liability. Okay, so that is it from this particular standard, accounting standard 7, a highly scoring standard. I want you to go back and go through all the questions that has been given as a part of the compilation. Okay, any questions? If no questions, then we'll take a 5-minute break and we'll start with accounting standard 7. Second, in the ICI material, question similar. See, ICI study material, no? So they jump things. They have skipped the first table. We can't do that in exam. Okay, so second question. What is the second question? Are you referring to this one, May 22? What we did? So how can you skip? See, one thing is you write in. Okay, so there are two ways to solve the questions. I will see. I'll pull out the study material actually, so that we can clarify this doubt immediately. You don't need to worry. So study material is not the benchmark for writing answers in the examination. Please keep that in mind. There are some errors. Some things have not been properly given, so we should not do that. So also the way they have given is you should give 9 first. You should learn 9 first and 7 subsequently. Illustration number 6. Okay, same thing what they have done. So, see what they have done is, here we have taken work certified, work not certified, 21,175, that they have calculated here, 605, okay. Then 1100, they have done working like this. So here they have done 500 plus 105 plus 495. If you want, you can do that way also. But what happens is, for the examiner to give you marks, he's searching for these numbers. So it is easier if you do, see, the problem here is, here anyways you have done 500 plus 105, 605. Add 495 here itself, no. That is more easier. So what you do is, take this 495, add it here and bring it to 1100. They have split the table, which is not drawn in a logical way. Finally, what the examiner is looking from your answer is, did you calculate 605? Did you calculate 1100? Then, did you calculate this 100? Did you calculate percentage? Now see, percentage they have said this is 55%, like don't do that. Say percentage completion is 605 divided by 1100, so it is 55%. Examiner is looking for this 55%. Then examiner is looking for this 550 and looking for this particular amount of 35 lakhs. So do it in the manner, suggested answers are slightly better because they have some inputs from the examiners also. So do it in that manner. This is a clumsy way of doing the answers in the examination. Okay.